Let's get some good to hear you. All right, good. Steven, good to see you. All right, good. Mark, perfect. Don, welcome. All right, loud and clear. Susan, Phil, good to see you again. All right. If everybody wants to be able to see the chat, once again, if you click where just above where it says two, you can click to everyone so everybody can see everyone else's chat. Just please, be respectful for everyone here, and you don't want to get booted out. Okay, so let's just take care of that. All right, so just a quick little intro of what we're going to be doing. Let me just get this up and running. So you can see from here, these are our new. Let me just fix this. Hold on. Slideshow set up. Browse window. Here we go. All right, so we got a great lineup for today. Obviously, you could see some of the great speakers that we're going to have. I'm going to kick it off here. Then we have Price Headley. We got John Hutchison. We got Jeff Hurst. We got Dan Gibby. And we got Jason Bodner that's going to come in here. And we got a lot of really good stuff that's going to happen. We'll talk about trading. We're going to talk about, what's happening with the world, with the war. Market's down 500 points. I'm going to do some trading with you. I'm going to show you, exactly how to trade today's markets. And everyone here is going to give you a great product where everyone's going to learn something. Now, if you can't be here all day, that's okay. It is going to be recorded as long as you're registered and you're on our newsletter. We will have some shorts made up for you, and we will have it will be on our YouTube channel where you can watch them later on. All right. So with that said, everyone, let me just get right into it. So I'm going to kick it off, and I want to tell you a little bit about, the type of style, what we do here at CyberTrade University, and want to talk a little bit about, how to follow what we call the big block orders. Obviously, everyone is noticing what's happening with the war. It is putting a very big strain on the market with oil, with certain stocks. You hear that, could this be a short war or could it be a long war? But in our business, you got to keep in mind, we really don't care what the market does. We're just here to make money. Okay. So you'll notice that when you're part of CyberTrade University, we really kind of don't take things personal. We try to keep our political beliefs out of it, anything it may be, because if you do, that means you take things personal. And then if that happens, believe me, you will lose terribly in this market. So what I'm going to do is I'm going to go over some of the stocks that benefit from the market and some of them that got really crushed because of the market. And, depending on you, if you're a day trader, a swing trader, an options trader, you better know how to be prepared with the right brokerage firm's accounts and actually how to look for what's going on. And let me tell you, when I show you a couple of things in the market right now, you're going to really learn that you just basically just know a fraction of what you should know to be very successful at it. So quick little disclaimer, just to make the attorneys happy and making sure everybody understands that there is a very high risk to trading. And this goes for everybody that's going to be doing a presentation today. We're not making any guarantees or promises or anything like that. Okay. It does, vary from student to student. You can lose all, if not more, your money in trading. We just want to make you aware of that. So I always try to tell everybody, don't trade when you can't afford to lose. Okay. So now we got that out of the way. Let me just kind of get into talking about what we're going to be offering all of you here at CyberTrade University. So within the next 30 minutes, I'm going to invite all of you to come to our professional trading room. Now, we have some people that are here now. Most of them are in the room trading live. Let me just bring it up over here and show you what's going on, because they're having some fun trading some stocks right here. This is our professional trading room right here. And you could see here, I'm just going to unmute it. Rich, one of the instructors, is talking right now. Oops. Wrong one. There we go. Just get down, man. So Rich is basically talking to the traders in the room. We're looking at a couple of stocks like POET. And right here, let me get my little crayon so you guys can follow along so you see what we got going on here. As of right now, we got close to almost 200 traders in the room. These are all our instructors. These are people all around the entire world. You can see people from Los Angeles, Alberta, Illinois, Ontario, England. We got people from all over the world. These are traders out there that are trading, and we got our watch list right here. So I'm going to invite all of you out there. This is one of the first trading rooms that started over 35 years ago. I started one of the first ones in there. So whatever I do, we practice what we preach. Okay. So I'll give you that golden ticket in the next few moments, because everything that I show you that we're going to do right now, you're going to see that we do that for the next week in the trading room plus more. So with that said, everyone, for some of you, I don't know who was here, but did you guys ever see me do a speaking before? Just give me a yes or no. Just want to know how many new people are here and some retakers are. Yes, you knew. Yes, yes. Bill, no. Roberto, no. Vincent, no. New. Okay. All right, so good. We said a lot of new people. So it looks like 50-50. All right. Old student Lita, of course. Well, welcome back, Lita. Lita's actually right here in the trading room. She just logged in. This is her right here. She just chat back there. That's the one, that beautiful face right there, Lita. All right. So anyway, for some of you that don't know who I am, just to let you know a little background, I'm one of the original day traders that started back in the early 90s. So when I started, it was a few thousand of us, and now there's a few million around the world. So, I'm not that old. I'm only 54, but I started when I was 22. So you could look at me as being the great-great-grandfather. I don't think anyone here has been day trading more than 35 years. So unless you work for a prop trading firm. So I know the system very well. I'm going to teach you the system. And what you're about to learn is that nothing really changed. The only thing that pretty much changed from when I started till today is you don't have to live here in New York, work for a brokerage firm, a trading firm, trade their money. Ticket charges went down a lot. Fractions are gone, but the technology is the same. And the technology I'm about to show you is about 50 years old. And some of you probably don't even know what it is, never seen it before. And you're going to be completely shocked that you're going to realize that you can't trade without it. Now, this is not the Fausto trading indicator or trading software or anything like that. This is just how the exchange works, and you all have access to it. Now, I've done many presentations in some of the big financial institutions in the world. Nasdaq always had me on. You could see a bunch of videos that you'll see that their platform is what we mainly trade off. And if you're not trading on it, I don't know what you're trading on. So we're going to talk about ECNs, all that stuff. Now, before we move forward, I want to give everyone access to my book for free. It's a fast read. You'll be able to read it within a couple hours. I did that specifically because I just want to get right to the point. So for everybody right here, if you could just take a moment and open up your inbox, and I want you to write right here, Fausto at c2trading.com. And the subject line, I want you to write book. Okay. And then very important, I don't know, some of you here are logged in with different names or whatever, but please give me your first name and last name. And if you want to get a phone call and maybe you want a little support from us, just drop your phone number. We won't solicit. We won't pass it around. If you want to give it, you can leave it. But at minimum, give your first name and last name. And so write that book. And then I'm going to give you my book immediately once we're done today. And it'll be great because when you come to the trading room, you'll learn that much more of what you're looking at. You'll know everything that we covered here, just a little bit more detail, and just hit send. There we go. All right. So as all of you guys are doing that, Mike, wow, you're pretty fast, Michael. You must have had your email up and running pretty quickly. Tefan says, I just got your book read. It was amazing. Thank you, Fausto, for sharing it. That is, you're more than welcome, Tefan. I'm glad you enjoyed it. Thanks. And like I said, I think everyone's going to enjoy it. So not that because it's my book, it's just that, I always feel like the market was very good to me, and I always want to give back to everyone. And that's one of the big things. So let's talk about what is the style here in Cyber Trading University. Okay. The style is this. I don't care what I trade. Finding these stocks are very easy. Okay. There are 25,000 stocks out there, and people are like, wait a minute, how do you say this is easy? Oop, my phone's ringing like crazy. You could probably hear it binging like crazy. This is all you guys writing for my book right there. Carlos, Lynette, I just got yours. Robert, Steven, These all the people are emailing me. All right, good. I'm glad you guys are very interested. We got over what, 100, 200 people in the room? That's awesome. That's great. But anyway, with that said, let me get back to what we're going to cover. This is a very important question to ask everyone. And I always tell everybody, do not take this the wrong way, because I tell everybody, I was raised by a very strict dad. I'm first generation Italian, and, we're from New York, and I'm old school New York, and we just tell you how it is. So we do not give trophies for last place. Okay. But this is very important. If you can't answer this question, you should not be trading. And the question I have to ask all of you is this: how do stocks go up and down in the stock market, everyone? How do they go up and down? Mark, you're right. Kathy, you're right. Brent, you're right. If you don't know the answer, just give me a question mark. Just be very honest with yourself. Okay? Susan, you're right. David, you're right. Phil, you're right. Wow, everyone is getting this answer right. Okay? By the way, if you don't answer this question, then I assume that you don't know the answer. All right? So the right answer is this: buyers and sellers. Just write B and S. Okay. If you didn't know, if you're not a good typer, just write B and S so I know you're paying attention. Because the thing is this: the way you learn and be part of Cyber Trade University, if you can't contribute and don't know what you're seeing and can't answer, then that means you're trading by yourself, you're a deer in the headlights, and you're overthinking things. So I think we all agree, buyers and sellers. So I want you to remember that, because what I'm going to show you right now is I'm going to teach you how to follow the buyers and sellers in the market. Now, I'm going to bring up the market right now, and we're going to look at a couple of stocks here. Okay. Now, does anyone here have a stock that you want to look at? Just give me any stock out there. It's got to be brand name, and it's got to have volume. Okay. And don't give me something that you're stuck in and that's not going anywhere. HIMX, that was a good one. HIMX, that was a really big mover this morning. Okay, Kathy says HIMS, ASTS is pretty good. I think we were trading HIMX this morning. Now, people are like, wait a minute, does anybody even know anything about HIMX? HIMX right now, if you look here, they say it doesn't matter what the news is, but it's up about 23%, 18 million shares. And if you look right here, it is number 11 on the big percentage gainers list. Okay. Now, the thing is this: it had a really, really nice run this morning. Fabulous run. But when the market opened up, once it got around here around 9:30, it started going down. Right? Does everybody see that? Now, do you notice what happened here at 11 o'clock this morning? Does anybody know? What happened? It's kind of like, you could let me zoom in a little bit closer for you. Okay. So you see now what happens when you zoom in too close, it's not easy to see. So I'm going to go back. I'm going to bind this out. I'm going to clear this out. And you can see right here, kind of hit a little support levels there and resistance levels there. So now it finally came down. And now, like, all of a sudden, it stopped at this number at 11. And then, but it's got a lot of resistance levels here. Okay. So my question to everyone here is this: by looking at the stock right now, ballpark, from what you could assume, where is support and where is resistance? Can anybody tell me? Where's support and where's resistance looking at those numbers? In theory, Steven says 11 and 12. Okay. Michael says 11 and 12. Anybody else? If you don't know the answer, give me a question mark. All right. So to answer the question, you are correct. From what we see here, when it hits somewhere around 11, it goes up. When it hits somewhere around 12, it goes down. So the stock right now is, what's the trend of the stock right now? Is it going up or going down? Everyone. Barbara said it's going down. It's not sideways. It's not sideways. There is a support. There is a resistance. Okay. It is channeling, but the end of the day, you are correct. Supports at 11 and resistance at 12. So the stock is obviously, you hit a resistance at 12 and now it's starting to trend down. So where should it start going up? What was the number again, everyone? What was the number you said? 11, right? Everybody write 11? Okay. Now, that is the past. We can't see the future, right? We can't see the future. So we just see what happened, past-wise. So what I'm going to do right now is I'm going to show you something that is going to knock your socks off. All right? We all agreed the way stocks go up and down is supply and demand. Okay, so what we're going to look at right here is this. This is called the current order book. These are every order that is out there around the entire world. Okay, every algorithm, every brokerage firm, every exchange, they have orders out there. These are the prices. Okay, and at every price is a big, big order. Now you're looking at right here, it's called a heat map. This is called a heat map. Okay. Now, if you look over here, every place that there was a big number, that is what we call a supply. So right now, the stock right now is trading right around 12. Now, what did we say about 12 again? What was 12? What did we say? Yes, it was a resistance, right? But now the stock is starting to trend down. That resistance is a 250,000 share seller out there. Well, now it dropped down to 170. Okay. You said 11 was support. How many shares do we have that looking to buy at 11? How many shares? What do you guys see right there? What number is that? About 15,000. Now, by looking at the chart, do we have more buyers or more sellers? You got more sellers. So just because you thought and looked at the chart, it might say a support levels. When you look at the orders, they're not there. So do you think the stock has more of a direction to go up or go down? What do you think? Great. Now, did you need a stochastic, a momentum, a Bollinger Band, a MACD? I don't know, whatever you guys use, an RSI? Did that help you answer that question? Did this basically kind of give you a game plan of knowing that there was a 250,000 share seller at 12 and no buyers at 11? All right. What was easier to read? Chart note, the one on the left or the one on the right? What's easier? The one on the left. The one on the left. Now, they do this on every single stock, fellow traders. They do it on NVIDIA. You could see big orders at 200, 190. No one looking to buy till 170. They do it on Coinbase. Okay. They do it on Palantir. Okay. They do it on Amazon. I mean, look at all these orders at there. You can see where they are. 20,000, 30,000. They do it on every single stock. By the way, let me clear this out because it's giving me a headache. All those indicators get me confused. There we go. All right. So did I get everybody's attention? So my question to you is this. How do stocks go up and go down again? Buyers and sellers, right? B&S. So now what I want to do is I want to kind of show you a little bit more of the difference between what we call level 3 quotes, which is Nasdaq, which is called TotalView, and level 4 quotes. Now, I've done, I can't even count how many speakings I've done at Nasdaq, but Nasdaq hires me. I've done a lot of training for Nasdaq. I've done a lot of presentations for Nasdaq. Nasdaq is probably the biggest exchange. It is probably is the biggest exchange in the world, bigger than New York Stock Exchange. They probably do about half the volume in any stock than any exchange in the world, more than the New York Stock Exchange, the CBOE, all of them. And the thing about the Nasdaq exchange is that they give you the tools, including the other exchanges. I'm going to work on Nasdaq specifically because they give you so much order flow. They show you the orders. Is that you're going to see all the orders out there. So I want you to pay attention really quick, because if you've never seen this before, you're going to realize you're going to be able to apply this towards any trading. Okay. Now listen, this is not the Fausto indicator. This is not the Fausto, Fibonacci or trading software. I'm just going to teach you how to have access to the floor of the exchange and look at any stock that you're in so you know who you're competing against. So let me start off and show you what we got going on here. This is called Nasdaq Book Viewer, which is also known as TotalView. Now, a lot of the brokerage firms do offer it. So make sure when we're done today, after you watch all your presentations, ask your brokerage firm, do I get TotalView? Now, I'll tell you in the next few moments where to get it, okay? I'm going to give it to you. I'm going to give you a free video in the next minute or two to kind of show you the value of it. But let me kind of explain to you really quick what we got. We're looking at Palantir, and we're seeing every buyer in the entire world that wants to buy Palantir and every seller out there that wants to sell Palantir. And you're seeing whoever wants to pay the most and who wants to pay the least. Who wants to sell it for the least and who wants to sell it for the most. So if you notice, this is like a big chat room, and including that you're going to be in it also. So you're seeing every order around the entire world that wants to buy and wants to sell the stock Palantir. You're going to see it on every stock that's out there. Now, let me clear this out and we go to the next one. So let me show you how we utilize this. We all talk about, it's funny when I asked everybody this question, how stocks go up and go down. Do you notice nobody said support and resistance levels? But apparently everyone's always looking for support and resistance levels. Well, let me explain something to you. You can't have support unless you got the buyers. You can't have resistance unless you have the sellers. So you have it pretty much backwards. And that's why majority of the people are trading backwards. So let me explain to you what that means. We're looking at the stock Palantir. And you could see that when it started this morning, it went all the way down and it decided to stop right here at this number of 151. And then it decided to go up. Now, you're probably thinking like, why did it pick 151? Why didn't 150? Why not 150? What is 151 so special? Why not 154? Why 151? Well, like you all said, how do stocks go up and go down? Buyers and sellers. So when we go over here, we look at the buy column. You'll notice, I know it's kind of difficult to see here, but there was a 300,000 share buyer at 151, and there were 120 orders around the entire world that equal the 300,000 shares. Now, you have to understand, that's not one person. That's 120 different people around the world. And is it a lot? Well, when you look at majority of the trades out there, 600, 5,000, 2,000, 800, 100, that's almost like 100 times more the average of any buyer, any order out there at any price. Now, like we just said, how do stocks go up and go down? I don't want to sound like a broken record, but I'm going to say it 1,000 times. I'll say it another 1,000 times. It goes up due to buyers and sellers. Now, remember, I'm going to ask everybody this question. It's a very important question. I know some of you can answer it because you have it. Do you know where the buyers are in the stock that you're in? Do you know where Goldman Sachs is buying? Do you know where BlackRock is buying? Do you know where the institutions are buying? Wouldn't you like to know where they're at, where they got their limit orders? Because you're just an ant on the floor. You're just trying to get the crumbs. These guys are moving blocks and blocks and blocks of stock, not millions, trillions. Of course you would, right, Lynn? Right, Mike? Right, Muhammad? I mean, you're saying it yourself. This is why trading is a 90% failure rate in the industry. Listen, if I told you, do you want to get into this business, but it's a 90% failure rate, would you do it? You're probably like, no. You probably have a better chance to do better in the restaurant business. I heard that's only an 80% failure rate. Why is it such a big failure rate? Well, you're all here. Why are you all here? Why are you in this business at a 90% failure rate? Because you know people make money doing it. And you probably have done your work and you're like, you know what? I'm definitely doing something wrong. Well, the start of doing things right is you need to know where your competition is. You need to know where they're buying and selling. Let me show you another one. A couple other ones here. Now, before I continue forward and go to the next example, did I lose anybody yet? Just give me a yes or no. Yes, you got lost. No, you're following along. You hear me? Good. Nope. Still in there, Barbara? Steven, you're following along? Good. Demetrius, everyone else? Brenda, I didn't hear from you. Don't let me start picking people, okay? Believe me, I'm watching the list. The more you interact, the more it makes my job fun. The more it makes me feel like I'm basically accomplishing something, okay? Because let me tell you something. I hate seeing people lose money. There is so much negativity in this world in trading. Everybody's going to go out there. Why would you do that? You're losing all your money. I just came back. I did a speaking in Orlando. I got another one I'm going to be doing in Florida, in Hollywood Beach next week. And I'll be in front of all these people. And sometimes, I get a heckler in there. I've been doing this for almost 30 years. Oh, everyone's going to lose all their money. And I feel bad. I asked the guy, I said, how did you lose your money? Oh, whatever. I'm like, and I said, who trained you? Oh, what does that matter? I don't know. I don't want someone to do brain surgery on me that never went to med school. I wouldn't go get my hair cut to somebody in their kitchen. Why are they working in a hair salon? Don't you have to pass a test? I mean, I'm just using stupid metaphors, but you wouldn't give your money to someone that never learned finance, right? You don't think Goldman Sachs could just hire anyone? Yeah, just call these people and take care of them. Whatever happens, happens. Listen, you got to do things right or don't do it at all. Let me tell you about resistance levels. Same example. Boeing. Stock has got a running up beautifully. Hits a resistance levels. How do we know it's resistance? Because it went down. How would we have known it was resistance? Because we looked at the sell side and we worked our way down. And if you notice, there was a 5-digit number here, which is that a lot? We just saw a 6-digit number. Well, I don't know. Look at all the sellers out there. 100, 100, 100, 100, 300, 400, 200. Oh, 88,000. I don't know. That sounds like a lot compared to everyone else out in the world that's putting orders. You see, there are orders at every single penny on a stock. You just got to know where they are. Think about how much smarter and better trading decisions you would have made if you just knew where the orders were. Anyone here own a house? Anybody bought or tried to buy a house? Ever get outbidded from somebody? Ever, sometimes don't you feel like, damn, I bought that house. I paid too much for it. I could have probably got it cheaper. Wouldn't it be nice if there was an order book to knowing what the sellers all want for the house and what the buyers want, so you know exactly where to put your bid in? How many of you went out there and bought a house and like, damn it, you know what? I would have never went out there and looked and spent all that time and money if I knew the guy wanted to sell it that much money. Why didn't you just tell me in the first place? Or how many people out there be like, my God, if I knew that house went that cheap, I would have bought it. I would have paid more. Well, guess what? You can in the stock market. Let's move on and let's look at a couple more examples. Okay. So let's talk about review some of the stocks that we traded this week, for example. So obviously we know everything that's going on in the stock market. You got the war that's going on right now. The market is down to almost 700 points right now. Oops, not looking good. But there are some stocks that benefit from it and stocks that got hurt. Like, let's talk about RCAT really quick. Okay. So on RCAT, you had the stock had a big run up, went up high, and then it backed off here, right? So you listen, you've been in some stocks. You went out there and you're like, my God, do I sell it here? I mean, like today, it's like, I know a lot of you have some swing trades and some of you have some profits. And like, do I sell it here? Listen, you got to have a game plan, right? Because you don't want to sell it at a support level. You don't want to sell it when you got a big buyer out there. Just because you know what's going on with certain stocks. RCAT did great. It's a drone company. You hear about the drone stocks, right? So it's like, wow, this thing had a big run up. And then all of a sudden, let's say you bought it too late, you paid too much, now backing off. You got to have a game plan. And when you see something like this, I'm like, okay, stock right now is trading at 1396. Do I sell it here? Well, let me just tell you, the next buyer is right around here, around 1280. So you got a choice. Do you sell it now, or do you hold it for another dollar loss? Now, another dollar loss on 1,000 shares. Anybody good with math? What's a dollar? What's a dollar times 1,000 shares? Anybody good with math? You should know this answer. Let me tell you, when I started this business, thank God we went to decimals, because I used to teach a math class on fractions. Some of you probably remember that. $1,000, right? So is it cheaper to take a loss now or wait until we get down there at 1280? Yeah. You know, $1,000 a day over the course of a year, it's $250,000 salary. That's how you lose money. Now, and the thing is this, you might like RCAT and it might go up and it could happen, right? Absolutely. It happens all the time. But why? You could just buy it cheaper. You could just buy it cheaper. I would rather sell the stock here, buy it at where that big buyer is at 1280, buy $1,000 cheaper, because guess what? I don't want to in the break-even business or deal with that stress, because that's what ends up happening. Now, can we find resistance levels? Absolutely. How many of you out there, you own a stock and like, man, I don't want to sell too cheap. This thing is going up. Another drone company out there, like, oh, finally making some good money. I'm up about, $1,500 on this trade. Well, the game is this. You better know where people looking to sell. There's always someone looking to take a profit. And it's just not you. It's these big brokerage firms. So when you look right here, I could say, okay, big seller right here at 1160, 100,000 shares. Is that a lot? Like I always say, I don't know. Look at all the other orders out there. If I had to go up a seller of 200 shares versus 100,000, I trust 100,000. I think you would too. All right. So what's your game plan? You probably want to get out right around that price. And sure enough, look what ended up happening. Hits that resistance levels, and it comes crashing down to 980. Now, I know everybody has been there and has done this. How many of you always convert a winner to a loser? How some of you feel like you sell your winners too soon and you hold your losers too long, right? Too often, right, Susan? Guilty as charged, David. Well, listen, hopefully today we're going to fix that problem. And then I'm going to invite all of you guys to come into the trading room so you can see this and learn this a little bit better, so you don't make this mistake. That's the big thing we're going to do. So we like to call these things iceberg orders. These are big block orders. So, and I came up with the word, I tell everybody, I did a video on it on YouTube. I came up with the word, watching the movie Titanic, the unsinkable ship. What happened? Got too close to an iceberg. An iceberg, it's not what's on top of the water, it's on the bottom of the water. And all of you are looking at the top. You don't realize you don't have the technology. Look at the bottom. If you knew what was out there, you probably wouldn't have, got too close, because it didn't work too well for the Titanic. Now, the next question I have for everybody is that I want to show you all is that stocks break support levels all the time. You know that, right? Now, how is that possible? Well, let's look at this example right here. Let's look at Tesla. So Tesla has a big buyer at 415, right? Huge buyer. Now, in theory, what you just learned, that's got to be a very big support levels. Look at all the buyers out there, 200, 300, 1,000, 300,000 is a pretty big buyer. And I am with you all, big support levels. Absolutely. Now, looking at the chart over the course of several days, every time it hit 415, it went back up. When it hit 415, it went back up. When it hit 415, it went back up. Hit 415, went back up. So this is a major support level. Not only do we see it on the chart, but we see the order out there. Now, this is where trading comes in. Is it possible for that order to get filled? Yes or no? So that's a question. David says yes. Sue says yes. Barb's got a question mark. Listen, shit could happen. Somebody could sell it to him, right? Well, look what happened. When it hit it 1, 2, 3, 4, the fifth time, when it finally got there, guess what? That order got executed. Someone decided, like, you know what? I want out. And they sold it to them. And guess what? That stock went from 415 all the way down to 390. Now, you've all been there and you've all done it. And you've all probably been guilty as charged, like you all said it. You all seen support levels and you're sitting there in your mind like, I don't understand. Everything was right. Everything aligned. Every indicator, every news, they beat earnings. How, now Fausto's teaching me, buys and sells. How does that happen? It could happen. It happens all the time. Support levels get broken. And one of the things we're going to show you is that when you come to my trading room, you're going to have one beautiful week of being in there, and we're going to show you how this happens. And if you're not prepared for it, you better get ready, because it didn't work out too well for the person who held on to that stock. Now, this is what I'm going to do. Who here would like to play around and have a seat on the Nasdaq exchange? Anybody here want a seat on the exchange? Because you couldn't get it a long time ago. Now you can get it. So this is what we're going to do. I want you all to bring up, by the way, a bunch of you guys sent me emails for the book. That's awesome. All right. So what I want you to do is this. I want you to bring up your inbox again and type in Fausto at C2 Trading. And I want you to write what I wrote here at the bottom. Okay. And this subject line, write Nasdaq. Okay. And then, give me your first and last name so I know who you are, as always. And if you want us to give you a phone call, if you want to talk to us about it, my staff is happy to. Give us a phone number if you want to leave it. If you want to, don't worry about it. All right. Do that now. And what I'm going to do is I'm going to send you 2 videos, very important videos. They're about 5 minutes long. I'm going to show you where to get it and how to set it up and how to utilize it. Okay. Like I said, I don't have time to do it right now. We're running out of time. I want to get you guys registered for the trading room, but this is a very good tool to have when you come to the trading room, because then you can align it, what you're doing, and see what we're trading, and you can get ready and prepared for it. So just hit send. And, all right, looks like everyone's in there. That's me, Robert, Steven, Wayne. Just got you guys registering right now, coming across. Perfect. All right, so let's do that and get that out of the way. Perfect. Okay, everyone's got it. Good. Frizz got yours. You see everybody registering. Oscar got yours. Remember, guys, there's over 200 people in here. The worst thing that could happen is that you learn something. The worst thing that could happen is that you're going to realize and finally know why you lost money on a trade. Okay. So go out there, email me, and write Nasdaq on a subject line. So I know exactly, because I get, I don't know, maybe a couple of hundred emails a day. So I know how to weed out who's who. Okay. Now we got that out of the way. I want to go over one last thing with you. Okay. I'm calling my broker to get this trading system. Fraz, listen, don't waste your time. Go to the exchange. Okay. Let me give you this one. And then this is where you're going to really get a little pissed off. Then you're going to ask your brokerage firm. And if they do have it, you'll be able to compare the quotes. Let me tell you, let me explain something to you. Do you have any idea why brokerage firms give you free tickets? Does anyone have an idea? Why are they so generous? Why are they so nice? Why do they like you so much? You're like, you know what? Fritz, I'm going to give you free tickets because you look like a nice person. Exactly, Susan. That's one of the things. They get paid for order flow. They trade against you. They don't want to show you what's really out there in the market. Okay. Listen, I don't work for the brokerage firms. Okay. We're brokerage firm neutral. I work for you guys. And listen, everyone has to eat. But nobody works for free. There's no such thing as free lunches. Apparently, people think there are, but listen, if you're looking for a free lunch, get out of this business. I'm warning you right now. You will lose a 1,000 times worse than you can make. Let me go talk about Nasdaq TotalView really quick, level 4, and we're going to go from there. So remember, I brought up the heat map on you. I want to bring up this one. So basically, you're going to see this in our trading room. Okay. And I'll tell you where to get it when you join the trading room. But this one is the same thing, but not only are you seeing the orders, but you're seeing it on a heat map. So for some of us, you might say, it's a lot of numbers, a little discouraging, whatever. But what's nice about this is that now you're seeing it on a heat map, and you can kind of see a little bit more where the orders are a little bit better. Like here's Palantir. We were just talking about it. And what's nice about it is you could see if the person added to the order, maybe he had less at this time. You could see added more. The color got redder. You could see when the person showed up. If he's still there, you can see how the stock Palantir went all the way up, hit the resistance at 156, came back down. And by the way, everybody knows they're out there, but you. We all know. Every brokerage firm, every institution, every algorithm, we all know they're out there. And you can see here, when we saw that order right around there, now you can see how we got to 153. And now we're going to go probably get close to this number. So you have a little bit of a game plan. Okay. All right. But I'm not going to take time on this one because we're running out of time. And I got another presenter come in. In the meantime, I want to get you guys all ready to sign up to join the trading floor. Okay. Because we do practice what we preach. And that's why we're one of the most popular educational schools in the industry, because seeing is definitely believing. Now, what I want to do is I want to post this up really quick. Now, do any of you guys follow me on social media? I know we got people that are watching on YouTube right now, YouTube Live, but we broadcast. I always give you, nice big tips, best trading strategy, follow the big orders. I constantly give you some nice little tips. I like to do a lot of shorts more than longs. I like to work with maybe, 2-3 minute videos, not to lose the attention span. If you really want to learn and be in watch for an hour, you should be here asking questions. You should be in my trading room, but feel free to register for them. You follow everywhere you teach Fausto, Genevieve. Thank you very much. YouTube and X, Bill. Okay, good. And by the way, make sure you like us and friend us and share it. Very, very important. All right. Now, we did post that link up there for everybody, right? I don't know who's here in my trading room for my staff. Just let's get that up there. So if anybody here wants to register, they could do that. Fausto, I sent you an email yesterday and I got an invite for a free live on March 19th. Someone mentioned to see free videos. that on YouTube. Yeah. So Raj, I'm gonna do it. I do another one every week. All right. But but most importantly, let's get you registered for coming to the trading floor. There's the link if everybody wants to click on it. The trial is going to come up right now. I'm going to talk about that now, but right there, those are all the YouTube channels, Instagram, TikTok, X, whatever you're a fan of, they're right there. All right. We're actually even on Telegram too. So this is the deal. You want to learn how to trade. You got to stop being the guy on the left, and you got to be with traders on the right. The way I've learned is that I was a huge failure. I blew up, I don't know, 2 accounts when I got started. And I have a good excuse. I was 22 years old. Okay. Yeah. I thought nothing could happen, but everyone here is a little bit older. And the thing is, the only way you learn is not by just being with people that are successful, but you also learn mistakes that they make, so you don't make those mistakes on your own. It's better to know from someone else to make it before you could make it. But you all know you're trading by yourself. You're trading on with these, on one laptop computer. And listen, just do it right. Just do it right. It's cheaper. It's safer. And you know what? I hate to say it, it might not be for you. And that is okay. But the only way you're going to know if you surround yourself with good traders. And that's why Cyber Trade University, we work with some of the biggest brokerage firms in the industry. We actually just signed on Mumu. I don't know if I'm very familiar with them, but they're another huge brokerage firms that are stepping in the market. We just did a great deal with them up in Toronto, and we're negotiating a deal right now that we're looking to train all their clients here at Cyber Trade University. You've seen Tom Sosnoff yesterday. We train all their clients. There's a reason for it, because if you do well, they do well. Now, this is what we're going to be doing for everybody. My goal today is, I want to invite you all into the trading room. I want you to see and practice what we preach. And what we're offering you is this. We're going to give you a live trading room. We run from 7:30 in the morning to 5 o'clock in the afternoon. We do live audio commentary. We'd have over 100+ hours of workshops. I'm going to give you this all in our trading room. We're going to give you real-time alerts. And most importantly, we're going to talk to you on the phone. Okay. We're not some of these people that hide behind emails and text messages. I don't know if everybody's noticing AI starting to talk to you. You don't even know if it's a real person anymore. We're very big when it comes to customer service, because we want you to make sure you're making the right decision. You know what? The money is one thing. Your time, I think, is a little bit more valuable. How many of you here are in between jobs? How many of you here are retired? How many of you here are just like, you're looking for a new career, sick and tired of dealing with employees, insurance, getting sued, taxes. This is a great job. This is a phenomenal job, but you got to know how to play the game. So myself and all my instructors are here for you. We're here to train you. We want to teach you if this is for you. And we're going to give you all this great stuff. And all you need to do is this. Take your phone. You could scan that QR code, right? Or you can go to this link that we're going to post up there, and you're going to meet all our traders on the floor. And the goal is, don't judge us on our winners, judge us on our losers. Okay. And you'll see why. And then you might be one of these also, why we have a 5-star rating on Google after doing this for 35 years. You're going to get all this great stuff, a $2,000 investment for $9. Now, why are we charging $9, not $900, $9,000? Is because, you know what? It just tells me if you're a real person or not. And we're not going to put you on a residual or any payment plans or anything like that. The $9 is just more of an application fee to kind of to let us know a little bit about you. And if you're ready to, to see if you're going to take it seriously. Now, I know some of you said that you did sign up yesterday and you haven't received the link to enter the room yet. You will. Susan, you should be receiving it. If you didn't receive anything yet, Susan, please email me at Fausto@CTU Trading. But what we like to do, Susan, is you like to make an appointment with the, you got to talk to what you need. We want you all to talk to our education advisors. And the reason for that is we want you to, it's like going to the gym. You sign up for a membership. I'm like, okay, what do I do? You have no idea what weights. You see all these great looking people with good looking bodies. And here you are like, we don't want you to get discouraged. Okay. Michael, you made your appointment through? Okay, great. Good. So that's the most important part. We want you to give you a good experience. We want to let you know, but it all starts with a $9 fee. Okay. And by the way, fellow traders, if you can't afford $9, you really can't afford to trade. I don't need the $9. Okay. That $9 just tells me that you're a real person or not. All right. So there's the link. Scan your QR code. We got Price Headley that's going to be coming on next. So, I want to give you guys about 5-10 minutes to get registered. In the meantime, there's no annual renew fee. One person asked me, do I need a brokerage account? No, you do not need a brokerage account. We don't want you to buy and sell anything. We just want you to watch. Okay. That's all we want you to do. We want you to see the traders, how they think for themselves. There's a saying in the Bible, feed a man a fish, you feed him for a day. Teach a man to fish, you feed him for life. Okay. You don't want AI to do the work for you. You want AI to teach you how to do the work for you. That's how you learn. We can't tell you what to buy and sell. We could only teach you how to buy and sell. And that's what most people want. I know everybody likes everyone to tell them, could you tell me where to get in, where to get out? Great. You know what? That's not us. Other people do that. But if you want to learn how to do it on your own, that's what you got to do. Oscar, you registered yesterday. I saw you, Oscar. I don't know if you got my email. I emailed you back. Okay. I think you emailed me a couple of things, but you should be receiving your, you should be hearing from someone today. We don't want to bother anyone today and tomorrow because we know you're in the cyber group, in the Cyber Expo. So that's one of the reasons why we don't want to get you we don't want to interrupt you. We want you to enjoy all these speakers, all these presenters, and all that good stuff. Tefron, how much does it cost after 1 week? If I join, I need to prepare myself for future weeks. Tefron, let me explain something to you. If it was $90 or $9,000, if I could teach you how to make 6 figures, does it matter? Don't worry about next week. Let's worry about the $9 first. Okay. Don't worry about being prepared or anyway. That's the least of your problems. Okay. That's the least. Don't get discouraged. That's like saying to me, wow, I could drive my own car. I was doing public transportation. It cost me $2.50. What does it cost to drive my own car now? Let me tell you, it's not cheap. And we all know if you find out what a car costs, you probably, if you knew from the beginning, you probably would have spent the money to buy the car, did the trial. But you know what? You all know, you can't tell a pregnant woman, say, hey, honey, I'm a little cheap right now. I don't want to buy the car. So we got to wait for the bus to get, that's going to show up tomorrow morning. It's not going to work too well with the pregnant woman, if you know what I mean. Don't worry about next week. Worry about today. Oh, and one bonus I'm going to throw in there for all of you. One big bonus. If you register right now, okay, I will personally give you a coaching class. So you know what? If you're in the trading room and I see you in the trading room, after about 2-3 days, after you get a little fun, a little experience, you're going to have a lot of good questions to ask. We're going to make that appointment and we're going to talk together. And I want to answer your questions more in great detail because my goal is I'm looking to hire traders I could trade with. And if you realize this is for you, we'll have that conversation. All right, guys, I have to go. Take the phone, scan that QR code. If you did not email me yet regarding the book or anything, once again, just bring up your email and I'll be happy to send it to you. Remember Fausto and just write whatever it is, Nasdaq, whatever it may be, and hit send. I'll send you the Nasdaq book too. All right, we'll get that done. But it looks like a bunch of you. Lynn, I got yours. Phil, Rico, there's my email just came in. Got yours. All these people registered. Patel, I got yours too. A couple of shout outs really quick. Just wanted to thank Eric. Lynn, Owens, I got yours. Susan, I know you signed up yesterday. I saw that already. Michael, thanks for the info. I joined yesterday. Okay, Michael, I got your registration. No problem. Who else we got here? David, just got you from College Station, Texas. So you did so David, you live right next to Texas A&M. Funny story about Texas A&M. So one of the head coaches, I don't want to mention his name, okay, but was a good friend of mine. He's one of my students in the room, okay? So I remember he invited me to, he was so happy that, finally had someone to teach him how to trade. He invited me on the floor. I'll send you a picture of it, but I'll never forget. I was running on the field, like the MasterCard, priceless. You ever see those commercials? And I was invited to go see Texas A&M, and that was one hell of an experience. That was just amazing. David says, I already know who it is. All right. All right. A couple of more shout outs right here for everybody. Raj, I think that's you right now. I see you just got registration from San Diego, California. Good morning. I know it's pretty early where you are. Who else we got here? David from Texas, another Texas person. Lumbrook got yours. And Barbara from another country. I don't know where that is. I can't read it. It usually doesn't really show me. All right. All right, traders. Now, listen, don't forget, I got to go. Price is ready to take over. We're going to bring them in here in another minute. All right. So get registered. Do what you got to do. Enjoy the rest of the presentation. I'm going to be here all day doing the intro of all these people. So don't go anywhere. We'll be right back. All right, traders, let's get back. Welcome again, once again, for the Cyber Trading Expo. And I want to bring in our next speaker, which is someone I'm really excited to hear about. This is somebody I've known for as long as I've been in this business in trading. Probably he's got over 30 years of experience, and he's very, very well known. Has a number one bestseller when it comes to the into the trading market with his book and everything else. But he's a lot of traders love him. We have him here several times at Cyber Trade University, and we're just really happy to have him here again as always. So I want to introduce you for some of you if you never heard him or seen him before. Price Headley. He has, like I said, he's a founder and CEO of Big Trends, and he's been a national star. He's been on every financial institution, TV. He's been on CNBC, Fox News, CNN, Bloomberg. You said it, you name it. He's had articles written up in Barron's, Forbes, Wall Street Journal. Just has a track record that you probably never seen. And that's why we love having him. And his style of trading, I've heard from people that they've done very, very well, including myself. And I think it's something you all are going to walk away with. So without taking too much time, and he'll, once again, he's going to share you a little bit about, price action patterns, moving averages, all that good stuff. He's going to show you how we trade the Tesla options, which you can see there on his PowerPoint right there. He's going to go over that. And we're a big fan of trading that style. So let's bring it and give him a nice warm welcome and pass it over to him. So Bryce, they see you.
Thank you, Fausto. Great to be with you. Am I coming in loud and clear, I hope?
You're coming in loud and clear. Go ahead.
Perfect. Thank you so much, Fausto, for that kind introduction. And it's always great to be with you all as a part of these cyber trading expos. It's really all about, soaking up a lot of information from a lot of fellow traders about what has worked. And that's what I know. I've been in this game about as long as Fausto. I mean, for me, it's like 37 years and counting. And it's about like, how do you stay in the game for the long haul? It's about finding an edge and then executing that edge consistently, right? So the idea is that you don't want to be jumping around between a lot of different strategies. Sure, you can soak up a ton of content on this awesome expo speakers and traders here, but you got to eventually focus on what are you going to implement. And one of the things we found has been one of the most popular things with our big trends community has been to start to focus on single tickers. There's this feeling that a lot of people have. They've got to jump around and try to scan through hundreds, if not thousands of different securities to try to find the one that's moving. But yet, what you see the institutions doing is going back again and again to the most active, the most liquid, the ones they can get in and out of easily. And Tesla, of course, is one of those, right? Tesla TSLA is one we love to trade. Of course, it just came out. I don't know if you saw the news the other day that the Forbes billionaires list just came out. Billionaires' wealth and their Forbes top rankings rose by so many trillion dollars. It's just amazing. But the amazing thing about all of it is that Elon Musk, being the richest person on Earth, they show him at $839 billion. Okay. If you put it in perspective, it said he's richer than the poorest 693 billionaires on the planet combined. He's $54 billion richer than Jeff Bezos, Mark Zuckerberg, Larry Ellison, and Warren Buffett combined. Okay? Get chills when I say that. I mean, you talk about for me, and that makes Elon Musk and Tesla to a degree kind of basically polarizing. Of you've got their love them fans, you've got the hate him folks who got down on Elon from his time with President Trump in and back out of Washington D.C. with the whole Doge thing. But the point is, he's a winner in terms of the stock market, in terms of building wealth. And you want to be in a follow the winner strategy pretty much with whatever you do in the stock market. At least that's been my experience, right? I don't buy dogs and hope that they're gonna turn around. As I say, if you lie down with the dogs, you're going to get up with the fleas, right? You can't afford that in your portfolio, and it messes with your mindset when you're in that hope mode. I'd rather focus on the leaders. Tesla's a leader. Okay, so we're going to talk more about Tesla, but we're going to talk price action patterns, moving averages. Just wanted to give you that overview about why I think you should be including Tesla in there to get a piece of the wealth building that Elon Musk has been a part of. Of course, he's going to have the SpaceX IPO coming out later this year in all likelihood too. So that's going to be another big thing to watch. But remember, as we get started, the information I share with you in today's presentation is based on our proprietary research. It's intended for illustrative purposes only. What we talk about here should not be considered specific advisory recommendations. Of course, you know that stock and options trading have large central rewards. Let's face it, they've also got large central risk. What I'm going to show you today shows you when to get in, when to get out, win, lose, or draw. There's going to be winners, there's going to be losers. Your approach has to be to consistently execute the system, and that's what I always try to set up for new subscribers coming in as a way to try it out. And I've got a special trial for you to try it out for a reasonable amount of time and give it a chance to show you what the system can do for you as well on our Tesla Options Trader approach. Now, remember, the past performance of any trading system or method is not necessarily indicative of future results. So see our terms of use on our bigtrends.com homepage for more information. So like I said, single tickers has been, I can take a breath. I can actually relax a little bit and say, I can just zero in on one single ticker, TSLA. Okay. Oh, by the way, TSLA, one of the most popular options tickers out there. Trades, some even just some single strikes will trade 50,000 to sometimes 100,000 contracts in a day, especially as you get into the shorter term options. And that's what we're talking about here today. Weekly options. We're not talking about 0 days to expiration. You hear zero DTE thrown around a lot. I like more runway than that. So I'll share with you when I get in, when I get out over an option that's got anywhere from a few days to about a week to go before expiration. Okay. But the other interesting thing is that we're only going to hold this trade for a maximum of 24 hours without ever having a day trade. Watch how we do that. I'll show you a bunch of success stories when it works. I'll also show you when it doesn't work, what do you do? How you can just focus on Tesla only and get real-time email alerts and text alerts to your smartphone when you get into our special trial at the end here on our Tesla Options Trader service. Okay. If you don't know me, I've been trading options for coming up actually on 37 years officially. About a month from now, middle of April of 1990, I got started trading right after I'd graduated from Duke the prior year, and that's when I got interested in the stock market when I was a student at Duke. But really just got hungry to learn more and more about options because I saw how options give you maximum customization, right? You can customize any view you've got on the stock, short term, intermediate, long term, up, down, or sideways. And you can also constantly adjust with a variety of other option strategies layered in. So I launched BigTrends.com after growing my portfolio in the 90s. Launched Big Trends in November of 1999. And it's always been about a systematic approach, right? So our view is follow the system, follow the method. Don't, no matter having, 37 years of experience, I still have to follow the system, right? We cannot, me and my team of analysts, we're always focused on, okay, where do we have an edge? Then you've got to execute that edge. So when you come into this system or any system from Big Trends, I say, don't think about how much money you can make on your first trade or how much money you could lose on the first trade. Think about starting small and proving to yourself that you can consistently execute a series of trades over time to build a habit of execution. If you become consistent at executing, not picking and choosing, not loading up on one, passing on another, keep executing when the system says to get in, you get in. When it says to get out, you get out. You let the winners and losers stack up over time, and you see that you can do this. I believe that'll make you a more confident trader over time in addition to a more consistent one. Let's get into a winning trade example, and then we'll talk about more about how the Tesla option strategy works. Okay, so here's one back from mid-December where we've got a first view of this chart with which is daily candles. Of course, the white bodies is where we close above where we open. The red ones are where we close below where we open on a given daily candle here. But right away, when I see this chart, you see that light blue moving average. That's called a simple moving average. We give all of our settings to paid subscribers, but I'm giving you principles here. That stock being above that moving average, first filter is don't ever consider a bearish trade above the moving average. Okay. Only look for the right setup with the right kind of price action bar finish near the end of the day. And that's when we like to get into these trades in the last half hour or so of the trading day, around 3:30 or so Eastern time, Wall Street time. Why do we wait for the end of the day? A lot of people are acting right off the open. I believe if you act off the open, you're going to get faked out a lot. It's been my experience. Sure, sometimes you'll catch a runner, but we like to say, you know what? We want to avoid the fake outs. We don't want to participate in amateur hour and get flushed out right off of an open. Okay. So bottom line is that we wait for the end of the day. We get in at 3:30. The earliest we would get out, because we're targeting a double on all these trades, the next trading day, the earliest we get out is the next morning. So you see the stock gapped up. We got in on this case on the 12th of December. We didn't write down the dates there, but 12th of December was a Friday. Okay, so that's where we entered here, 12/12. And you can see we entered there right near the close. So this is where we're getting in. We're not early here. Okay. That's okay. You don't have to be early if you're using options and the leverage of options, right? Because of course, look at the leverage here. We're buying just under 460. Remember, 460, you would pay $46,000 to control 100 shares of stock. We're buying the near the money 460 calls, and we're paying 880. That means $880 to control 100 shares. So less than $1,000 controls $46,000 worth of stock, give or take, right? So we're at about the 50 to 1 leverage ratio theoretically here. And we're looking for doubles. Remember, when the stock pops to the upside, that's when we can score our leverage gain here. If it had popped to the downside, we're going to also, while we're looking for 100% gains, we're also going to put in a 50% price stop. That's not inconsequential. A lot of people say that's too loose, but the reality is when we're targeting doubles, half of the maximum reward is where we want to keep our risk here. So, if I was only targeting 50% gain, sure, I'd probably cut my stop down. But the problem is that would noise me out of a lot of trades, right? We want to be able to stick with the bigger trend, the bigger move, not get flushed out or faked out. So the idea here is that, okay, we're using the example here that say you allocate up to and no more than $1,000 into any one trade. In every trade, you never commit more than $1,000. We call it out and we say get in at an average of 880. That means you can only get one contract. That's okay. You're still controlling $46,000 or so worth of stock in for just $880. Guess what your target is? Whenever you get your confirmation from your broker, you got filled at 880, you should go put your target in at double that and your stop in at half that, right? So our double target was 17.60. Our stop was down at 440. Okay, so and you can actually have both of those orders working with most options brokerage firms, right? This is not brokerage firm dependent. You can use any options broker you want, and you should be able to place that as what's called an OCO, or one cancels the other order, meaning that when one side fills, the other side cancels. So you don't have to mess with it any further once the either side fills up or down. Bottom line is that you can learn more about that from my team later when you get signed up for the trial. But the idea is that that's a great way to place your order on both sides. You're covered whether it goes up or whether it goes against you. Guess what happens if neither one of those happens? We close it out the next afternoon at 3:30. So we're not holding it more than 24 hours in trading terms. Right. So you look at that and you say, okay, and by the way, where do we get out there? We got out, see the stock ran as high as about 480, maybe even 481 there. You say, well, hold on, that means it got up to $21 intrinsically. Sure. We're not going to always call the top here. We're not going to get out at the perfect spot. We're happy with a double in 24 hours or less, right? You cannot be greedy in this game. You've just got to have a recipe that guides you through when to get in, when to get out, and so the time stop is the other piece. If we don't get either, we get out. In this case, we got our double and said, thanks very much. As it turned out, why did it gap up so much on that Monday morning? We got in on that Friday afternoon. We're willing to hold it over the weekend? Sure. I mean, we're following the system here. System said we had a nice positive finish to go with the higher gap up opening. And so that told us institutions were continuing to buy this thing throughout the day on the 12th. We want to get into that. Guess what happened over the weekend? That weekend in Austin, Texas, where they're running their self driving car tests, that Teslas are spotted without a safety assist driver, an actual human in the car. They were driving themselves. So it made people think, wow, they're a lot further along than what was expected. And so that's what led to the optimism on that Monday morning throughout that Monday rally. So it took the money off the table and ran. We're going to show you a bunch more examples, but idea is that, look, we don't want to hold it more than a trading day. So this is going to impact, okay, what type of options are we going to buy? We're going to buy weekly options that expire either this Friday if we're early in the week, or next Friday. If we're buying today or tomorrow on a Thursday or Friday, we would go ahead and say by the next Friday's expiration. Give yourself enough time, but not too much time. Okay? Because you're not going to hold it more than one full trading day. So we've got three different price action patterns we look at, tied to gaps, tied to the daily chart, tied to the moving average filter. We run those things through, and at the end of the day is where we will call out the trades. At 3:30 is where we call out a new trade if we have one. We're not going to trade every day, right? So the goal here is pick your opportunities when you have an edge. If you don't have an edge, don't trade. Okay. That's again, and I think Foster would speak to this as well. Part of trading is knowing when to trade, but also when not to trade. Okay. So really getting your focus on the best opportunities, not messing up not just your financial capital, and trying to overtrade, but also your mindset, right? You got to keep your mindset protected from the noise of trading, from getting chopped up too much, from then wanting to give up if you're just amid a lot of chop and a lot of churn. We don't want that. So like I said, same week or next week depends on where we are. Monday, Tuesday, Wednesday afternoons, we would get in the same Friday expiration because we know we'd be out by no later than Thursday on a Wednesday trade. So the idea here is that we don't want to hold anything into the last day of the option's life. Why? Don't you get more leverage there? Sure, but you get more risk too. You get both price risk and volatility increasing, but you also get time risk even more accelerating in that final day of that option's life. We don't want to take that. So daily chart, why not use intraday charts? Because I find I'm always as my website bigtrends.com's name implies, I'm looking for the bigger trend, the bigger fish. I throw the small fish back. I'm not interested in those smaller moves. So we're not scalping here. We're looking for something meaningful, a double in a day, basically. And so one trading day later, after we get in that prior afternoon. So we're gonna only have an entry signal once per day if we get one. And the idea here is that 3:30 is the entry point. What this does, it saves you a ton of time. You do not have to screen watch. Like I said, when you place those target and stop orders at the same time, OCO orders they're called, one cancels other, you don't have to screen watch there either. You just know that, okay, if you don't get either one of those filled come 3:30 the next trading day, you know that we'll have an exit in your email box, and you can get it on your smartphone as well as a text alert. So the idea here is that saves you time. Guess what? It saves us a lot of time too. So we don't have to scan for this all day, every day. We're just running our scans right here before 3:30 saying, does it look like we're going to get a validated signal? And if we do, great, we're ready to fire one out at 3:30. If we don't, then no trade, no update, wait for the next trading day. This gives you and us a big time savings. It also eliminates a lot of noise, and you're still leveraging the power of weekly options rather than buying a month or 3 months or a year out. So the idea here is that that's going to give us plenty of trade frequency. We'd expect probably, I'd say 7 or 8 trades a month. And so it's about 2 trades a week on Tesla out of the 5 trading days a week. So just under half of the trading days we'd expect to trade. That's okay. It's all about the right kind of risk reward relationship. What I love about weekly options, it gives you a ton of bang for your buck. I can remember lobbying the exchanges back when the 90s, that they were just doing monthly options. Then in the 2000s, we finally started to see weekly options come on board, and I was even say, hey, you might even consider daily options. They're like, are you crazy? Well, now you're having daily options on some of the indexes. So, even some stocks like Nvidia have like 3 days a week options, Monday, Wednesday, Friday. So it's going to be really interesting to see how these choices that you have potentially keep expanding. And that's a good thing for the off the floor trader. Our average contract entry price going back to the beginning of 2023 is $5.90. That means 590 bucks on average to control 100 shares of Tesla stock. We're always going to get out the next trading day at 3:30 if we haven't already gotten our target or our stop. What you don't want to get stuck in is you don't want a slow moving trade. More importantly, you don't want to slide into hope mode. The slope of hope has killed a lot of traders, right? Especially options traders, right? Because remember, we are buying a time limited instrument, right? So the idea is that we only want to utilize that time limitation when the power of the trend move is likely to well overcome the time loss. Right? It's not always going to happen, right? Sometimes we're still going to stop out because it just didn't fire. And so we're going to have winners, we're going to have losers. But when we stack up all of the trades that we've called out, going back to the beginning of 2023, and when I look backwards like this is through today on all closed trades, I want to remind you that past performance can never guarantee future results. We all know that future results are going to vary. But the idea is that since we're just focusing on this one stock, Tesla, I tend to believe that stocks are a lot like people. They tend to have personalities that if you can find some patterns in them, you're likely to see those patterns repeat on a generalized basis. But again, you can't guarantee any one trade. We're playing through the edge of looking for the winners to exceed the losers in their size of the gain compared to the size of the loss. It's really our biggest advantage here, and the trend advantage that we're looking for as a Tesla options trader. So you see this example we show, if you start with 25 grand, you can start with less. The key is that we're assuming that you use a fixed dollar amount per trade. Even as the portfolio grows, we are not compounding our amount invested per trade. People that compound their money into the trade as their portfolio goes up can make money faster, but guess what they can also do? They can lose it faster, right? So invariably, if you're compounding your gains on the way up, that means that you'll have your most money invested per trade right in front of your next drawdown, right in front of a give back, right? Because you're trying to pour it on when you say the system's hot, and then you get thumped when the drawdown comes out of nowhere, right? It can happen. And so a big part of it is to assume that better to be steady with your capital allocation on a fixed dollar basis, in my opinion, in this case. So, okay, sure, we're not getting as much invested per trade as a percent of our portfolio when the portfolio is up at 120,000. By the way, these examples showing a $95,000 gross profit or 380% gross return are gross before commissions and before subscription investment. As you know, commissions have come down to $1 a contract on each side, so $2 a contract round trip on a commission to get into one contract of Tesla options. And then of course our subscription rates are some of the best in the industry relative to how much you get from us. You keep the vast majority of your money working for you. So bottom line is that, the idea here is that, okay, whether you're trading with a $5,000 account, trying to take it on up a multifold, or 25,000 going to 120, your goal is consistent growth, but also managing risk always, right? So the dollars, uh, when they stay fixed as your portfolio grows, your percentage of risk in each trade actually drops as your portfolio grows with a fixed dollar investment maximum. So that's one of the reasons I like that approach. But we're just using a smaller $1,000 sort of starter kind of an approach to Tesla. So that's what I would like you to have getting started, because sometimes we can have an option up to $10, never more than $10 or $1,000 for one contract, controlling 100 shares of Tesla stock. Three different price action patterns tied to gaps and candle patterns, candle momentum. Two of these three are bullish, and then one of them is bearish. We'll show you those today. But bottom line is that if we don't get one of those three patterns setting up, then we just don't trade. We just say, okay, pass on a given afternoon, wait for the next afternoon to consider a new trade setup. Again, like I said, I can't give away all the settings here with this overview presentation, but I can share the concepts with you. New subscribers and all existing subscribers get access to my full rules sheet, and so you learn the system as you seek to earn from it. So, like I said, the first filter is the simple moving average filter. The goal of that is just to get ourselves in line with the bigger trend that Tesla's making, sometimes up, sometimes down, and not fighting that, right? So it's what I always say is that when you're using like a bigger filter, like a simple moving average, and then we're using day-to-day price action, that's like two different time frames, like two different rivers of time flowing together. And when I get them flowing in the same direction, that's going to lead to a doubly powerful river as they intersect and meet up. If we get them flowing against each other, that's going to lead to a lot of chop and churn and a lot of basically going nowhere typically, so that we don't want as an options buyer. So the goal here is that, okay, we're going to look at these patterns. Bearish trades do require a little more confirmation for us. We'll show you some more examples here from different market environments. And let's go back to another one here back, in this case, on September 30th. Now, this pattern is a little different than the last one I showed you, because last one gapped up and then kept finishing up near the end of the day. This pattern's a little different in that Tesla opens lower. This is September 30th. You can see we're above the moving average here, so we can only consider call trades, right? So, oh, by the way, look at back at the end of those days when we had red candles. If you'd bought puts there, all three of those, you'd be pretty much hating it. You'd be not happy. Maybe that fourth one there, maybe you get off to a good start. If you don't cash out early, by the end of the day, you're back to negative, right? So that's another just visual representation of why you don't try to bet against the broader trend. Okay. Align yourself with it. Don't fight it. Okay. Simple, but effective rationale here. Notice that during that early going, as we opened lower and kept trading lower, we ended up trading kind of intraday well below that prior day's low. And I put an F on that to say those trades that happen under that low are basically a lot of traders, especially newer traders, will tend to put their stops under the prior bar's low, in this case, the prior day's low. And they'll get stopped out there, and then when the stock reverses back up, those traders have just been flushed. They've been faked out. And you don't want to be one of those that gets faked out. You want to be able to stay with the trend. That's why we're not acting earlier in the trading day. We're waiting to see, does this thing hold? Obviously, if it finished down below the prior day's low, that's going to be showing quite a bit of weakness. We're not going to be trying to buy a bunch of weakness. But here, look what happens. It closes right near the highs of the day. It's up here to like 442, 443. We're buying about 10 points out of the money, about 2.5% out of the money. We're buying a 452.5 call. Now, that was on September 30th. That was a Tuesday. So we were buying that same Friday expiration. So when we bought on that Tuesday afternoon, we've got 3 more trading days to go before these things expire. Based on the rules I've just laid out for you, we're not going to hold it past the end of the day, Wednesday, October 1st, the next trading day. But the key is, remember why I told you want to have enough wiggle room on your stop? Look what happens. That next morning, we actually open a hair down, and then we trade about 1% lower. We trade down to about 439, and from 443 down about 1%. You could easily see that you could be down 20, 30, sometimes even 40%. I don't want people getting faked out there by putting too tight of a stop. And then look what happens by the end of the day. It's rips back to the upside. We're gone up above 460 here. And you can see we paid $755 on one contract. Couldn't get two if you're putting $1,000 in. So just with one contract in and then the one contract back out at 1510, how are we able to get out 1510 when it looks like it's only maybe about 7.5 or 8 points in the money? You still got time value with 2 more days to go, right? So Tesla options will hold a lot of time premium, and we want to try to hop in, hop out, and sell that time premium when we can double it, which we did there. 1510 was our exit, $755 minus your $2 round trip commission on a one lot. So the idea of this is that, okay, don't let yourself get faked out. Give yourself enough wiggle room. Sure, if we hit a 50% loss, then we're going to say bye bye. We are going to get stopped at 50% losses. Every once in a while, we can get faked out there too. It could reverse back, but we feel like that's enough of an uncle point, especially relative to our double target, to be appropriate. Now, this is a really interesting blast off that Tesla had back in about the second week to middle of September. And this is a trade. We had called out one on the 11th that we got out of on the 12th for a nice gainer of a double. And then here we go again, back in on that Friday afternoon, September 12th. We said, look, this is checking all the boxes. And most people would look at that big blast off of those two big up candles and say, you're telling me to get in after this huge move up here, and you're going, you've missed it. I literally will get emails like that saying, you're way late. And I'm saying, we're just following the system. The system says there's still more meat on the bone. There's more upside. And so we called out to get in when the stock's about 395 here. We're getting in near the end of the day there, near the high of that second big bar up at the close, right near the highs. That checks all the boxes for us. That basically, okay, this is powerful momentum. We want to take advantage of it. We buy about 10 points out of the money, about 2.5% out of the money, buying a 405 strike call. A lot of people will look at that and say, whoa, these things are expensive. But you know what? Tesla moves a lot historically. So the reality is we want to be positioned to take advantage of that. So we're buying those at 725. Again, that still only gets us a one lot. Now, you know right away what our double target is, right? It's $14.50, right? And so guess what? It gaps beyond that on that Monday morning. What happened there over that weekend in mid-September? It was announced that Elon Musk himself had bought up nearly 1 billion shares of stock. Maybe he was part of those big candles to the upside, right? Or maybe that word was leaking out on Wall Street. Guess what? A lot of other investors liked that sound too and bought in on that Monday morning even higher, up opened around 423. We had bought the 405 calls. So right away, those 405 calls are intrinsically worth $18, right? Right to buy at 405 is what that call gives you. It's at 423. That's an $18 in the money option. We're selling it out above that because we're on a Monday morning. We still basically have the week left, the whole week of time before they hit that Friday afternoon expiration. So we get out at 24.50 when our target was 14.50, make an extra $1,000 above our expectation, right? So this is atypical, right? Most of the time, if they're trading continuously from below 100% intraday to above 100%, we're going to get filled at 100% target, right? But in this case, gaps can benefit you even more. In this case, of course, making us 237%. And so you can see this example shows you if you bought $2,000 worth, you still would only get two contracts, not quite three. So it just doubles up what your profit would have been. One contract would have made you 1725. Two contracts makes you 3450. That's if you use 2,000 bucks a trade. But you get the idea that look, hey, these patterns can be powerful. Now remember what I mentioned the day before that Friday entry, we got in on that Thursday too, right? So you can see we weren't messing with any of this red candle stuff, right? And you say, well, gee, eventually you might have gotten paid off. Well, I don't know about you, but I don't like to sweat a trade. I don't like to hang around and hope. I don't like to say, oh, it's eventually going to work out, even though I'm in the hole now and the next day, the day after that, right? If you're buying there, you're kind of you are sweating it and you were wondering, is this thing going to get going or not? Or are we at the top of resistance and are we going to roll over, right? What I want to do is take away those question marks in your trading brain. I want to basically get you to a point of clarity to say, don't mess with that. Wait. Sure, we're not going to be early, but you don't have to be early. That's a huge eye opener for people to say, you know what? We're looking for that almost self-fulfilling prophecy of the institutions pouring on the gas, finishing near the highs, saying some, as it turns out, it wasn't just institutions, it was Elon himself, we believe, as he's buying up nearly $1 billion worth of stock as it's announced, right? So why do insiders buy? You know, they sell for a lot of reasons, right? Estate planning, whatever. Insider selling doesn't have as good of a track record. Insider buying has a very good track record because insiders buy for one reason and one reason only. They expect the stock to go up a lot. They're going to put meaningful capital down on their own stock. So principle here is okay, we get in there. Notice what we bought when we're trading there near the end of the day, about 368, buying just about 10 points out of the money, 377 and a half calls. We paid 584 bucks per contract, right? So just get us a one lot. The next day, it gaps up a little bit, but then keeps going. Obviously, it went up even higher by the end of the day. It was like up more than 10 points in the money. But look, we take it out at our double target. And in this example, if you use a $2,000 investment, that would actually get you a thousand gets you one, 2,000 gets you three, right? Because that's what higher dollar amounts can do is you can get closer to a full allocation because you start rounding up to where you see three contracts here would get you in for something like just under 1,750 bucks or right at it, 750, 1752. So the idea is that, okay, that's the advantage of as you gain confidence having a higher allocation. That's not how you should start. You should start small, let the system prove it to you. Don't just take my word for it and then go from there. Even after those big gaps up, you can see the rest of that next week, it was slow grinding up. But then on that following Friday after the Elon insider purchases, that you see that on the following Friday, we got a check mark that indeed it's reversing back up off a lower open and finishing the top part of its range. And we bought the 437 and a half calls, 720 that following Monday morning. You see it not only gaps up, but trades all the way up to about 444. And so again, with the whole almost 4.5 days left before expiration, the 437 and a half calls are about $7 in the money, but then we've got that other $7 or so at time. So we're out at 1440 and we take down on a one lot for $1,000 investment maximum. You get one contract, 720 bucks, turns into 1,440 bucks. You make the 720 minus your $2 commission. This is an interesting chart where it's a little noisier around the moving average, right? So you can see if we were considering a bullish setup, we would not get it even as it tries to reverse later in the day because it's below that moving average. This next one, it closes lower and finishes below the moving average. So it's only when it then takes the next day to test under it, but then finish back up and close near the highs here, that's going to say that's where we want to get in there. September 4th, you can see we're buying in with just under 340 and we're maybe 339. We're buying a 342 and a half call, only about 1% out of the money here. And you can see that we're paying 595. So again, if you in this case we're buying $2,000 worth, that would get you in for 1,785 bucks on a three lot, and that would turn into the double when it gaps up the next day. Again, it probably trades past that and it goes all the way to 354. So it's probably trading at some point near $13 or $14. we're okay taking it out at our double target, 1190, whether you had a one lot or whether you had a three lot or anything more. Bottom line is that follow the rules. Rules say sell at a double. Don't get greedy and hold on for more. If you do that, you will tend to mess yourself up. Now, what do the downside opportunities look like? It's kind of like flip the script, right? So now here's one where Tesla was rolling over below the moving average and then really finishing a hard pop to the downside, right? Prior bar is like, well, it's still kind of dancing around again, kind of in that little range there, right? So you can see that range is happening where we've got just some resistance around the moving average, but basically you can say we're still kind of in a trading range. No more basically here. You say, what about the old low? Well, it's finishing so weak right there. And this was obviously in a prior phase where you can see it's just under 162. We're buying the 162 and a half puts. We were paying 380. So again, if you're buying a two lot, that basically would make you, about 760 bucks on your 760 investment, give or take. And you can see the next one though didn't get our targets. Here's where the time stop kicks in, right? So it gaps down. You can see we like that gap down pattern, right? That it had a gap down here in addition to the following gap down as we got out there. But gap down, we're in, remember, as it gaps down, getting in here, that's our entry, right? So again, we're not early per se, but at 150, the options are getting a little more expensive. Volatility is rising. We buy the 143 puts, 7 points out of the money. Now we're almost 5% out of the money, and we're paying 395, right? Volatility has definitely increased over those prior few days from the big move it was having. And you see the next day it does drop to a low of about 146 and a quarter, finishes back around 147. But hey, we were right by 3 points. We got a point of that in the option, made $100 a contract. So if you bought a two lot for 790 bucks, you can see here that we're gonna make 25% or a couple $100 on that trade. Getting out the next afternoon at 3:30, time stop is what got us out. Those smaller winners or losers or roughly break evens, that's where the time stop will kick in if we didn't get the double target or the 50% stop loss. Here's another example. In this case, you see here where we gap down and we close lower. Even though it looks like it's reversing back up, our system says, hey, look, there's your gap down, there's your lower close. And so you say, okay, look, this thing still checks the boxes for us near 375 to buy a put. So we were buying about 2% out of the money, the 367 and a half puts. That was February 6th last year. And you can see this one, because this volatility has been rising, costs us 965 bucks to control one contract. That's why I say I'd like to see have the ability to do up to $1,000 to go into even one contract getting started. Obviously, it's a little harder to get your double target when you pay nearly $10 for an option versus paying $5 for an option, right? That just makes intuitive sense. We're going to reduce our leverage, but there's a reason we do that. If volatilities are high, we want to reduce our leverage. We want to make sure that if we do get into a flattening situation, we don't just get creamed with time decay. So the idea of this is that, look, we want to focus on the best of the best signals. And then, sure, in this case, you can see in retrospect, it kept dropping the next couple of days, right? But the key here is that we cashed it in that next afternoon, took it down out at 1375. The stock's gone down, you can see here, to around what, just under 365. And so it's gone from 7.5 points out of the money to maybe 3 points in the money. And you say, okay, that roughly 10-point move, we get about four of those points, $410 profit on the one lot, 42.4%. So you can see in principle that sure, there's times where, you look back saying, oh man, it still had more to go. But we want to say there's a window of opportunity. When that window closes, we feel like it's better to clean it up, move it on. So what does a losing trade look like, right? We don't just talk about winners, talk about a loser. Here's one where, okay, we're above the moving average. Looks like we got that fake out, right? We open lower, got that fake out, and then trade all the way down here, and then we're reversing back up to finish above the open with the positive white candle there. That's around maybe 248 and a half, 249. In this case, we're buying even a little bit in the money, 247 and a half call, thinking we're going to get the reversal back up to kind of fill the gap. We're expecting it'll pop back to like maybe 258, filling that prior gap back there. Guess what? That was wrong. But next to that thinking, Instead, it gaps down and keeps going down. Our $570 we invested in a contract turns into $280 pretty quickly, not long after that gap down, and continuing to go against us and say, okay, we get stopped out at 51% loss. Right? So you lose $290 a contract plus your commission there of $2 per contract, right? So the idea is that it will happen. Not just it can't happen, but it will happen that you will see stops hit. Okay. Just remember the nature of the game is lose smaller, win bigger. When you're an options buyer, that's a big part of the driver success. Most people come to me and ask me, "What's your win percentage?" That's only part of the equation. The size of win to loss is, in my opinion, just as important, especially as an options buyer. So we want to get a lot of bang for our buck and for a lot of reward potential for our risk. So sometimes, though, again, we showed you some gaps past our target. Here's another one that gapped for a larger than expected winner. And again, this is like looking for the reversal. So you can see it's getting that consolidation. You see that consolidation happening here. Put a big X through it, right? X that out. We're not even messing with it because we are above a positive moving average here. We're positively closing. And so that first reversal, as we come off there, we're just over 320. We're buying the 330 call. It's about 3% out of the money, and we're paying 710. And so you look at that and say, okay, well, gee, that seems a little risky after a few days down. You haven't even made a higher high yet. But we're saying we're waiting for that momentum to turn, right? The candles show you, okay, it had been down, 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 and then, okay, we're starting to reverse back up. So we believe there's more potential to keep reversing back up. We buy there, and then the next morning it opens at almost 340. You can see off of the open here at 340. Think about it. We went from 10 points out of the money to 10 points in the money. Okay. So that 710, we were targeting 1420. We end up selling it right off the open at 17.65. And so that makes us 148%, $1,055 gross minus your $2 commission. So the idea on a one lot is that we don't have to try to be heroes, but we just wait patiently to the end of each day. In that last hour, we're evaluating it and looking to get new trades out to subscribers right around that 3:30 p.m. Eastern time, Wall Street time window. So, one of the things that I've done is I've said, okay, I want people coming in to get a reasonable amount of time to try it and not grade it off of what happens on its very next trade. Actually, give you some time to see the real-time trade alerts in person and basically say, okay, how can you prove to yourself that you can follow that? So now, I'm going to set it up actually today where you can get 3 months of trade alerts to our Tesla options trader service. So that's the next 90 days access. And I'm also going to give you the same access I give to long-term subscribers. You are going to get access to the Tesla options trader settings and rule sheet, even with this, I think, low dollar trial, low dollar relative to the money you can make for sure. But of course, remember, every trade has risk. But the requirement when you sign up is you do click off on the terms of service, which says you're not going to share those settings and rules. This is something me and my team have worked many years on setting up these edges, and we want to make sure we maintain those within our paid subscriber base and not for the rest of the world. Okay. So bottom line is that, you keep that private for your own benefit when you get signed up. It's part of the rules of the terms of service. You also get access to my weekly video training. So I'm constantly teaching subscribers about what I'm seeing in the markets. What are the big trends happening out there? What are the future opportunities, the way that we look at it, the big trends way? You also can reach not just my customer service team, we give you a separate dedicated email to reach me and my analyst team via dedicated email address. So if you see a Tesla chart we call out, you're like, hold on, I don't understand this. I thought I knew the rules. Why did you make this trade? We'll be happy to confirm the rationale behind the trade. You can email that over. Now, if you're buying it off my Big Trends website, you'd pay $297 for every 30 days. So over 3 months or 90 days worth of access, multiply times 297, and you'd be at $891 invested. I'm going to make it much more attractive for you than that today. Fausto and the CTU team have been very good to me over the years, and I appreciate them including me in today's Cyber Expo, the 2-day events. Excellent event. So bottom line is that, okay, look, 3 months of the test options trader service, which includes real-time emails, and you also can get signed up for real-time text alerts. So you can get all that, plus the 3 educational trading resources, including showing you in the system so you can learn it while you're seeking to earn from it. Those are all included as additional bonuses. And you see, we're scratching out that 891, taking it down to just 177 bucks. So what's the link to do that? It's bigtrends.com/CTU. Now I'm going to answer some commonly asked questions here in a minute, but let me just show you that page because we keep our order pages really simple. I'm a big believer in the KISS principle in trading. Same thing in ordering here. We want to keep it simple. By the time you get into this page and you get to this page, you're like, okay, how do I get signed up, right? Because the nice thing about it is for 177 bucks, you know that you can pay for that very quickly off of just one good trade, right? And we're talking about not the next month, we're talking about 3 months. I don't really like 1 month trials. I also don't believe in free trials because what I've found is that basically if you don't invest anything in it yourself, you're not going to have any skin in the game to actually care about following it, right? If you put a little bit of money down, like, hey, I spent good money on this, let me learn this. And then 3 months gives you a lot of time to learn it while you're seeing about maybe a couple dozen trades, give or take, over the next 90 days right? So to me, that's a plenty of a good statistical sample to say we should have had plenty of chances to prove to you the value of the service. And one of the popular questions too is, well, what's my renewal rate after 3 months? This is not an auto renew. It's not a rebill. It's a one-time investment to try it out for the next 90 days with no future commitments. But know that as a paid subscriber, when you want to get signed up after 3 months, we'll give existing paid subscribers our best VIP pricing. So don't worry about that either. My representatives will help you out and work with you to get you renewed when the time comes 3 months from now. I believe you'll want to do so. But in the meantime, we want to first get you started to try it out, right? Because remember, your goal coming in should not be how to get rich quick on your very next trade. Your goal should be prove to yourself you can follow the system over all kinds of market conditions, all kinds of different ups and downs, and not getting hung up by a trade that lost or a trade that won, not letting that throw you off your game. Stay with your game of being consistent. Slow and steady wins the race, especially in capital allocation, right? So you don't get too high or too low on any one trade. You can see though, we've got the payment info up here. If you want to put your payment info in on the secure page, again, our 27th year serving our Big Trends community, you just then put in your billing information on the left. If you're doing that manually, make sure on this email field here that you do indeed get your email correctly in there, right? Double check it. We didn't ask you to type it in twice, but do double check your email if you're typing that in there because that's our first way we communicate with you. We will send you follow-up instructions about how to set up the text alerts via that email and your welcome instructions and everything else. You review our terms and conditions, you agree to them after you review to them how we do business and how we'll serve you over the coming at least 90 days. And I believe you'll want it for a lot more, but the next 90 days is the commitment that you're signing up for here today to take advantage of this for just 177 bucks, right? We've already taken all discounts on here. 891 bucks would be the retail price. We slashed in more than 700 bucks, some 80% off to say, okay, look at this. There's no promo code to apply. It's already done for you. 177 bucks. So the other easier way to go here is the PayPal orange button on the bottom right. If you want to save all that typing, if you have a PayPal account, you can just review terms and conditions, click I agree once you agree to it, and then click through the PayPal, and then no typing later. You just log into your PayPal, choose your money source, and then you've locked in the full next 90 days for just 177 bucks. As you can see, math-wise, that works out to under $2 a trade, actually under $2 a day for the next 90 days, right? If you do it per trade, like we said, about a couple dozen trades, you're still getting in for something in the neighborhood of about, what is that? Just under $8 a trade. And we'll show you again, remind you what one trade can do. Oh, by the way, too, on the top right of that page, on your full screen page, there's our 800 number to reach my customer service team. 800-244-8736. If you don't remember that, I encourage you to write it down. But if you don't, you can also write down or note 1-800-BIG-TRENDS is what that spells, right? So bigtrends.com, 1-800-BIG-TRENDS, how you can reach me and my customer service team. If you've got questions there, pop in any questions you want or email us to customer service. Our address is clientcare@bigtrends.com. When you get signed up, you'll get a separate email that reminds you what your separate email is to reach me and my analyst team. So some $700 off to lock it in when you go to bigtrends.com/CTU. Now, let me just answer a few of the frequently asked questions. I think I've got a few more minutes here, so let me do that. And then we're only setting, because we have a lot of people already in the service, we're only setting aside 25 of these spots. So don't sleep on it. Take advantage of it quickly. Remember the performance over the past, you can see here now, about what is that, 3.25 years, $25,000 portfolio growing to 120,000 gross before commissions, before subscription investment. So those are gross profit of 95,000, gross return 380%. Past performance does not guarantee future results. There will be winners, but there also will be losers, right? You don't have to allocate 5,000 a trade. You could start with as little as a $5,000 account, put in $1,000 a trade. We have a number of people that do that. So that's a great way to get started too. But let's talk about the FAQs, frequently asked questions, just to kind of give you the overview and the summary of what we're doing here. We are buying a call when we're bullish, buying a put when we're bearish. Okay. It's really KISS principle stuff, keeping it really simple. We're not holding it, like I said, more than the 24 hours in trading terms from one trading afternoon to the next trading afternoon. How we receive the trade alerts, real-time emails, and then I do recommend you get set up for the text alerts to your smartphone. I know that that will mean more pops that you got to keep up with on your smartphone, but I don't know about you, but I pay attention to texts and they get my attention a lot quicker than my email updates. So I do recommend the text alerts that will remind subscribers there when to get in, when to get out on every single trade. We never leave you hanging. If a trade's not working, we say, okay, this trade has hit its ending point. We are out of this trade. Uh, Close it out, move on. Same thing with on the bull trades. We'll remind you what your profit target is. Go ahead and book it, and make sure you don't miss out on locking in a gain. So when do we send these trades? Right around 3:30 p.m. Eastern, give or take a few minutes. That you say, well, that's only 30 minutes till the close at 4 o'clock. That's true, but typically once you get your alert, it's a matter of you just logging into whatever options brokerage platform you want to use and basically going ahead and getting your order in. So you figure out what your capital allocation is per trade. You say, oh, I can buy one of those. I can buy two of those. Whatever your capital allocation is, you figure out your amount of contracts and we'll place a maximum entry price. So we'll say get into this up to this price or less, right? So we will give, that's the order you can put in to say, okay, if it says get in at $9 or less and you put it in for $9, if you get filled at 880, great. And we try to give some room so that it's one of those that we don't want somebody to get it and be like, that trade already ran away from me, right? We try to give you some wiggle room to make sure you can get in and participate and take advantage. Okay. At the latest, we will hold it till 3:30 p.m. the next trading day, half hour before the next Wall Street close. And bottom line is that way we clean them up, move them on, win, lose, or draw. Like we said, if you do the data, we average about 7 trades a month. I said 7 to 8, but we expect to get you in that neighborhood over the next 90 days and then some. Once you get signed up again, as if you choose to renew, which I think you'll want to after the 90 days are up. Will there be day trades? There will not be a single day trade with this strategy. There's some talk, of course, if you haven't been keeping up with the news, of that the SEC and FINRA, I guess, has already said that they approve the lowering from $25,000 minimum account if you're an active day trader down to 2,000. So that's the proposal in front of the SEC, which I think mid-April is the cutoff point for the SEC to hopefully approve that. That will actually help the day traders out there as well. But this is not a day trading service. This is a quick swing from one afternoon to the next afternoon is our goal. So recommended average entry price of a Tesla options trader trade going back to the beginning of 2023 is $590 per contract, controlling each 100 shares of Tesla stock, right? So, Tesla's had its share of volatility, right? I mean, the bottom line is that, we've had a little market shakedown in some of the growth names. Tesla currently is trading at actually 398. So it's down just under 400 today. That still means that one contract would control $40,000 worth of stock, give or take. So the idea here is that, okay, you get the point here. We do believe in learn while you earn. It's not just firing out trade alerts. It's also teaching you the system, the settings and rules you get today as part of this with the dedicated email to reach me and my analyst team if you've got any questions whatsoever. Remember, what just one trade can accomplish, right? This is an example where we got into on $1,000 investment, one single contract. A lot of people say one contract. That sounds so small. I want to trade dozens of contracts. It's not about how many contracts you buy. It's about buying the right contract, right? We want the proper bang for our buck, the proper risk adjusted approach, not just taking a wild flyer on something and then if it doesn't work, sorry, you're out of luck. That's not how to stay in the game for the long haul. The way to do it is to limit your time risk to the next afternoon at the latest, so that even if it doesn't fire, you can control it. This one did fire, falling through, gapping up, and continue to trade higher that next trading day to get to our target at 1760 for an $878 net profit after the $2 commission, 880 gross. So obviously that can pay for your 3-month trial with a lot of room to spare, right? You're getting the 3 months of trade alerts with all the educational resources. And bottom line is that, remember, there's your link, bigtrends.com/CTU. I'm going to see if I had any other questions, see if I can pick up any other questions via the chat here. So let me see if I can pop that up here. Okay. So let's see what questions we've had here. Thanks, by the way, to the CTU team for posting my link up there. Very kind of you. Do we look at open interest, Genevieve says, before taking the trade? Genevieve, you don't have any open interest problems with Tesla. Okay. Tesla options trade very actively. There's not any issue getting in or getting out. The spreads are reasonable, between the bid and the ask. So basically, but the key is even if we saw something we thought was a little bit wide, we would put a limit order in to say don't pay more than this price. So like on that 880, we might have said pay up to $9, and maybe some subscribers got 850 or 860, and some paid the $9. And so we take an average when we track these things through to make sure subscribers benefit from that. Other questions? Let's see. Never traded options before, says Barbara. Is this a problem? No, it's not a problem at all, Barbara. This is the simplest way to get started. This is kind of like building a bridge between stock trading into options trading, which is a simple options purchase. So, but I do recommend that you start small. Don't load up. Just even if you trade a contract at a time, that's fine. Minimum days to hold the trade. We said there's even never holding it more than 24 hours. We're in one afternoon, out the next afternoon, no matter what. And I've got some thanks to give out to Genevieve, taking advantage of this. Whoa, we got a big response here. Genevieve in Connecticut, thank you. Brent in Illinois, David in Florida, Marco in California, Delwyn in Nebraska, Yvonne from Ontario, Canada, Raj in California, Oscar in Texas, Sharon in Florida, Len from Georgia. Wow, I think we got a pretty good representation of the U.S. and even Canada there. So thank you from East Coast, West Coast, North, South. It really pleases me to see that you see the value. And we're working hard all the time. Wade in North Carolina, thank you as well. If you've got questions, remember, you can call our 800 Big Trends number. You can email clientcare@bigtrends.com and know that we're focused on that. Now, Tessa is one of those that Steven says has Monday, Wednesday, Fridays. We always do use the Friday. It's just what we've always done on our system. Maybe down the road we'll look at if we had a Wednesday, maybe do we go with the next Monday kind of deal? But right now we've always used the Fridays. So that's kind of what we're sticking with, just kind of sticking to our knitting. But yeah, it's something that we're keeping an eye on. But thanks, good question there, Stephen. Okay, I probably missed a couple other questions. Let's see. Delta and implied volatility says enable. We watch these things, yes, but you see most of the examples I showed you are maybe near the money, we call it, maybe slightly out of the money, maybe a couple percent out of the money. Where you get probably your best bang for your buck as a quick options move from one day to the next is as it goes from out of the money to near the in the money, or as it makes that swing, at least up to the strike price or maybe a little bit past it, right? So going from out of the money to in the money is really where you will pick up a lot of delta, which is the amount that it moves on each next point in the stock. So yeah, that's really the sweet spot for us. So do we do spreads? Raj says no spreads. We keep it incredibly simple here. So you don't have to sweat a spread approval level. These are basic options purchase trades. Stephen asked that question. So I appreciate all these good questions here. And Patricia says, looking forward to trading options again. So yeah, we want to make sure that, yeah, you trade small so that if you come in and you say, okay, what is happening on the next trade? What if the first trade you get as a new subscriber is a loser? I would say that could happen, and for some phases when some people come in, it will happen. So when you start, I want you thinking, okay, my first goal is not making money on my first trade. I would like it if that happens, but even if you make money on your first trade, that's probably going to lead to overconfidence, lead you to loading up on the next one, That's not how you should be trading your options. If you want to stay in the game for the long haul, be steady and consistent. I'm out of time. More people coming in. Steven from Massachusetts and more. If you got other questions, call us at 800 Big Trends or email clientcare@bigtrends.com. Fausto, thank you so much, my friend, for having me back as usual. It's so much fun. Your audience is so well engaged, and it just really makes it great for me to see such engagement and interest in options. So thank you as well, Fausto, for all you do for helping Big Trends spread the word out there.
Well, thank you very much. Appreciate you being here as always, Bryce. It's always a pleasure. I know everyone did sign up, and that's awesome. Listen, the greatest thing about being here at Cyber Trade University is like we have a great lineup of people, and everyone here is going to learn something. And they're not asking to break the bank or whatever. It's a great startup. It's a great way to get to step into the realm if you want to learn one thing versus the other. Let me just take over the screen really quick right here, and let me stop sharing. Here we go. But as always, Price, thanks for coming. As always, we look forward to having you back. All right.
Thanks, Fausto.
You're more than welcome. All right. So I want to bring in our next guest because I know we're running like I said, we're running a good time. We're doing good. And let me just bring up something right here because I think he is logged in right now. Yep, he is here. Absolutely.
I'm right here.
Ah, there you go. All right. Let me just John Hutchison, I can hear you loud and clear. Perfect. There you are. Beautiful. All right. So let me just do a quick intro about John and tell you a little bit about him because, we just started bringing him on to the Cyber Expo. He's been around here for 30 years. And, we just teamed up with him about 2-3 years now. And we just got such a great feedback on his style of trading. And just to tell you a little bit about John, so you guys know a little bit about him, if you haven't heard from him, he's the co-founder of Trader Reserve. He's a lifelong entrepreneur. He started his first business delivering newspapers in Syracuse. So I love that. And you know what's so funny? I delivered newspapers. Those are like the old days. I remember the penny savers and all that. And that just basically just shows you somebody that is a great entrepreneur and built that business, and he built a passion in trading and investing in business. And he co-founded Trade Reserve to help investors, opportunities in the markets. And I think it's been over about 10 years now he's been doing it. So he focuses a lot on micro trading, investment opportunities. He's pretty strong on commodities with traders and investors. And and I've seen a little bit of his style of his trading, how he does his options and everything else. And like I said, we had such a great feedback of traders, and a lot of them signed up for his course. And we always check back with the traders and say, how'd you like his product before we ever bring someone back? And they just learned so much about it. So we're just so great to have you back, John. And we're all looking forward to it. You got a great staff, a great bunch of people here willing to listen in. They were all waiting for you to come here today. So let's pass the stage over to you, and everybody enjoy.
Well, thanks, Fausto, and it's great to be back. Glad to see, again, the continued need for helping people, especially in times like this. It's a little crazy out there, and I'll tell everybody before I throw my slide deck up here, I will share with you something that I shared with members of one of my services right now this past Monday, which is it's a great day today to play golf, have lunch with a friend, or watch the entire Harry Potter movie series. Because if you're a long investor, it's not a great day to watch the market, and that's okay. We all know that right now, the price of oil is dictating everything. So with that, a quick message, which is in really difficult times like we've had over the last 10 days, it is the best time that you can use to load up on ideas for the future, not necessarily trades or trade ideas or investments that you might make tomorrow, but ideas or investments you may make 3 months from now, 6 months from now, stocks that you want to start paying attention to or get more familiar with, charts that you may want to be paying attention to for the longer term, when at some point when the oil shock ends and things return to normalcy, you're ready to go. You're not playing from behind. You're playing from in front. You have a list. You have a watch list. You have targets. You have objectives. Can you still make money in these times? Absolutely. Is it a little harder? Absolutely. But today, I took a really hard left turn or right turn, take your pick, last year in our business to begin to focus on what was taking place in artificial intelligence. I am not here today to tell you that artificial intelligence is the greatest thing, and I'm not here to tell you that it's the end of the world. I'll leave that to you to decide. What I am concerned with and focused on is how artificial intelligence is creating a new class of stocks that many people are not watching. And when I say this is a great time to start watching those stocks, that's why. So I'm going to walk through what I've been doing over the last 5 months. For a little bit of background, I am the co-founder with my partner, David Durham of Traders Reserve. We actually started up in 2010 during the last financial crisis. Great time to start a business. But our focus over the last 10 to 12 years has been teaching people how to generate income selling options or using option strategies to generate income from their portfolios. The turn that I made last year was reverting back to stocks, not abandoning options, but focusing on using these stocks in the artificial intelligence realm because they offer significant growth opportunity. They offer the full menu of short-term trades, medium-term trades to long-term investments. Can you still use options with many of these companies? Absolutely, unquestionably. And you can use them either way, long or short meaning for income, long meaning for potential gains, like Price was talking about, big gains on Tesla. In his case, 24 hours. In our case, probably not. But the key is that once you start to get to understand where the money is being made in these stocks today, it gives you a path for where the money could be made in the next several months to the next several years. So I'm going to give you a little bit of a different presentation. I'm going to have some fun with you here today. The number one thing when it comes to artificial intelligence is this: think like an investor, not a consumer. And I think it's the hardest thing because right now, regardless of whether we're talking about what artificial intelligence can actually do, problems that it has, which it does, how people are talking about it in the media, and that's everything from regular media, regular news media to financial media. It's difficult to know what it really represents, what artificial intelligence really represents. If we can think like an investor for a moment, the best analogy that I can give you is that artificial intelligence is two things at the same time. It is the transition in the business world, not the consumer world, from typewriters to computers in the late 1980s to 1990s. Think word processors to personal computers, right? To software programs like Microsoft Word, Excel, etc. This transformation that took place in business, which accelerated business production. It actually changed how businesses hired, which we're seeing today. It changed the speed of business. It changed the communication capabilities of business. All of that is incorporated into what is taking place in artificial intelligence in different ways. The second analogy is this is like the internet in 1995. We remember back to 1995, right? We had dial-up modem. Either you had an 8K modem, maybe you could splurge for the 16K modem with the terrible sound when you connected to AOL back in those days. But it was the early stage of the internet. And if we think about the internet in 1995, mobile phones, 5G, wireless internet, social media, retail, online retail, none of those things existed. They took 10 years for the internet to actually reach its true potential, and another 10 years for it to truly become as ubiquitous as it has. Artificial intelligence is at the same stage. We're still discovering what it can do, what it can't do, how it can transform businesses, which is happening in ways that the media isn't even talking about. We'll share briefly, and not to or to belabor the point, but where artificial intelligence is really getting traction is among solopreneurs, small entrepreneurs, and small businesses, because it changes their ability to accelerate their business. And that impacts the growth. And small business always has been, and always will be the driver of the economy in the US. So when small business succeeds, our economy ultimately will succeed. And if they are able to leverage artificial intelligence at these core levels, at solopreneurs, digital marketers, digital businesses, all those people you see on Facebook selling stuff, if they are able to be successful with artificial intelligence, it creates a true underpinning to the economy that nobody even knows is there. And this has been true for over 10 years. If you think back to 2010, 2011, they used to talk about the gig economy, and what they never told you was it was a multi-billion-dollar economy. And it still is today. And that's where artificial intelligence is really getting its grounding, even as major corporations are beginning to expand what they're doing with it. But over the last 5 months, I have watched with dismay as our media continues to lead us astray and tell us things that don't make sense or don't connect. For example, the media narrative around AI keeps shifting. Back in October, there were bubble concerns, right? Is AI a bubble? Was the headline on almost every financial news site. And to make a major differentiation from the dot-bomb era to today is this. The dot-bomb era was not a business bubble. It was an IPO bubble. The vast majority of the companies that failed were companies that were being bid up as IPOs where they had no revenue. They had no revenue stream. They had no earnings. Many of them didn't have the business infrastructure to actually become real businesses like Pets.com. Today, that's not true. Today, artificial intelligence is being led by companies that already have existing products generating revenue that have nothing to do with artificial intelligence. Think Microsoft. Microsoft is both a business software unit, a cloud unit, a database unit, and a hyperscaler. So that is the major difference between this discussion about is AI a bubble or is it not, the major argument against whether or not AI is in a bubble. The second and fourth points here: CapEx concerns, low return on investment, and then just over a month ago, the announcement by the media that Claude had developed this co-work program that was going to wipe out the entire SaaS industry. One guy on Wall Street calling it the SaaSpocalypse. I hate those names, but there they are. Here's the problem. If you're going to tell me that artificial intelligence is going to wipe out an entire industry and sector, then that capital expenditure being spent right now by major businesses is justified, isn't it? Right? One of those two things can't be true. Either CapEx is too much money being spent by these companies, which is decreasing their free cash flow, or the artificial intelligence presents a serious disruption or threat to the software industry, the software as a service industry. Think CRM, Intuit, other companies in the SaaS market, or software infrastructure, software development, et cetera. So one of those can't be true. The same thing with adoption rates. There was an MIT study that was published claiming that only 5% of AI projects achieved success. They didn't exactly tell you what success was, but the actual result of that study was that only 5% had reached deployment. So that was interpreted as AI has low adoption. Well, if AI has low adoption, how does that replace an entire sector? It doesn't, right? So these are the problems as you see stories which have been put on the back burner because of the conflict in Iran and the price of oil. If you see these stories, think through whether the narrative makes sense or whether it is counterintuitive to something the media has reported to you in the past. It is clear and evident, even in our industry, a warning to Fausto, AI is coming into our sector too. There are now companies there's a company called Moby, which makes stock recommendations. There are companies that are developing everything that can attack futures and options and use AI agents to provide trade recommendations and trade ideas and education. So artificial intelligence is seeping into every sector, every industry, slowly but surely. And one of my goals is to help you see how you can use stocks that benefit from artificial intelligence for your portfolio. So I've covered this, so I'm going to skip this slide. I gave you all the things on that one. Over the last 5 months, I have been working with a small group of investors. I developed an index which tracks over 350 companies which are validated as generating revenue from artificial intelligence. And what I have found across those companies is that they fall into one of 5 segments, or I call this the AI economy. And there are 5 parts to that economy. And those parts are the AI supply chain, the AI core, AI frontier, AI powered industries, and AI solutions. I'll walk through each of these with you. I'm going to start with AI core. That is the hyperscaler level, the data center level. Those are the companies that are building the delivery mechanism and the power behind artificial intelligence. That's your Google, your Meta, your Microsoft, your NVIDIA. AI supply chain is the companies, or is comprised of the companies that feed the AI core. They are the companies that supply the foundation for building out those data centers. That's servers, chips, memory, storage, optical connectors, everything that relates to the speed and scale of delivering artificial intelligence. The third sector is AI-powered industries. These are companies which are 100% artificial intelligence driven. There's a small insurance company called Lemonade. That's the company's name. Stock symbol is LMND. That's Larry, Mary, Nancy, David. Stock is down from its highs recently, but this is an AI-driven insurance company as an example of an AI-powered industry. They are disrupting that industry. They recently announced a significant deal to insure autonomous driven cars with Tesla drivers. Since you folks were listening to Price with his Tesla trade, I figured I'd bring that in for you. The next group is AI solutions. These are your SaaS providers, et cetera. One of the things that was very much missed by the media when they hyperventilated on the SaaS apocalypse was companies like CRM, Salesforce, have built in artificial intelligence into their business to help their customers leverage their SaaS platforms for speed and scale. So artificial intelligence has been built into many of these platforms over the last couple of years. And Salesforce is not alone. Intuit, which has both TurboTax, QuickBooks, and MailChimp, has been building artificial intelligence solutions into its existing platforms, again, to help businesses communicate faster, communicate better, do data analysis better and faster. MongoDB, stock symbol MDB, recently announced advances in their Atlas database platform, which is a fully functional artificial intelligence database program. Stock is down too. You'll find lots of these stocks are down, largely because of that news around Claude's Cowork, and it dropped the software sector by more than 20% in February alone. So, but there are still opportunities even in that AI solution sector. And then the next one up is the last one rather is AI frontier. This is the future. This is the future of artificial intelligence. Defense AI, companies like Paladin, Palantir, other companies that are providing solutions to the US government and other governments in defense applications, autonomous vehicles, quantum computing, edge computing, robotics, and space travel, right? This is somewhere in the future, maybe 2 years, maybe 5 years. These are the companies that make up the Star Trek of artificial intelligence. That's wherever we're going to wind up, that is where it's going. Many of these companies are still new, they're young. One of the features of companies in the frontier is that many of them are not yet profitable, but they are building toward profitability. So again, ways to look at companies that you may want to find in the future. This is a sector that you can look at. The underlying build out of AI infrastructure is absolutely still going on. Data centers have been held back over the last 6 months not because of expense or cost, but because of placement, land, where to put them. More and more townships and cities are making it more difficult for companies to place data centers. In fact, there's a data center in Texas, believe it's in Austin, that was just abandoned by one company and then bought out by Meta. This is an area in flux, but the build out is still ongoing. So what I call AI 1 is that foundation, that initial infrastructure. That is what has driven NVIDIA over the last 3 years. It has driven companies like Vertiv Industries, VRT, GE Vernova, Vistra as power and energy companies. Companies you'll hear in a few moments like Lumentum, Coherent, and even Corning for connectivity. So all of these companies are building the foundation, but we have shifted since last year from building out the foundation to the revenue end. And what I want to talk through is finding stocks, how to identify them, and how they're in this next phase, what I call AI 2, which is the revenue phase. This is turning that infrastructure into profits. And my primary methodology is looking at growth and value. In my process, I'm looking for companies that are undervalued. I will show you an example of my process here in just a couple of minutes. This is just to give you a sense of where I'm finding stocks that have provided pretty damn good performance over the last 6 months. But that is looking at the future earnings of the companies. And one of the things that I keep seeing is that Wall Street is reacting to companies that are undervalued into the future against their future earnings growth. So a company that has high earnings growth, but a lower forward price to earnings ratio, those are the companies that are typically getting bid up in shorter timeframes. They are also companies that are outperforming on earnings consistently. I'll show you an example of a group of companies here on that as well as we go through this presentation. But my primary focus is looking for companies that have a significant gap between where the stock is priced today versus where the stock should be priced in the future based on its earnings growth. That's a projection, not a prediction. I'll share an example of that with you as well. So the one segment, though, that I have been focused on in the last several months is the AI supply chain. And the reason for that is where I have found the most companies consistently providing double-digit gains in short periods of time. That is 7 to 30 days or slightly longer. The AI core and AI frontier, the stocks that I track in my index, are slightly positive on the year. That may change after today, but you look at AI powered industries and AI solutions, these are companies which have been under much greater pressure from the expectations of disruption to their industries, or companies that are not yet performing on the earnings front. You can see the difficulty AI solutions, which is largely driven by SaaS and other software companies, driven down substantially in February. Don't be surprised that that's a sector in the future that makes a comeback as market begins to realize that companies are not going to simply wipe out an existing platform and then try to replace it with artificial intelligence. So that's an area that I think in the future of this year and into next year will have a strong rebound capacity. Frontier and core are two areas that I'm really excited about, in the sense that Frontier is thinking into the future, largely driven by small caps. So there's, everybody loves a $10 stock that turns into a $20 or $50 or $100 stock. Those stocks are here. That they're in that sector. They are not there yet. They're not making those moves yet, but they will. But supply chain are strong companies, strong fundamentals, strong earnings, strong forward earnings, and with the continued growth expected in data centers and delivery of artificial intelligence, this is the one area that I will continue to attack. I'm running a portfolio right now of 15 stocks. All 15 of them are in that supply chain category. And I'll even give you a sneak peek at what I'm doing there in just a couple of minutes. One company that I have traded 3 times in the last 5 months since October of 2025, when I launched all of this, is Lumentum. Stock symbol is LITE. And it's what I really find difficult is when you get a stock that makes a significant move on a chart, and Lumentum did in the latter part of last year. Stock moved from roughly $150 to over $300. As an investor, or even as a trader, the first time you look at that chart, you probably think the money's already been made. This is where I have a small advantage, which is looking at the future and seeing that a company like Lumentum, which has significant earnings growth potential, isn't done yet on the chart. And I'll take you inside for just a second. Give me a moment to swap my screen out, and I'll show you what I'm talking about here. And so this platform is called FinViz. This is just a platform I use as everything from a little bit of research, stock screening, checking in on stocks, et cetera. But what I also like is a quick and easy access to their earnings. I'm not pitching or selling their platform. I'm just telling you how I use that and giving them credit, since I have to share it on this broadcast. So when I keep in mind that 2025 here is over, right? This is last year. But if you look at the growth here from 2025 to 2026, look at the expected earnings growth. They're three quarters of the way through, or going into 3/4 of the way through their fiscal year. That's insane earnings growth, which is then nearly doubled from 2026 to 2027. Note that growth is expected to slow here as we get into 28 and 29. That's okay. That's not a surprise. But when you look at the chart, right, this is what I'm talking about. We started trading Lumentum back here in November. We rode one trade up for 37%. We rode a second trade up for 30%. And then in the beginning of this year, actually January 5, right there, we entered again, and we carried Lumentum up to over $500 a share, and then stepped out, and you can see kept on going to nearly $800 a share. But on the challenge with stocks in this realm is always, of course, the hard right edge, right? You see a stock here which has, just in this time frame, 250 to 500. You think, oh, the move is over, and then it just keeps going, another $300 per share. This is what I mean by Wall Street is rapidly pricing in future earnings expectations. Now, stock was clearly overbought, and so that presages that there should be some rebalancing in the price, but it does not change the fact that this stock moved, and it moved rapidly. That is from the 300 level. That's November to February, so 4 months that stock more than doubled in that time frame. This is an example of how fast these stocks are moving in the artificial intelligence space. And to illustrate that, over the last 5 months, I mentioned that I was consistently finding double-digit gains in this market. SanDisk, we closed for an 89% gain in 30 days, just over 30 days. Now, a little bit of context around that. There was both a lucky element to that trade and a skill element to that trade, and I want to define that. I had actually wanted to enter SanDisk the last week of December, and I opted to wait until the first full week of January, because for people who are following what I'm doing, you've got holidays in there, people are traveling. So I gave people the opportunity to, if you want to enter now, enter now. If not, we're going to wait till next Monday. So we entered on Monday, January 5th at the market open. And an hour after the market opened on January 5th, Bank of America published a report that identified a major shortage in the memory chip sector. Well, SanDisk went up 30% on that day. And if I had, sorry, it was January 6th, my mistake. 30% on the day. So part of that gain has to be attributed to the luck of that report falling on the day that it did after the entry of the trade. But I had identified SanDisk the week prior and in the 2 weeks prior as a stock that I wanted to add to our portfolio. It was trading in the 250s at the time, and we exited it at about 550, just under $550 on that trade. You can see Lumentum I've hit multiple times. Western Digital, Teradyne, ASX is a small company, smaller cap company. That's ASE Technology. And you can see a number of other companies in the memory sector, Western Digital, Seagate Technology, that's WDC, which I've traded multiple times, Seagate. And then one of my favorite stocks right now is Coherent, COHR. We traded that for a 20% gain, and we currently hold it with about an 11 or 12% gain. It's down from a high, but it was also just announced that Coherent will join the S&P 500 at the quarterly rebalance. So I think it's March 23rd that it's scheduled to join the S&P 500 index. So as I've been building this index out, and actually another company on this list, Amprius, that's AMPX, that's another small cap. Amprius is a really cool story to me because what they do is they create batteries. They make batteries. Now, batteries for most people, not real exciting until you realize that their advantage is smaller, cooler, low power, and accessibility, which helps the data centers and anyone executing on artificial intelligence servers, server capacity, things of that nature, power constraints, get batteries in smaller places, so to speak, and supplement or complement the energy problems that AI creates. The stock just reported earnings. We were in that stock. We're holding it now. We were in that stock in late February at $10.97, and it's currently, today it was trading over $18. So nearly an 80% gain. Second time that I've traded it. This is what I mean. If you can start to investigate what these companies do and connect the dots for how they have growth potential. And Prius has growth potential because it touches all of the major sectors inside artificial intelligence. It is not a company that is limited to, they're not limited to just one path, like NVIDIA is sort of limited to one path with hyperscalers. But Amprius is not. They're working toward deals for autonomous vehicles, as well as data centers and more. So the expanse of what they're able to provide is growing. It's a company that is just barely negative on earnings. I believe they closed the year at a penny in the red, but they have that forward path to growth. Just something that I like. So anyway, too much detail on that one stock for you, but let me carry on for a second. When it comes to stock trading, I'm a fundamental first person. I'm not starting at the chart. I'm not starting at technicals. I want a story for why do I want to own this stock? And that story is in the numbers. It's in the fundamentals. It's in the earnings growth rate. It is in the long-term path of that company. Is this company going to keep growing, or is this a company that has something special that's going to be sort of like one and done? Those are not companies that I want to invest in, although they may be companies I could trade short term. If I want something that I want to hold longer, I need a company that is going to consistently grow its earnings over time. There's a twist here, though, which is, as many of these artificial intelligence companies have exceeded earnings expectations, earnings growth expectations, Wall Street's expectations have become extreme. And in the last earnings period alone, I saw more gap up, gap down moves based on, even for companies that had beaten earnings, because they didn't beat earnings by enough, right? They grew their earnings by 70% instead of 75%. So this is what I mean. This is a challenge. but earnings are always a challenge. We can't do much about them. But one of the things that I shared, and I'll share with you to show you what I'm looking for and why I'm looking for it, is in the realm of what a company is doing as it relates to their earnings, how they're performing. And my mechanism is I'm looking at, did they beat earnings? Did they beat revenue? And did they raise forward guidance? If they're doing those three things, these are companies that I will continue to hold or continue to trade because they have a fundamental reason for me to do so. At that point in time, once I have that fundamental reason, then I can go look at the chart. Then I can use technicals for an entry or for an exit. Or if I want to hold this stock longer term, I can worry less about the technicals and focus strictly on whether or not the stock is continuing to grow. Right now, my entire portfolio is challenged, probably like everybody else. But my portfolio is moving based on the price of oil, which is ironic because most of the companies here are not companies that are susceptible to a rise or fall in oil prices, like an airline, for example, or a transportation company. But in the most recent quarter here, with the exception of Micron, because Micron reported in December and is due to report on March 18th, almost all of the companies here beat EPS, they beat revenue, and they raised forward guidance. What this is telling me is in the AI supply chain, growth is still happening. That, remember I said at the outset, the media narrative is low adoption rate. If there were low adoption rate, these companies would not be raising forward guidance. They would be guiding conservatively, they would be guiding down, but they would not be raising forward guidance. And that's not what's happening. They are. This tells me that there is still earnings growth happening. We still have a shortage in the memory sector, which benefits Micron, Western Digital, Seagate, SanDisk, and other chip suppliers, memory suppliers. It positively impacts storage companies. There was a Avgo during Broadcom during their earnings call made a statement that they've been favoring what's called direct access copper. That's in the weeds. I'm sorry about that, but that had impacts for companies like Ciena. And as Ciena outperformed on their earnings, it's one of those stocks that went down and then recovered rapidly. But Ciena is in the connectivity, along with Corning, along with Coherent, along with Credo. For those of you who may know the stock Credo, CRDO. So I'm trading across a wide range of companies in the semiconductor, memory, and connectivity, optical connectivity industries. But what this is telling me is I've got good stocks for the moment. And what I like about all of these companies, these are the 15 companies that currently make up the portfolio that I've been running since the beginning of February. So it's just about a month old. We'll take a look at performance. It's probably ugly today, but that's going to happen. But the biggest thing to me is the only stock that I got worried about was right here, down at the bottom. On Semiconductor, did not raise forward guidance. They reported revenue in line. Tower Semiconductor reported revenue in line, so that's not a beat, but they did raise forward guidance. So there's good things coming. But across the board, all of these companies provided the exact mechanism that I need to say, I want to hold these companies or I want to trade these companies. This is the path that you can use on your own. And I'll show you how to do it here in just a second. So we have about 22 minutes, plus Fausto owes me 2 minutes, so we'll be in good shape. Let me move back to, hold on one second. Let me get it set up in the background here. Let's take a look at how things are going. Actually, better than I thought. Oh, that's not too bad. So this is the current performance of my portfolio right now. Down 1.5 today. We have two companies that are up. Ciena is positive. Let's take a look at Ciena. We'll go to the big person chart. Here's their earnings day, right? They did all the things right. They raised guidance, they beat revenue, and the stock was down as much as 18% on the day. But look at the recovery and how rapidly, even into the teeth of the whole Iran conflict, that's how fast Wall Street will say, oops, we made a mistake. This was the recognition day as the stock bounced right back, and now it is back up in the 340s. Obviously, resistance here at 360. We'll wait and see how that plays out. More importantly, And to keep Windows out in the background for a second, I've been holding Micron. Micron's a lot of fun for me because I don't have to do anything with it. We bought Micron back on November 19th. That's September or November. Here, just before it went down a little bit. That was helpful. But since then, you can see from 226 to over 400. Stock is currently range bound. Resistance there. Solid floor down here at about the 370 level. And I suspect that the stock will continue to stay in this range until they report their next earnings. But we're sitting on a substantial gain of 70-ish%, right? 79% gain. So no reason for me to to make any change to that. I talked about Amprius. Most of you are probably familiar with candlesticks and three tall soldiers. This is an army of soldiers. I mean, holy cow! I didn't expect this after their earnings report. Breakaway gap up, and then bam, bam, bam. And even today, still holding. That tells me institutions are coming in to support this company now. And the shorts are probably in trouble. So I'd like to see this stay a little bit bigger. But at any rate, this is a significant move from the $10.97 level that we bought in. That was actually here on this day, on February 25th, just ahead of earnings, and that has paid off. We also traded it earlier in the year, and we exited, I believe, here. Nope, it would have been here, around the $11 mark. So the second time in, much bigger gain, and Amprius currently challenging Micron for the top spot in our portfolio. But here's a little bit of a test for you. When you look at these 15 stocks, be honest. It's okay. Be honest with me. How many of you are looking at these numbers over here on the right side, right? And going, wow, I don't want stocks that are down that much. Don't blame you. But you know what I look at? I'm looking at these two numbers right here. What is the total performance of all of these stocks? This is my approach. Please use your own. When I have a group of stocks, I'm looking at the collective, because what it means is if I walked away today, if I don't think that anything is going to get any better, the conflict in Iran is going to continue, that oil is going to continue to rise to 120, 150, 200 a barrel, and stocks are going to continue to fall under pressure. The Fed's never going to cut rates again. The economic Armageddon is underway. I can walk away and I still have a gain. If I close out any individual trade, I have a loss, right? I'm guaranteeing myself a loss. But if I were to walk away today, I'm walking away profitably. That's my approach to portfolio management. It is not single stock specific unless the story changes. And in most of the cases, the only stock that I stress that I had a worry or concern about and that I'm watching is this one right here, On Semiconductor, because they didn't hit that trifecta on the earnings, on their last earnings report. I can give the stock a little bit of time to see if it recovers on the chart. If it doesn't, I can walk away. I have a limited gain. I hate an 18% gain, but that's irrelevant. It's $400, but I'm making that up here, right? With stocks that are outperforming. That is, to me, what matters. But when I shared with you the earnings for all of the rest of these companies, they were essentially plus, plus, plus. And what that tells me, and what I've seen in the last week that actually helps to validate that approach, is these stocks recover faster when the market turns risk on. A week ago Friday, this portfolio was down 3.8%. On Monday, when the market rallied back and oil fell, the stock swung from a 3.8% loss to a near 3% gain. And yesterday and today, it has pulled back some. But these stocks can move, and they move rapidly. You can see it in several of the charts. I talked about Coherent. When you look at a couple of days back, right, there is Monday, March 9th, 7% pulled back. But that is how fast these stocks can move back. Because When Wall Street goes risk on, they are looking for exactly the kinds of companies that I'm targeting here. High growth, high earnings, strong revenue, consistent outperformance, and lower future forward valuations. Notice I don't have NVIDIA or Palantir in my portfolio. Palantir is still overvalued to me. If I take a look at Palantir, this is an example of the way that I'm doing analysis here. You look at their financials, right? Are they growing earnings? Yeah, but the real earnings growth isn't until 28 to 29, right? This is still small growth, but what am I paying for that growth? 120 times or 80 times earnings, when I can look at Coherent and I'm paying 30 times for more earnings. Which stock would you choose? That's why Coherent is in my portfolio and Palantir is not. Even though Palantir is still a good company, nothing wrong with it, but this is the company that has stronger earnings at a lower price, at a lower price to earnings ratio into the future. 26 times for a company that's growing earnings by more than 20% a year. Yes, please. I will take 10 of those, 20 of those, 30 of those. Anyway, let me work back to presentation and we'll get everybody out of here in just a couple of minutes. So my current portfolio performance, total returns since October of last year is over 20%. So I'm outperforming the market. I have losers. I have an overall 62% total win rate. But I'm consistently finding these stocks that outperform on the double-digit plus side. And that is what has helped me stay profitable. If we look at the total, I've split this into last year, closed trades and open trades. So the average return on my closed trades is still 10%. The best one was SanDisk. My unrealized P&L right now, you just saw, is actually about $600 because I had to do this presentation in advance. But overall, I realized P&L for the year in 2026 is almost $6,000 on a $35,000 starting base. So I'm outperforming the market again because I'm focused on the fundamentals first. So I'll close here and then take questions. Oh, no, actually, I want to do one last thing. Let me share one last thing. I told you about this index, and I forgot to show it to you. I'll pull this up in the middle so I can see it. So this is the index that I built. And I needed to build this for two reasons. Number one, how am I going to find all of these stocks that are in artificial intelligence? How am I going to sort them? How am I going to value them? How am I going to keep track of them? So I built first a database, and then I used artificial intelligence to build this tool. I am not a web coder. I'm not a web designer. Frankly, I hate that stuff. I took computer science one time in high school, never again. Artificial intelligence built all of what you're seeing here. I provided the data, it provided this. So I'm a believer in that sense. And that also saved me money, right? As a business, I didn't have to spend money outside of buying the access to AI, but I did not have to spend money for a web developer and everything else that goes into developing a web tool like this. So it's pretty kind of that's huge. So this is at the top. I keep track of the segment performance, which is just what I shared with you earlier. Total of 358 stocks. I'm constantly adding and subtracting stocks from the index. You might ask, why would you subtract stocks from the index? And the reason is because many of the stocks the stocks that have been removed from the index are stocks which have been bought out by private equity, companies like Confluent or Dayforce. There's a company out there called Thoma Bravo. That's Thoma, Thoma Bravo. They're buying up everything they can in the AI platform space. They, I believe, have bought at least 4 companies from this index since I started it late last year. And so that's why I have to both add and subtract to the index. I add companies as I make new discoveries. Here's a new discovery, a company called Qnity Electronics, a company that I really like. I would like to trade this one in the near future, so I'm keeping my eye on it. Up to date, year to date, the stock is 34%. Has a 1-year target that's 18%, but when I look at the longer term, it's the stock that has a potential to double. I would expect Wall Street to pull this price forward if this company is beating its earnings expectations. But what I'm watching, they have earnings growth, but is it strong earnings growth? And I'm not convinced yet that it is. That's why I'm watching the company and not just automatically buying it. But what I've built into here is a way for me or any investor to get instant view on a stock in artificial intelligence and say, yes, I'm interested in that stock. It belongs on my watch list, or it's a stock that I want to start paying attention to, or disqualify it immediately and say, nope, I don't want it. I don't want that stock at all. If we go, let me clear this out. Go back to all. Here's another company, AIS, better 1-year target, 29%. Remember this, keep in mind, I note here, this is a projection of price. So I'm projecting over the next 2 years that this stock could grow from $300 to $450 based on the earnings growth of the company. This is a really good example, however, of what I'm looking for. Note that the PE ratio here is falling by the earnings each year. Something went wrong there, my fault. And what that is creating is essentially the stock trading at a discount. So versus current prices. So in the future, this stock is worth essentially 40% less than it is trading today, 40% more than it is trading today. And that is for a company with compounded growth of almost 30%. As a marker, the standard or basic S&P stock is around 10.8% expected EPS growth. So anything above that is outperforming. And that's what I'm targeting. I usually want to be 2x that. So stocks that are above 20% growth on their annual earnings, those are companies that I typically will start by targeting. But all in all, this is the little tool that I built. And it gives me a way to say, I want high growth. I want best value. These are companies that have the best discount values out of the index. I want companies that have momentum right now if I want a short-term trade idea. And if I look at the index in total, the average EPS growth across this full index is 35%, which means I have a large number of companies with significant earnings growth potential. Anyway, so that was the index. And my little fun offer for you here, we have a few questions, so I'll get those in just a second as I close out, is to do this. Next week, on Friday and Saturday, we're holding our 12th annual Investors Blueprint Live event, which we're calling the AI Wealth Conference. It's a 2-day event, but day one is the one that matters the most because we're trading all day from 10 a.m. to 3 p.m. Eastern time. And we'll be trading stocks, just the stocks that I've walked through with you. How would I trade for short term? Which stocks would I own for long term? We have option strategies for income that we'll be teaching and trading with people during the conference. It is a live conference, meaning we will be at the Hilton South Lake in Dallas, Texas, but we also broadcast virtually. So you can do this from home, from your office, from your car, on an airplane. The key is a way for you to see this index in action, get a better grounding beyond my roughly 50 minutes here of what's taking place in artificial intelligence, how to separate out the different segments and identify the best stocks. So you're not spending time looking at 350, you're looking at maybe 10 or 20. Right? It's how do I narrow down and focus on? And then, so that's Friday. And then on Saturday is our training day. Saturday is where we can take you on a deep dive on our option strategies, my stock and portfolio strategy. And most importantly, how to use AI as a trader. Everything that I've learned in the last 8 months of using and executing with artificial intelligence, I'll be passing on to people how to build tools for tracking, for portfolio management, for trade ideas, for trade analysis. As I said, artificial intelligence can do more. It does still have issues. So you need to know what those issues are in order to use it successfully, no matter whether you're using it as a trader or however you are using it. So I think we'll get the link out here in the chat. Tickets are $197. Most important thing is everything is recorded. So I know it's a Friday and a Saturday. Nobody likes to give up their Saturday, least of all me. But since I can't mow the lawn because it's still winter here in Detroit, I might as well be in Dallas doing something fun. But for anybody else, everything on Saturday is recorded. It's available to you for up to a year. So you have plenty of time to go back and watch the recordings. if you have better things to do on Saturday. But if you don't, you could spend the Saturday with us. And if you join us, my biggest suggestion is plug into a big screen TV. It makes a world of difference, even for a virtual event. Even the next time you attend Fausto's Cyber Trading Expo, plug into a big screen TV. I'm using a 55-inch monitor while I talk to you. So trust me when I say plug into the big screen monitor. So anyway, that's it. Let me check the chat so I can catch up on questions. And I think, Fausto, that we will get you back on track, and I got to figure out where I'm starting from.
No problem, John. I'm here. I'm here. Everybody hear me okay?
Already done. So synergy with Lost Dog. Oh, Stephen Pearson. Hello, Stephen. How are you? Great to have one of my members along. Excuse me, Patricia, to be frank. Patricia, exactly. That is exactly the point, though. The question for you, Patricia, is, and I get it. There are people who don't like AI, don't want the future of anything to be artificial intelligence. The question is, as an investor, and that's the only question that matters, how can you use companies that are in the artificial intelligence realm to support the work that you're doing to build your portfolio, to generate income, to generate growth? Because this is where the growth is right now. It's not in GM. Most other stocks have been flat this year to down. Right? The real question is, do you hate something enough to never invest in it? Or can you hate it a little bit, but profit from it? That's a personal decision. I leave that to you, but I understand where you're coming from. You're not alone. My wife hates AI too. My wife is a teacher of 10th and 11th grade students, and she cannot stand artificial intelligence. Needless to say, I sleep on the couch frequently when I talk about AI at home. Not one of the more there is a lot going on, Genevieve, and I like what's happening. Again, I stressed at the beginning, the story that the media always misses is what's happening at the very small entrepreneur level. There are people who are literally building businesses that are driven by artificial intelligence. These are not companies that are out to cheat people or screw people out of their money. They're building legitimate businesses. They're building it in coaching spaces, content spaces, marketing spaces. And all of that is doing is affecting the speed of business. And the other thing that I think gets lost in some of what's talked about artificial intelligence is, and I've been testing this, you can train artificial intelligence to talk like you. So just for fun, instead of Fausto, Fausto, at some point you might have Faisto, Faisto, hosting one of these events. I'm kidding, Fausto, don't do it. But the point is, AI can talk like you, it can sound like you, it can write like you, and that is both scary in one sense, and I get scared by that. But it is also a critical function in being able to execute anything at speed. So AI agents can. Let's hope that they can do that. I know Micron. I love Micron. Micron is my absolute number one stock right now. Has been since September. I held an AI summit last year, and I said in September that Micron was a long-term buy and hold. And then all of the other major, the Motley Fools and all of the other companies out there came out in December and told you that Micron was the number one stock to buy. I'm 3 months ahead of them. And I say that for fun. But most importantly, HBM, high bandwidth memory, their 2025 sold out. Supply sold out. Their 2026 supply sold out. They are now forcing companies to take long-term contracts to guarantee supply for HBM4, HBM5. They recently announced development of a new plant because Micron can only serve a certain percentage of the market.
Decent and pretty girls are high maintenance, and you can't afford them.
That's exactly it, right? So at any rate, there it is. So yeah, Micron, absolutely. Every one of them paid for itself. Thanks, Stephen. Appreciate that. I'm sure we'll see you at the next one. Grab a ticket to this event.
Why don't you reply back to Mom on your email?
If you
reply back to your business.
if you grab a ticket to the AI Wealth Conference, Richard, you'll be able to get into the AI2 program that I've been running since October of last year. So it's still new, still fresh, and deep dive list. Appreciate that. And there will be, yes, they'll be giving us your name and email address. Once I get through the conference next week, Richard, I'll make sure we reach out and give you access into that. Oh, I'm not telling you. I'm not telling you. I agree. I agree. The challenge in education is teaching students how to use AI in the right way. I think the biggest issue for most of the people in education is the assumption that AI is being used to cheat, right? To do right everything. But there are more and more more people in the education market who are trying to teach them how to understand what the limitations in artificial intelligence and everything from drift, hallucination, AI fake creating things so that it can be used responsibly. Listen, everything gets used in an irresponsible way in technology at some point. It's all to all of us to do the best we can to fight against that. Thanks, Fausto. Appreciate it. And we'll get in touch with everybody after the event. I'm done.
Yeah, thanks a lot, John, for coming here. And yes, and by the way, you got his offer. And thanks, John. We'll make sure we'll promote it and help everybody get that video and so on. So thanks for coming. But we just ran out of time, so I don't want to take too much time away from Jeff. So let me just pass it over to him. All right, but thanks for coming, John. All right, so let me just pass it over to Jeff because it is 1 o'clock, and I want to tell you a little bit about Jeff. Now, for some of you don't know who Jeff is. Oops, hold on 1 second. Sorry about that. If you don't know who Jeff Hirsch is, he's actually a really, really good friend of mine. He's been around for, as long as I've been around. For some of you that are students of Cyber Trade University, you probably met him. He's been to our on-site several times. He runs the Trader's Almanac, which is probably one of the most popular book in all of the trading industry. I mean, they constantly have a series. Every year he comes out with a new one. It is a #1 bestseller, and what happened was, I always see him at the Money Show events, and he's always introducing, and interviewing people. And I wanted to have him come back. I want him to come back. So this has been a long time since we had him back on the Cyber Expo here at Cyber Trade University. And, and we haven't had him in a while on the on-site, but I was like, you know what? This guy's new book that came out. He wants to tell you a little bit about it. He's super, super excited about 2026. And there's no better place than for him to do it here. So, Jeff, thanks for being here. It's always been a pleasure having you. And stage is all yours, my friend. We can't hear you, Jeff. I'm gonna get mics off.
About that.
Ah, there you are.
Sometimes just got to plug it in and pull it out again. Sorry for the boomer move, but anyway, it was great seeing you in Vegas. I think it was Orlando Money Show.
Orlando. We had a good time over there. That was great. And and by the way, he's a local guy, Jersey guy, and it's so funny. Was it last year? I think I saw your son wrestle. Is that right?
Yeah, we bumped into each other at the Suffern. It was like the what was that? That was the big. Actually, my guy was his best performance of the year. That was he took first in that event in his weight class.
Yeah, and now what he's doing? Now he's doing rugby, right?
Now he's playing rugby up in Northeastern. I think he's got to take a little break. Freshman year, he's got a lot going on. He needs it's 7th season in the spring, but he's a 15s guy. He's a gridiron guy. So
well, good luck with them. And and then, by the way, thanks for being here.
Hey, the pleasure's mine. I appreciate you having me. So, yeah, exciting year. Came into the year bullish, still bullish, despite some of the things that are going on in the media. So, just the Iran conflict has really driven intense media attention over the past couple of weeks. And while that geopolitical backdrop is pretty serious and rapidly developing, market behavior remains more measured than the headlines suggest. So, it's still early on in the conflict. Nobody has any idea how this is going to play out or end, but if the situation were as dire as the worst headlines make it seem, the market would be down even more dramatically. Oil would be, I don't know, $20, $40 higher. It's definitely up today. So it's rather remarkable that so much has been thrown at this market. Venezuela, the SCOTUS tariff decision, the AI disruption to software and the banks, and now this Iran war. And yet the S&P is still relatively flat on the year and flat since November. So with that, just a little history. Um, you know, my father started this publication, the Stock Traders Almanac, back in 1966. The first edition was the 68. It's going to be 60 this year for the 27 edition, so we're celebrating that. And I'll also be 60, just so you know. I was kind of born, bred, weaned, raised on these cycles, patterns, seasonality. My father, Yale Hirsch, icon of the industry, legend, passed away at the ripe old age of 98 back in the fall of 21. And here's some of the other books and places we put out there. This is Yale's "Don't Sell Stocks on Monday" book. He's was a songwriter, had a way with words, could coin a phrase. Super Boom was a book I put out building on his cycle that he discovered back in 76 for these major market moves. I'll show you a little bit of that at the end. But basically, the S&P, the STA was a big hit right out of the blocks, and it has become arguably the most influential book on Wall Street. It's been on the desk of top money managers and traders and advisors. I know Fausto's been using it for as long as I've known him. We've sold over 1.5 million copies. Things like the Santa Claus Rally, January Barometer, best 6 months, all created by Yale. He put the 4-year presidential cycle on the map. Coined phrases like October phobia and if Santa Claus should fail to call, bears may come to Broad Wall. That's all my father. And, I like to say, forget selling May, though. We'll talk about that a little bit in a second, but I like to say buy in October and get your portfolio sober, which was still a good trade last year and this year. So we all remember what Santayana taught us, that those who fail to remember the past are condemned to repeat it. I like to think that those who understand market history are bound to profit from it. Our foundation is in seasonality, cycles, and histories, and we incorporate technical, fundamental analysis, market internals, and sentiment, also in conjunction with macro trends, geopolitics, monetary policy, and the economy. So I refer to these 5 disciplines as seasonal, fundamental, technical, monetary, and sentiment. And we use all that knowledge to construct portfolios in the newsletter service. Today's takeaways, got a lot to cover. It's quite an interesting year, as the old Chinese saying goes. We'll talk about the January barometer. It's positive, still keeps our base case forecast for 2026 in play of 8 to 12%. Look at some historical perspectives on the Iran conflict and midterm election year conflicts. We'll look at the best 6 months. The only proven black box system that I've come across has got some scientific method testing on that. Get into the weak spot of the 4-year election cycle, the midterm election year, Q2, Q3. Watching volatility, and then I'll show a little bit about the March Almanac and go through our market at a glance, 5 disciplines, and we'll look at some stock and ETFs, some commodities and Bitcoin stuff, as well as the AI super boom that I think is going to continue to 2026 and beyond. The January barometer was positive. Pretty solid numbers here. We got the positive years of the January barometer. That's when the S&P is higher in January. The saying is, so goes the year. Again, something invented by Yale back in 72, along with the Santa Claus Rally and the 73 Almanac. So I just pulled out the bottom here, added February in, but you can see 41 out of 46 years. When January is up, the full year is up 89% of the time, average gain 16.9%. And in the last 11 months, not including January, still up 87% of the time, 40 out of 46, 12% gain. So this is positive, and this is what keeps our base case scenario. This is from our forecast put out in December. December 11th was the date that we released this. You can see our base case scenario, about a 70% probability. Look for some trouble during the middle of the year, but the super boom continues. you have basically a president trying to cement his legacy. He's got some issues with what's going on over in the Middle East now. Best case scenario, everything gets resolved. We get another 20% gain. This is only 10%. Worst case, which is, starting to show up a little bit. It's still 20% probability for us. An old school, ugly, volatile midterm election year. Remember 2022 when Russia invaded Ukraine? We had that slow bleed bear market. So, geopolitical hotspots have flared. We're still watching the economic numbers. Had some issues with AI valuations. Again, this is still, smaller probability. So with that, let's just look at a little history of the geopolitical crises, S&P performance during war, and other energy crises. I mean, just for reference, the first thing I remember as a kid growing up, in 72, I guess I was just about 6 years old. Watergate is like the first big, news current event thing. And then I remember the 73 oil embargo. I remember the odd and even lines, odd and even days in the gas lines. So interestingly, we've broken out the history of these crises. 1 week change after it starts, 2 weeks. That's kind of where we're at right now. 1 month, things get a little bit better. 2 months, 3 months, 6 months out. Broken it out since 79. Since, I mean, this is, not ironic and not coincidental that was when the Iran hostage crisis happened, but it was also the beginning of all these crises after we were off the gold standard. So you can see down here in the crises since 79, not quite as harsh of a reaction than we had back in the old, World War II days. So it's still very early in this conflict. Oil's definitely telling us that things are a little bit of an issue, but that picture today of the tanker on fire is like one picture from one weird source. You'd think in this day and age with everyone videotaping and recording everything, there'd be a lot more news on that. So just take some of that with a grain of salt, and let's try to tune out the noise and stick to the data and the numbers. So I took this table and turned it into a chart here. So we plotted the S&P 500's performance. It's about a month before to the 6 months after the crises began. And I've got in the blue line, this is, I guess, as of yesterday's close. Not I guess, it is. Compared to all years going back to World War II there on the previous table in black, since 79 in green, and before 79 in the red. So we're kind of tracking right on the all years. I mean, this is something to pay attention to. Interestingly, for what it's worth, this gray dotted line is all years on the S&P since 1930. Basically, this is the market's upward sort of, 45-degree or so-ish angle. The bullish bias of the market, you can see that, several months down the line, these things tend to, the market tends to shrug off these things, despite what happens in the theater and the military and geopolitical front. So keep this in mind. Within the first month, we tend to recover. We're still right in here in this first week or so. Something to keep track of as the news cycle continues to flow. And then just to look at one of the pages out of the Stock Traders Almanac, the 2026 edition. I think you can see one. I got one over here. Always keep one on the side of my desk at all desks, home, office, everywhere. And this is sort of the midterm election year page 28. You can see the where bottom pickers find paradise, another one of Yale's sayings. And I've highlighted some of these war disturbance events, even 98 with the Kosovo war and the NATO prep there, 22, down here, 22, where Russia invaded Ukraine. So it kind of rhymes. I mean, this is sort of the time when you have the U.S. Political system, in flux, and sometimes it gets taken advantage of. So just remember, already printed last year when we put out the 26 Almanac in the fall. Again, if you got a copy, you can refer to the page. Otherwise, any of my subscribers get a free copy when they sign up. So just looking at the best 6 months. This was invented by Yale Hirsch. You've heard of sell in May and go away. As I told you, I like to say buy in October and get your portfolio sober. But there's math behind this, and it's pretty simple. Yale put this together in the 1986 Almanac. It's not sell in May and go away. It's, get more aggressive risk on in, September, October, November, and start to take risk off in April, May, June, July. Back in 2008, a gentleman named David Aronson, he's a CMT, chartered market technician, group I support, and he put out a book called Evidence-Based Technical Analysis, and he took 6,200 and change different black box systems and put them through the scientific method, testing them against the null hypothesis to see if they had predictive power or were just the result of chance. So when we picked his book as the best investment book of 2008 in the Stock Traders Almanac, we asked him to put the best 6 months through the same scientific mathematical paces. And he started in 1987, the year after what was first published in the Almanac, and he found that unlike any of the other 6,000 plus black box systems, this was the only one to have predictive power and not to be the result of chance. Here you have, this is simply buying on October 31st, or the last trading day of October, selling on April 30th, the best 6 months, November through April. Average gain 7.4% for the Dow. May through October, 0.9. Just a simple compounding of a one-time $10,000 investment gets you a gain of about $1.3 million versus a gain of $4,000 or $4,200 in the worst 6 months. This is the numbers taken directly out of the 26 Almanac when we published it last year. Add in one of our favorite technical timing indicators, MACD. I'm assuming everyone in this group knows MACD. If not, you can look at our website for some more information on that under our strategy. So just using the, now we use the 817.9 daily MACD on the buy side. This comes right out of the original research from Jerry Appel, who invented MACD. This is the faster, shorter MACD, which is better for buying bottoms, which are more of an event, and versus tops, which are more of a process. We use the standard 12-26-9. We start looking for a buy on or after October 1st. We want agreement between Dow, S&P, and Nasdaq, even though Nasdaq has the best 8 months, it goes through June. And then we start looking for a sell for Dow and S&P on or after April 1st using the 12-26-9. So just using the simple MACD triggers increases the average to 8.9% and turns that little gain into a little loss for the worst 6 months. And it triples the results of the compounding $10,000 investment to nearly $4 million profit, and turns that little gain of 4,200 into a loss of almost $5,000. And then just to look quickly at the Nasdaq version, this goes from October to June, and this was even better timing, great timing last year. It was better than the best 6 months sell. We got out in like that mid-July peak. Again, going back to 71 when Nasdaq started, 13.2% of the best months, minus 0.4 in the worst, 3.5 million profits in 71 with the $10,000 compounding, and then a loss of $5,300. So that's the best 6 months, best 8 months timing signals, and this is what we send out to subscribers when they trigger. And this leads me to the worst 6 months and the weak spot of the 4-year cycle. So this is Q2, Q3 of the midterm election year. You can see what has me concerned here. The pink line is 2026. sort of running the risk or upping the odds of maybe, getting into one of those old school midterm year type of patterns that I mentioned earlier. So we're watching this closely. But the sixth year of the presidency in this red line, when the incumbent in the second midterm year, no matter what you say, it's Trump's second midterm year, tries to cement their legacy. Maybe that's some of the calculus for what's going on geopolitically right now. No one knows what he's thinking, but that would lend us to believe that we get a little bit of a spring rally here before we kind of go sideways in the worst 6 months. Very typical of what happened in 22. A little bit more of the downside in 2022 with Russia and Ukraine. So this is this is in the Stock Traders Almanac. I've tweaked it for subscribers and for you guys here. The market's holding up to this Iran war, but optimism for a quick and swift resolution is wearing a little thin. Any sort of change, any sort of taco behavior could, as we've seen recently, could lift the market. So, we warned about this February break last month, and there tends to be a little bit of a turn here on the Ides of March, which I'll show you in just a second. So, keeping an eye on the weak spot of the 4-year cycle. This sets up that bottom picker's paradise. A lot of this is riding on what's going on with Iran right now. And then, we're keeping our eye on volatility. We have the VIX here. This is right out of stock charts. I just wanted to look back at a few of the different things with this index. The spike above 35 the other day, March 9th, was kind of getting into that fear area. It's this 20 to 30 range with sort of, higher lows that makes us a little bit nervous like we had in 22. You can see the big spike from COVID and from the tariff tumble. This 25, there was a little bit of a, I think it was the Japanese carry trade, the yen carry trade spiked this last summer, or in summer of 24, excuse me. But for the most part, if we stay in this range here, it's kind of that slow bleed lower. Concern for higher lows here. So we're watching this volatility index. We'll be looking at some of the other sentiment indicators out there. I'll show you the investors' intelligence bullish and bearish percentage just later on when I get into some more of the other things we're looking at. But nervous market here. Being up here makes us nervous. I think this is about where we were when I put this in there earlier today. So it would be nice to either turn lower or get a spike higher, indicating we've achieved sort of maximum fear, which tends to occur at these lows, as you can see from previous, recent previous history. But interestingly, the war and the surging oil price has so far failed to derail March. March has been a solid year in midterm elections. This is what we, prepare people for every month in the newsletter. And here's just an updated version of our typical seasonal pattern for March. This is the recent 21-year period, giving us a good, more current time frame. We like to compare different time frames, longer, shorter, and current. This is sort of the most. This is the shortest one we'll look at, last 21 years, and you can see we're getting into that Ides of March period. So we saw the spike up to about $120 a barrel from pre-war price around 65, but everything remains uncertain there. We noted this. I noted this before, just in the performance during crisis slides and chat a couple minutes ago. But basically, right here, the S&P was down intraday from its high on the 28th of January, just over 7,000, intraday high, just over 7,000, to the low on the 9th of only 5.23%. I mean, you can't see all of that here, but that's kind of close. So considering what we're dealing with in the oil market and the war, S&P's holding up pretty well. So look for some sideways action in March here. And then we tend to see the end of March stronger as we get into the end of Q1 and options expiration, triple witching, and the anticipation earnings season. Economic situation, a bit mixed, a bit messy. The Q1, the Q3 numbers were pretty good. Q4, I think, was impacted by the shutdown, but the Q1 forecasts are still coming in just today, updated from the Atlanta Fed, 2.7%, a little uptick. So, still resilient, but, we've got a lot to deal with oil being higher, the government shutdown numbers delaying things. But all in all, still resilient economic situation, still positive, especially in light of all the volatility here. Earnings season's been kind of mixed, but there've been some standouts. Nvidia, even though whatever whisper number wasn't met, they still, recorded record quarterly revenue. Dell also delivered better than expected. So tech and AI leaders were generally beating expectations, even though maybe the market expects them to beat even by more, which I think is kind of interesting. So there's some mixed numbers out there economically and corporate wise. Looking at inflation, continues to run a little bit hot. You can see some of the data missing here for the CPI, the blue line. Got a little flat there. I think it's pretty wishful, that 2% target that the Fed keeps talking about. I think they should look at some history. The history that I've seen with the CPI is about 3.1% historically. But nonetheless, with oil prices up and some of the things going on there, you've seen interest rates move higher, and then we're going to look at some of our little projection chart. This is something that we just put out on the blog yesterday. These are some of the projections. We just sort of use a little historical 12-month here. It's still kind of elevated, headed higher. It's not easy to with the economic war, with the Iran war headlines out there. It's easy to overlook some of the economic data. But the CPI release, 2.4% was, a little bit of an increase. But with the, inflation numbers elevated and the gaps in the data from the shutdown, though I don't love trusting the government numbers, and then the oil price is high. I think we're running the risk of some inflation numbers, and that's going to keep the interest rate cuts at bay. But employment's not so horrible. This is the initial claims. We love this indicator. It's not hard to manipulate. This is not seasonally adjusted initial claims. Remember, there were some concerns about it spiking. It was a very seasonal spike. It's come back down. You can see it looks very similar to the other seasonal spikes. Claims are down. Non-farm payrolls weren't so bad. This is something that is a little bit encouraging for the labor market. Let's look at some technical levels. Again, December low is one of the pages out of the Stock Traders Almanac. It comes from an old Wall Street analyst, Lucian Hooper, something we've had in the Almanac for many years. And what Hooper, he was a Wall Street analyst, an old Forbes columnist. He said, forget about the January indicators. If the Dow closes below its December closing low in the first quarter, watch out. I put out a bunch of information on the efficacy of that. January barometer has better numbers, better accuracy, but here we are trading below the December closing lows today. It hasn't closed below it yet. That was 47,289.33 on December 1st. Haven't looked since we got started here, but it was definitely trading lower here. That's kind of our line of the sand. We get through that, then the next level, is down around 45,000. You can see the top from last February and the previous, December 24 rally post the election there. And, you can make these lines real thick, but, this becomes a risk area. And there's the 200-day right there. Everyone's watching that. So we're right at that, technical level and that sort of historical seasonal indicator level for the December closing low. On the S&P, we've also traded below that. I know my buddy Larry McMillan has been talking a lot about, and other people also, about 67.20, which is right near the December closing low of 67.21 and change for the S&P. We kind of broke through that February low we were watching and the uptrend. So just a couple of technical looks here, but this the numbers here, which I think will also line up with the Nasdaq chart, which is broken further below the stuff, the October and November lows. This was that China tariff gambit with the deleveraging of the crypto and Bitcoin, and then the December pre-Thanksgiving low before, was it Williams was the Fed governor who had the chat down in Chile that bounced the market just before Thanksgiving. So Dow and S&P have not closed below the December closing lows, but last I checked, at this presenting or this writing, they were trading below it intraday. On the Nasdaq, couple of levels that we're looking at here, around 2200, about 2278 was that November closing low. So this is sort of that first level we're dancing with right now, right at the 200-day. And then the other below that, around 20,200. Again, that December 24 and February and also January here highs. That's a number that sort of sticks out to me on the chart. Again, you can make these support levels lines super thick with a crayon or a thick Sharpie, because it's not an exact number. Just be careful of that. And these, as I've been talking to some other colleagues, these support lines often become magnets for the market, as this one's really looking like right here, the 22,000. It's just pulling the index to that, especially when there's a lot of volatility and geopolitical turmoil and headline noise out there. So technically, things are on notice. Interest rate wise, it's really a wait and see. We're still in a cutting cycle. This is the 10-year on the bottom and the 30-year on top. You can see where we're trending higher, we'd come down, and now we're sort of threatening to push a little higher, suggesting that there's no cut. So rates are on the rise with the flight to safety. But looking at the CME futures, the Fed watch, you got to go out to September to see any cut. This is just the June one from earlier this morning. I think this was up even a little bit more last I looked. March, 99% chance no cut. April, 91% chance. July, it's about 55. It doesn't get to be about 40% or so until you get to September. So we're waiting on the new Fed. Hopefully that transition and even that vote happens. There's still some shenanigans going on with the Senate and the lawsuit. It would behoove us to get that done. But I think there's time with Powell's term not being up for a couple of months or so. So again, interest rates on the rise with the bonds, but wait and see with the futures not suggesting any sort of cut until after mid-year and after the new Fed, probably not until Q3. Elevated sentiment. My favorite sentiment indicator is Investors Intelligence that tracks newsletter writers and analysts, people that get paid to put out their advice. So it's not just a random survey of like an AAII sentiment. This is last year where we had the three spikes above. This is the difference between bull and bears. Above 40% is this danger zone, as noted by Investors Intelligence and John Gray over there, who does a great job. Fantastic service. And, it's been above 40 6 times in the last 8 weeks. We just dipped below it. It looks a lot like the pattern we traced out last year when we had that, dip in the end of the beginning of 25 and excuse me, the middle of 24 there, and then we had this tariff tumble here. So you can see, point being, when it gets above 40% net bulls, you can still have this rally for a while. A little correction in between them. We had that so far this year, but this is getting concerning. The bears have jumped. This has fallen down here. So I got a question mark here where we go from here. The bears jumped to about 21.8, call it 22% from about 14 and a half last time. The bulls fell further to under 50. They were way above 60, or not way above, just above 60 for a little while. Correction percentage has dropped as well. So more people moved into the bear camp. So you're starting to get to that point where you see, potentially these sort of spike bottoms, just like VIX or just like put call, and those other contrary sentiment indicators. You see these bearish divergences at low points. We're not there yet, but we could be in the situation where, you have a recent a shorter term rally. But, what's going on in the Middle East is front and center right now for sentiment and oil, of course. Midterm election years. A little look at crypto and Bitcoin. Midterm election years. Interestingly, worst year of the 4-year cycle for stocks. Horrible for Bitcoin. The data for Bitcoin begins back in mid-July of 2010. So this 500% move in midterm years and these other numbers when it was quite thin are a little dubious to me. The 2014 numbers, a little bit more liquidity there. I really only start paying attention to Bitcoin seasonal patterns and other things, and I really don't start paying attention until 2018, the first full year after the CME futures began trading in late 2017. So you can see, whatever the case is, we're down up. I think Bitcoin was up a little bit more today, so we're kind of 19.5%, but still negative for the midterm year, 3 years in a row. We've seen some pretty decent sell-offs, some historical drawdowns in Bitcoin. I'm not convinced it's over. I did this graphically for my friend. I don't know if Fausto knows him, but Adrian Zdunchik, the crypto burb. He's a CMT. He and I did a study back in 23 on the seasonality of Bitcoin, which showed that sort of low period you can see here on the stock charts, on the stock indices back in late September, early October. But this is the midterm pattern. This is a visual of the 3 midterm years. So again, this is only 3 years right here, 2014, 2018, and 2022. And these are all midterm years for Dow, S&P, Nasdaq, and Russell 2000. Bitcoin's got the scale on the right, pretty big numbers. Stocks are on the left, a little tamer, a little bit, Russell's down less than 10% at the low. So while it looks negative, it's, kind of just standard correction period. But again, Bitcoin stocks, not notoriously great in the midterm year. And here we are with some hanging volatility, oil issues, and conflicts. So sets up, the midterm buy, the bottom picker's paradise situation. Just, keep track of history and try to incorporate that with some of your other trading inputs. A little seasonality on the commodities. We're going to be putting out the Commodity Traders Almanac for 2027. Last edition is 2013. Just looking if I have one on the side of my desk. I think there's one over my shoulder in the back. I just ordered one off of eBay for myself for the home office, but copper has been on the move. This was a sort of seasonal, this was a seasonal trade for us. We got into this I'll show you the seasonal trade in a second, but this is, the tariff tumble. We've recovered from that. We got this move from AI and data center build outs and autos and housing, consolidating that gain. The seasonality ends in May, so we're not chasing this, but we're already in it. I have a nice trade in the copper miners. It's come off a little bit, the COPX, which I own. We got into that nicely on this November dip right here. You'll see it better on the other chart in a second. But midterm seasonal pattern for copper. This is the 6th year in green. I've got this for gold and crude oil as well. All midterm years in blue and all years in the black, and the purple is 26. So you can see this sort of seasonal run from December over here till May. Looks like we've got some legs left on this, if history is any guide. Gold, looks like there may be a double top in place here. The flight to safety during the war, still no new high. The seasonal run here, it used to be and still is a great fourth quarter gold trade. We got into that. We sold our GLD for about a 27% gain back in early December. Definitely left something on the table, but that was our seasonal trade. The miners trade GDX and GDXJ hit our auto sell levels up over 20% in 2 months. So, longer term inflation, the flight to safety, global central bank demand, that's what's driving gold here. But I think we've seen the recent top. I'm not chasing this. We don't have a position in it, but if you own it, maybe take some profits, tighten up some stops. Same thing with silver. Don't have the chart here for that, but basically no position there. But again, if we have one, I might be unwinding it, consolidating, tightening, taking some profits, that kind of thing. I did pick up a silver coin in Vegas at the Vegas Money Show a couple of weeks ago. I actually bartered it to a subscriber for a renewal subscription, which was kind of fun in Vegas. It's got the Las Vegas on one side and the roulette wheel on the other side. It comes from, is it First Silver ticker symbol is AG, if memory serves. They were presenting at the show there, so that was kind of fun. Here's the gold seasonal trade. A little bit upside here in the 6th year of the presidency, the second midterm year. But here's the more historical fourth quarter gold trade in all midterm years and all years in black. So this is kind of the seasonal trade that we normally look at. Crude seasonal low is in December. We've got the Iran war premium, about $20 to $40 or so of premium in there. I think it would be, I don't know where it is right now, but it would be consistently sustained above 100 or 120 if things were really or even more dire over there. I'm not sure what the plan was for the Strait of Hormuz when things were started there, but you'd think there would be or would have been or could be a better tactical strategic plan for protecting traffic through that vital passageway. It is above the level that we were at during the last engagement in Iran in June. So concerning here, we've heard some stuff about naval escorts and insurance. Just be careful with oil here. I mean, it dropped $35 in a day. Something could easily get changed by a post on Truth Social or a phone call with a reporter from the president or something, out of the developments over there. So careful with the crude trade. I do own the XLEs. We picked that up seasonally. It's nice when seasonals and macros line up. That's a December low trade. I'll show you that. That's the stocks, the oil company stocks. One sec for that one. But here's the crude oil seasonal pattern. You can see normally midterm years not great. All years a little bit better, but way above that. You got to think there's some sort of reversion to the mean. So that's a look at some of the commodity cycles and technicals that we're looking at. Just want to give you our tactical seasonal switching strategy. This is the picks that we went into for the MACD buy signal for the best 6 months. This is from the newsletter ETF issue we put out last week. This is getting this will be updated, but for now, of course, I own all these. Gains have been paired a little bit, not that much since the 4th. Just a quick snapshot. Again, stocktradersalmanac.com if you want to see more of this stuff. Here's the sector rotation ETF portfolio. Some pretty solid numbers. You can see we got into the European stocks, European ETFs, stock ETFs, selling out of biotech now. Got some decent gains over there. Actually, the DBA was one of the ones that was up today. That's just a little commodity trade there. But, copper was up. The copper miners was up over 50%. Now it's down under 40, but still over 30%. XLE, still doing well. I think that's one of the bigger winners today. A little bit early on the gas, but the UNG is back up near our buy limit level, and we just got into utilities. I picked up the XLU at about 46 yesterday with just a good canceled buy limit order outside real-time trading hours, one of those types of things. I'm not a day trader. I'm just kind of a swing trader. I kind of pick the buy limits and that we publish and stick to them, eat my own cooking. And then if something closes below our stop or hits our target, I'll either, put a trade on or just close it out. Here's the seasonal sector trade for copper. You can see this clear seasonal move from late November, December through May. We got in right around here in November. This was a fortuitous seasonal trade in conjunction with the AI data center build out trend. Again, when seasonality meets macro, makes me happy. A look at the energy trade. This is XOI or XLE. This is the stocks. Again, similar trade. That copper bottom is usually, right when the construction, just to finish that thought, is when the construction season is that it's low. Here we have just the energy stocks. Again, oil tends to bottom. The stocks at the bottom here in December. Nice trade for us. Definitely benefiting from the current volatility and surge in oil prices. Currently, I own the XLE here from back in December. And then here's the utilities trade. As I said, I just got into this on a dip at 46 for the XLU. This is the index because the data goes back a little further. That's why we use it. And this is some of the data is messed up here. This trade tends to run March through October. But there's been a big upside. There's been a big put under the utilities with all the energy we're using for AI and everything else. So those are some of the seasonal sector trade highlights. Just a quick rundown of our stock screening process. The whole list is on the website. Some of the stocks that we've uncovered, recently have been Amphenol, APH. That was last September. OSI Systems, OSIS was October 24. Arch Rock was a little energy infrastructure company. That was September 05. That's AROC, AROC. StoneX Group, SNEX is another highlight. I don't know how to pronounce it correctly, but it's Fibro is a pet animal company, PAHC, and Ensign, SN, a couple of our highlights there. But basically, we use a seasonal overlay and look for, going long on stocks ahead of the best 6 months. I do a fundamental screen with looking for stocks with acceleration of growth and revenue and earnings, good valuations, low margins, low PEs, low price to sales ratio, because that's the one that is hardest to manipulate, cash flow, debt. And then we look at ratings. I don't look at what analysts are saying, but I look at how many analysts are following a stock, and all things being equal, if a stock is followed by a handful of analysts versus 10 or 20, I'm going to go with the one that's underfollowed. That's how we get stocks under Wall Street's radar. We do 3 different market cap groups: small, under $1 billion, mid $1 billion to 5, and large over $5 billion. I know it's not super mega cap, but we're looking for stuff that's under Wall Street's radar, that's not being followed, stuff you're not hearing everybody talk about. We look for some relative strength and not a lot, just a little, just sort of marking time along with the market or its sector, not below, not falling, and not running away. So we're looking for stocks that are, under the radar, kicking out good numbers sequentially and year over year. And then we look at some chart patterns, your basic support and resistance, moving averages for entry points. Basically, old school fundamental technical analysis. And a couple of things before we wrap up and try to take a few questions here. Interestingly, the Dow just logged a historic 10-month winning streak, only the 6th time in history since the Dow's been up 10 months in a row. Squeaked out a gain in February of 0.17%, but that was sufficient to gain. This is just the 6th time since 1901. Dow's been positive 10 months in a row. What we see here is some positive momentum over the next month or two, but then it starts to wane over 2 and 3 months. Kind of runs in with our best and worst 6 months, and the Q2, Q3 midterm, weak spot of the 4-year cycle. So looking for some continued upside on this particular historical precedent, but then sideways weakness during the worst months. And this sets up, what we call this is from page 34 in the 26 Almanac, the potential 50% move. It's actually technically 46.3 for the Dow going back to 1914, from the midterm low to the pre-election year high. That'd be the 2026 low to the 27 high. You can see a lot of these pre-election year highs, which will be next year's in December. A lot of them on the last trading day or towards the end of the month. There's been some March lows. I'm not suggesting that we've seen that already, but we're definitely correcting a little bit here and potentially setting up a real bottom picker's paradise here in the midterm year. We called the bear market low in 2022 at the bottom in October when everyone else was still pretty bearish. And then on the Nasdaq side of this, I don't have it shown here, but Nasdaq's midterm low to its pre-election year high would be 26 to 27, going back to 71, a whopping 66.6% gain since 74. Just a little shout out to my pop. His original work from 76 inspired the Super Boom book I put out. You can see these secular bear market moves during World War I, World War II, Vietnam, the War on Terror, and these 500% moves. I put out a forecast in that book. We started the forecast back in May of 2010 with the Dow at about 10,000 for a 500% move to Dow 38,820. That's the cover of my book, but it's way ahead of schedule. We touched 50 for a few days, over 50 for a few days in February, but here's my initial projection based upon seasonalities and 4-year cycle stuff. If we go back to the actual end of the secular bear market in 82 and sort of correlate that to the bear market, end of the secular bear market in arguably October 2011 at around Dow 10,045, a 500% move there would take us to 62,430 versus the 38,820, which I picked off of the old 2009 low. So just to look at the future, I think the boom is here to stay. I think this is that part of the equation, the culturally enabling paradigm shifting technology, the disrupting technology that we've seen in the microprocessor, with air travel, air conditioning, refrigeration, the combustion engine, indoor plumbing, all these kinds of things that came before it that changed the world collectively and individually. And I think we're feeling that with AI right now. I heard some chatter about AI in the previous talk. I've been using it, still testing a bunch of things. But just to recap, headwinds, the tariffs and uncertainty, the Iran conflict, of course, inflation's rising. The labor market, is it softening? Not seen yet, but it's a concern. Midterm politics are going to be an issue. The razor thin margins in Congress are going to be battled pretty seriously. And the market's been flat since November. That's a concern. AI uncertainty is definitely a concern. On the tailwind side, we've got the AI super boom still going on. The strength of the 6th year of the presidency, the positive January barometer, an easy Fed and a new Fed. The economy's still showing resilience, lots of government spending, and the tax cuts and the deregulation. I guess we'd throw oil prices into the headwinds as well right now, but that's still kind of just temporary or short term. So I think outlook wise, this conflict starts to ebb during the springtime. Rate cuts after mid-year. Q2, 3, more volatility, steady economic numbers, stable job market, and I still think we'll get that fourth quarter rally and a 8 to 12% gain for 26, and the boom's going to continue into 26 and beyond. So, it's all right here in the newsletter service. So basically, I tell you what to buy, when to buy, at what price, when to sell. Send it right to your inbox. You get the stock portfolio, the stock traders almanac free every year, the best 6 months buy and sell signals, the calendar, the vital stats, the market at a glance, the pulse of the market, all these time-tested proprietary strategies invented by us. Get them nowhere else. You get the seasonal sector trades with the ETFs, undervalued stock picks off Wall Street's radar, and we do a monthly call with members. I'm going to take some questions. I think I got a few minutes left now, but I do 30, 60 minutes of questions with subscribers every month. So stay ahead of the market with Almanac Investor. There's a QR code there. You can scan it. There's a code for getting a big savings. You get a free copy of the Almanac, and you'll be getting a 27 too if you subscribe now, because that's going to come out in September, October. Should get it before Thanksgiving. So with that, I'm going to take some questions, if at all possible. Let me see if I can see if anything's in the chat here and dial back in. Let's see. Thanks, everybody. Thanks, Fausto. And let me know if you have any questions. Otherwise, we can let you go about your day. Anthony is saying some of the Elliott wave guys think a major top is near for a 15-year decline. I don't see that. I'm more in the, super boom pattern for your cycle. I think we've got some other, support for that. I don't see the big Elliott. I'm not a huge Elliott wave fan. I think, like Fibonacci and other things, you can, subscribe to waves. Right now with the S&P holding up, as I said, down about 5% intraday only. I think that remains to be seen. I'm not an Elliott wave guy. You're welcome, Sue, Luciano. Thanks for tuning in. Good question though, Anthony. Let's see. Mike has a nice question. Have you ever considered developing a 25-year out expectation S&P 500 growth chart? I mean, I think I kind of did that back with the super boom chart here. But it's definitely something. Let me see if I can get that back there. Definitely something we're looking at updating. And I do looking out 15 years back in 2010, 2011 was quite an undertaking. As you can see, there was some relevance to it, but a lot of things happen over 25 years. But yeah, I've looked at cycles that far out, and I'm not sure 25 years, but 10, 15, 25. Yeah, it's definitely what we're considering. I'm not sure I can pronounce this person's name. Iqbal Nadia. Thank you. First read my little book of stock market cycles in the mid 1990s. No, it didn't come out in the 90s. You may have read the Yale's book, the Don't Sell Stocks on Monday in the 90s. The little book came out in like 2012, I think. All right. Well, looks like we got about a minute or so left. If you have any follow-up questions, go to the website, stocktradersalmanac.com. Shoot it to us. You can call us. You can find my email. Hit me up at Almanac Trader on X or wherever. Hey, Fausto.
Hey, good to see you, Jeff. That was a great presentation, and just let everybody know that the Stocks Almanac is probably one of the most popular books out there in as long as I known it. I mean, I have it on my desk all the time, so it's a great subscription, and hopefully everybody takes you up on your offer.
And remember the intraday trading patterns that we both have, that you have on your mouse pad, which and that shows up in the back of the almanac, which you
got it. Beautiful.
Another simpatico we have there, buddy. Right?
Always has something in common. That's awesome.
That's right. All right, man. I appreciate you.
Thanks a lot. I'll see you. Are you going to be in our? You going to be at our money show in Florida?
I'm going to Hollywood.
I'll see you there.
I'll have my best girl with me too.
I'm gonna have I'm gonna have like mine too.
It's on the beach in Florida. I got to bring the wife.
Otherwise, you get divorced. So it's a lot cheaper to bring them than to leave them. Thanks a lot, everybody.
More fun too. Take it easy, buddy. Problem. Thanks, everybody.
Thanks a lot, Jeff. All right, so listen, I want to bring on our next guest. I want to bring on my next guest in here really quick. So hold on one second. Let me just take over. There we go. Hold on one second. There we go. All right, everyone. So we're down to just two more speakers, and this has just been a absolute wonderful event. Like I said, great content, great education, great deals on some great products from all the actual speakers. And I know that, listen, you can't buy them all, but you know what? Buy what you think that's best for you, fit for you. And like I said, that's what it's all about. So I want to bring on my next speaker, which is he's the first time been on here at Cyber Trader University. So I'm really, really excited to have him on here. Oops, hold on one second. Just got to change something up right here for a little bit. What do I got here? Oops, there we go. All right. So we're going to bring on Dan Gibby. So he is the chief option strategist at at Master Traders. So, obviously, you saw we had Capper on yesterday, and Greg has been as long as I've been in the business, in trading for almost like 30 years. And he works with Master Trader. He's got over 20 years of experience of equities and options trading. He's very experienced in the technical analysis and option strategies, which is what I like a lot. We have a lot of options traders in here. Listen, if you trade equities and you want to hedge yourself, that's the way to do it, because that's what it's all about, is learning to hedge risk. He's also successful, law career, and it's became like most of us become full-time traders. A lot of you are entrepreneurs. We got accountants, we got engineers, we got all types of people. And eventually, we're all going to trade the market, makes it more of a full-time career. He's got a strong knowledge of how the stock market works on the intraday part, which is what I love most of all. I'm looking forward to hear what he has to say about that. He's head of a corporate proprietary trading and global trading firm, manages trading accounts in the stocks and futures, and he brings his experience in trading, finance, and his business strategy. So with that said, you just want to really like to thank you so much for being here, and I want to pass the mic over to Dan. Dan, are you there? Do you hear me out loud and clear?
Yeah, Fausto. Yep, sound clear.
Perfect. All right, Dan. So once again, stage is all yours. Everybody enjoy, and if you have any questions, save for the end.
All right, awesome to be here. We have a fantastic session here for you in the next hour. I'm going to I am going to drastically change the way you think of options. There's so much misleading information out there. You can lose money. They're dangerous. They're complicated. There's there's all these myths, people trying to scare you. But what I'm going to do in the allotted time here is I'm going to change that for you. I'm going to show you the power of buying and selling options using the master trader technical approach. Now, there's a lot of mechanical people that say, oh, nobody can read a chart. It's a coin flip, 50-50. Well, Greg and I have been working together for 25 years and our success is 85%. So that just flies in the face of common sense. So we start with a technical bias, and then I'm going to show you how we then craft the best option strategy to make money with limited risk, with a higher probability of profit. And then we manage it with the charts and also with some of the way that the option Greeks work. So let's begin. It's going to be a fantastic session. Greg yesterday probably started with a very similar slide, and it's for a good reason. This is our approach to trading anything that moves. Now, this applies to any instrument, stocks, ETFs, futures, currencies, Bitcoin. It does not matter, and it doesn't matter on what time frame. So we're still going to apply these concepts before we go place an option trade. Price is king. We believe that technical analysis reflects the true sum total of all market participants, and that's what we call objective information. So we put those candlesticks and patterns together in connection with the trend, support and resistance, multiple time frame analysis. We look at volume and moving averages, just a secondary. You'll see how simple my charts here are momentarily. We don't use oscillators, which are derivatives of price and volume. We call those subjective, and they lead to incorrect information. And they also allow what Greg calls the indicator-based salesman. They're trying to sell you something proprietary. Oh, I have this magic sauce. One guy in my green trading room told me yesterday he heard some speaker say, oh, I'm a 90% so far this year. Now, when I hear exaggerated claims, I'm not going to say you're a liar, because I don't have an objective basis to unless I look at your data. But what I will say with utmost confidence is that anybody who touts extreme returns like that is taking on unreasonable risk. Number two, if you had some type of proprietary black box system that printed money, ATM machine, you would have billions of dollars thrown at you from hedge funds in Chicago and New York and elsewhere. So you just take these crazy salespeople's comments who are trying to pull money out of your pocket with a grain of salt. It's the same thing with it selling you a pill. Oh, you don't need to go to the gym, eat whatever you want, and you're gonna lose weight. Okay, come back to me in a couple of months and tell me how that works. So you're not going to hear the word proprietary from me in our teachings at all. It's objective analysis. Give me, and we have nothing to hide. In fact, when your customers, Greg shares all of his scans that he's built over 30 years in TC 2000. We have nothing to hide. We want to teach you objective, systematic approach to trading the markets. All right, so that's a summary of trading anything that moves. Of course, we want to then consider that compelling trade opportunity with what the broader markets are doing. We have different market internals for swing trading and intraday, of course. But without position and money management and trader psychology, people like to come to this, and it's really amazing. They'll spend 3 months researching to buy a new blender or telephone or whatever, but then they're slinging around $25,000 in a position without confidence or anything systematic. Trader psychology, I kind of just refer to that as that you have the discipline and patience to follow your trading plan. I mean, with Let's Chop lately, and I know in the green room, I start telling jokes and trivia because it's like I'm trying to keep us out of bad trades because things aren't lining up. Talking about options now. This is what we do. So based on that prior slide, okay, Dan, I have a high probability setup on multiple time frames. I'm ready to enter, but I prefer options. So the options are three-dimensional. They give us so many more opportunities. If you buy a stock or an ETF or future, whatever, and you're long, you're only going to make money if it goes up, short, the reverse. In option trading, both buying and selling, it's like a three, do you remember that Rubik's Cube? It's three-dimensional. So we can craft it where, by definition, the probability of profit is greater than just being long or short, the underlying. It's an amazing thing. And yeah, I've been, I started with a day trading shop in Tampa. There was Cornerstone, there was 3 of them. And it was in 1997. And they didn't teach me anything. And I lost $28,000 in a couple of weeks. I'm like, this isn't working. And that's when I teamed up with Greg in New York. And so that's our approach. But so I love our technical approach. That's what we live by every day. But I then, because I love the aspects of option trading, and that's why we're, great business partners, we merge our skills and our working together for so long, and that's what we do. So I have a good pattern. Then I'm going to decide if it's a directional trade, which I'm defining as, hey, I'm willing to buy the stock or ETF, but I want to see if I can use one of my directional bullish or bearish strategies where I'm still have a directional bias, but I'm crafting it again with leverage, limited risk, and trying to increase probability of profit. Income strategy is our reference to selling options. It's like, oh, it's not. Well, every directional trade is also an income strategy. I have plenty of examples here to hammer the point home. This is just some introductory words. But selling options on turning points where we say, I don't think that stock is going to go under this level of support for a couple of days to expiration, or I don't think it's going above this resistance. We have so many more opportunities with sloppier patterns. Now, the biggest downside to trading both of these is I got a great technical setup, but the options are the spreads are too wide. They're not liquid enough. I think there's over 3,000 stocks that are optionable, but really only like 125 have really tight spreads that are great. But we'll get into that. And selling them, we love selling short-term expiring options, even 0 DTE, which I got plenty of slides on that too. They expire in a couple of hours, so you don't have to take overnight risks. And recently, they've launched multiple expirations within the week, like for the FANGs and some ETFs, and I got to get a full list of them. Then we pick our strategy. I'll do my best to show you what I can and the time we have together. But that's what our seminars do. We got full full seminars that teach you exactly, here's the pattern, here's the pros and cons of each strategy. And then we manage it with the charts, calculate position size, and then just man it. Once you're in the trade, we're in management mode. Now, the beautiful thing with options is instead of just using a trail stop, we have what I call adjustment strategies, where you can. Do you remember the guy on the the music panel? And he's like, oh, give me a little more treble, some more bass, more of this. And that's what we can do with options, is you can adjust the volatility, the deltas, and, beyond today's session here. Just a quick definition for, new people here. What is a contract? Okay. You can buy Apple, for example. It's trading at $250 right now. But if I buy an Apple call or put, it gives me the right to buy Apple at a specific time. That's what we call days to expiration, for a specific price. So I might buy a $250 call option that expires in 2 weeks from now, and it's buying options are directional because the price of the options are going to move with the directional movement of the underlying. So call buyer, we're paying money for the right to buy stock, bullish. Call seller, we're taking the opposite side of that. We're saying, hey, wait a minute. Who's buying a call option on this chart right here? It's topped out and reversing, like say an M top, for example. So we go to the option table and say, I'll take your money. And then I manage it because I think the stock's going down or going nowhere. But I got a lot of slides on selling options. The benefit here, we're profiting from our bias, bullish or bearish, call or put, with leverage and limited risk, and also higher probability of profit depending on how you structure it. General rule here for swing trading. So if I want to swing trade long or short, I generally go by like an 80 delta, which is in the money. And I've just found in my experience that that's a good trade-off of getting the return that you want as the stock moves in your favor, which offsets the time decay that hurts option buyers. So whenever you buy an option, the premium is a time-wasting asset. So it's decaying day by day into expiration. And that, as you'll see, is the big benefit of selling them. This is a put side. I buy a put. I have a directional bias that the stock or ETF is going lower. So that's put selling right here. So I'm buying the right to sell stock on or before expiration at an agreed upon strike price. So as the stock goes lower, the value of this put is going up in value. And that's how I make my directional gains on options. Like with any trade, it's the difference between your closing price and your cost basis. These are just examples of patterns that we trade. All 9 of these are bullish. There's many more, but this is just a beautiful slide. You got a buy setup, you got a 3-bar reversal, 2-bar reversal, big red bar followed by a big green bar. We call that a bull 180. We use some terminology just to speed up the conversation. But we don't care the words. There's books out there that just focus on the names of candlesticks without putting them into the context of the pattern, which is meaningless. Call it whatever you want. we put that here. Call this whatever you want. It's a reversal. It went down and it came back up. Doesn't mean to buy it. Remember my first slide? It means, okay, I got a reversal. That's just a concept. A trading strategy is putting all the concepts together, and then position sizing and management, et cetera. So if this was a downside shakeout, like over here, if this one sucked everybody in and then snapped right back, and I have a price void, which means insignificant resistance to the left, now I got a pattern to trade. This is one of my favorites, the bull 1, 2, 3 continuation. I can teach an 8-year-old this pattern in about 10 minutes. It's a wide range bar with little or no tails. What's a big bar, Dan? Just visually look to the left and see if it's a whole lot bigger than all the ones to the left. That's a bullish wide range bar. I want that bar from consolidation. I want an inside bar in the upper third. One or more, you buy over the high, stop under the low, manage in between. Today we'll be talking about options. So that would be a pattern to buy calls, call spreads, calendar spreads, and to sell out of the money puts or put spreads under the big bar. Same with this. I got a double bottom. I got a momentum move down, retraces less than a third, and there's some type of reversal at or near the prior low. Need a potent reversal. We've been trading these over the last 2 weeks with, like, just because they've been all over the place. All right, let's look for, start looking at some charts here. Let me give you just an example here, a visual. We're going to come back to this with many examples after we get through some directionals. But this is the beautiful thing of selling options. All I'm doing is looking for turns. I would never trade this as a directional. This is a friggin' mess. But when this gap down to this breakout area, minor support, and closed with a bullish engulfing range expansion bar, I don't think that's telling me, and then the next day I do it over this bar's high, that's my support level. If I sell a naked put, that's the first green line. If I decide to do a put spread, I take some of the money, buy further out of the money put to limit my loss and buying power requirement at the brokerage firm. The money you received is your potential profit. And you keep that money as long as it stays above this green line by expiration. That's the simplest strategy that I can teach. But notice how we do it with a technical bias. And here's the opposite. Small little M top with a breakout failure. This is a picture of a void. Like I said, it's a momentum move. So once this breaks this support, there's nothing significant to the left to permit a move lower. So I sell on out of the money call or call spread. That's simple. But the beauty of this is you win 2 out of 3 directions. So a stock can only go up, down, or sideways, correct? Correct. Pretty simple. So if I sell this put spread, or right here, this put, I'm going to profit if the stock goes up. I'm going to profit if it goes sideways. And I'm going to profit even if it goes down, as long as it doesn't go below my cost basis, which is my break-even point at expiration. So this is a higher probability trade. Now, the downside is your premium is your max, premium received is your max potential gain. So if this thing just hypothetically rallies $30, well, your gain's limited to the premium, because eyeballing this, let's call it $5 wide. I like to take in minimum 10% times the position size, and then you can do the math. But the odds are stacked in my favor. This illustrates that last point that I just said. And this was an actual email from one of our subscribers, Roger. I still made money and the stock went against me. That's right. And not every time, because if the thing goes against you in a violent manner, as soon as you put it on, then you're going to lose money. But at expiration, and it goes slowly against you, it's great. You know, you can read this, but you know, Greg and I have literally thousands of testimonials, and that's one of the reasons we do what we do. Some people say, oh, you know, anybody who educates, you know, doesn't know what they're talking about. Well, we've been doing it 30 years, number one, and that's a testament. If you can stay in business that long and have this many customers and testimonials, but it keeps us sharper. Because if we didn't have customers in a business that we're interacting with, then yeah, I still wake up. I get 6 screens here at my house. I trade every day, but it's a responsibility to stay more focused. We love getting these testimonials to change people's lives. Do you know how many people we get that say, OMG, I wish I found you guys before? I have this slide in one of my courses. It's the 4 stages of learning and psychological. And the first stage is unconscious incompetence. And you know, we had a lot of that in the COVID days. People out of work saying, "Oh, well, let me go give it a stab in this market. I had buy a call," or you know, the Robin Hood people. And you know, the coin people, and you know, they don't know what they're doing, and then they come to us when they get to the conscious incompetence stage. That means, you know what, I've been beat up, I'm humiliated, I've lost money, I need to learn the proper way. And then you know, you got 2 more levels, and the goal is to get to unconscious competence, where you're like, you don't even think about it. It's flawless. You know what you're doing. All right, let's go. So here's a daily chart. Look how simple all of our daily charts are. Red and green candlesticks, color-coded volume. The blue is 20, green 50, red 200. So it just it speeds up the analysis, as we say. So I mentioned on the first slide, moving averages and volume are secondary. Why? Because I can make the same decisions without them. But I can take these candlesticks off, and the moving averages, me seeing the relationship of them and the distance between them and the angle of them, I can get a fairly good idea of what's going on under the hood. But we don't trade moving averages. We trade patterns and candlesticks. So this broke out, traded over, and these red dots, by the way, and blue dots, nothing proprietary. I told you we don't do that. A major pivot low, the blue dot, is 3 or more higher lows to the left and the right. And the computer just puts a blue dot there, nothing magical. And it helps visualize trends, because an uptrend is 2 or more higher pivot highs, higher pivot lows. Simple. 8-year-old can understand that. Reverse for the downside. So this took out 2 prior pivot highs above all 3 moving averages, deep retracement. Still, I got no directional trade yet. Gaps to resistance, and this is what we call bullish price action. There's no trade here yet, but now I have a breakout. You could do 2 trades on this, because it qualifies for both. It qualifies for a directional trade now. In this example, we bought, remember I told you I like buying in the money, because it reduces the extrinsic value of that call option, and I get a higher delta, which means, again, I'm throwing so much at you all. And I know it's a double-edged sword, because I'm wanting I'm wanting to give you so much information. That's just my nature. But I also don't want it to be a disservice to complicate things and frustrate you of not seeing the beauty and simplicity of our approach. So we bought the in the money calls, benefit of leverage, limited risk, and my original stops under here, and now I'm in trail mode. This, remember I said every directional pattern is also a candidate for a put spread. So I have a checklist for selling options and spreads. Number one has to be liquid. If it's not liquid, just move on. The options. I have to get adequate premium for the risk I'm taking for the days to expiration, which we get into in the course, obviously, and there has to be no pending news. We did a $10 wide put spread and full profit as long as it stays above that green line. Pretty simple. Here's another one. This is what we call a master trader buy setup. On the slide of the 9 bullish patterns, it was the one on the upper left. Again, I use little 8-year-old little Johnny because they're so easy to teach. What's a buy setup, Dan? Johnny? It is, look, we're looking for pictures of buying here on support in an uptrend. So it's in an uptrend. I'm looking for a fluid retracement. And I'm looking for pictures of buying. These two have the identical message, but they just, the bars set up differently. It's on minor support. This prior breakout area is minor support. I got my turn here. It's also at the 20 MA. Here's some 50s. I got a nice uptrend here, the 20 comfortably above and rising above the 50. So you could have bought a call option for a 2 to 3 day pop. So this one, we bought the $14 calls in the money, and that's exactly what we did, 2 days. And then this would also be a candidate for a put spread. So I would go to the option table and say I call it juice. Juice is premium. It's like, look, if I'm selling options, I'm taking risk, correct? Isn't this what an insurance company does, you all, selling options? They're selling you an insurance policy, and they're taking in money, and they're assuming an obligation to make you whole under the policy if your car blows up or a house catches on fire. So if I'm going to sell a $15 put, which obligates me to buy the stock at $15 a share on or before expiration, whoa, what's my policy premium? What are you going to pay me to take that risk? And then that's what I'd be looking to do on a put spread. Look, this is a mess. We don't trade messes. Here, this engulfing right here, this one I would have sold a put spread actually. But let's focus on directionals now because I got many examples of put spreads because they're so easy. We in fact, so we have 3 advisory letters at Master Trader. We got the swinging options where we buy and sell calls and puts. We have just an ETF letter for longer term trading, and we have what's called a weekly options trader, where all it does is sell options and spreads for weekly income based on these patterns. So this would be in the advisory letter. So here, look, we look for a tell of when we're ready to act. We're gathering information, nothing to do yet. Look, this broke out, got rejected, 2 topping tails. Here we go. This one traded under a prior bar, wide range closing breakout from a multi-month consolidation above all the MAs, and I have a price for it. I expect this to get through these pivots based on this overall price action. Now I have an inside bar. I'm buying over the high of these bars. In this example, we bought the 43.5 calls in the money. Look, we bought over here in the money. We did them this and, made just go into management mode. So we went into trail mode. Bullish 1, 2, 3. This is a bull, another bull 1, 2, 3. So remember what I said earlier? I want a wide range bar from consolidation and not far from the 20. That says Jerry raised his hand. Jerry, can you type your questions out here? Because let's see, I don't know where to look at raising hands. Sorry. If you can type it, I'll be happy to answer. So this is a picture perfect. I want a wide range bar from consolidation, not far from the 20. I want 1 or 2 inside bars that stay in the upper third. I want a price void, which means look to the left. And this came down in a nice fluid manner. And there you go. I'm buying. So look, I showed you this on purpose. Some people, and there's another myth. Some people say, oh, and there's so many myths out there. We don't have time to talk about them. But another one is, oh, don't buy stocks under $5. And I'm like, well, why not? Put tape over the price then. Put tape over it. This is a pattern. Blasted up here, consolidating, broke out, pullback. I don't care what this is, what time frame. That is a high probability trade. We bought in the money, 1.5 calls, $900 gain, just going in a trail mode. Intraday, we buy options if they're liquid, but I call them the 4 horsemen, the spiders, Qs, diamonds, IWM. For some stupid reason, diamonds don't have 0 DTE during the week. I have no freaking idea why. So nothing I can do about it. So we have 0 DTEs for both selling options, and we buy 0 DTE directional trades. That's another myth. Some people say, do not ever buy options that expire in less than 45 days. And I'm like, oh, why? The only reason you would say that is if you don't understand what you're talking about. And if you don't understand technical analysis, we're buying in the money calls. So the time decay, we're only spending a few pennies on extrinsic value. But look at the power of this setup. So this is the spiders. Look at the time of day here, 3:30. Well, I'm helping, it's not so obvious, but 1 p.m., 2, 3. And these are actually the prices of these options that we bought. We bought the in the money, 261. Well, actually, this one we bought out of the money because they were so cheap and we expected a big move. So that this actually fit into the category of we are going to intelligently go for a home run. This is a bull 180, downside shakeout, snap right back. Look at this line here. This is a price void. There's nothing to the left. So that was such a high probability late day breakout trade. Could you buy the spiders? Of course you can. It's a high probability trade. But that's going to use a lot of buying power. So that's up to you. How many shares are you going to buy? 50, 100, 500? I don't know. Do the buying power. And I forget what we paid. Well, no, it's right here. What we paid, and you can see it went up 40%, our call options in that run. Let's now start in the remaining time, focus on selling options. You've seen patterns like this on the other slide, but I'm just giving you a different visual. So I want a bullish pattern. I want to have the confidence to say, I don't think it's going under that level. by expiration, you could sell a naked put, and that's fine. You're going to take in more premium, but you have a bigger loss if it goes against you, and you have higher buying power requirements at the brokerage firm. Or you can take some of that money and buy a further out of the money put. The difference is the net credit received, and then you manage in between. Examples. I have thousands of examples, so we'll just go through as many as we can here in the next 20 minutes. This is another mess. Remember I in the word the tail that I said we look for, it's kind of a poker analogy. And I don't play poker, but it makes sense. It's like, okay, you know, they're gathering data, they're looking at cards, they're watching other people, and then one of the players in his head says, "Gotcha. I now have the confidence. I'm ready to play my hand more aggressively." This is the tell on this one. We've already rolled over. Look at my 20 and 50. Remember I said a visual aid? So it's a big wide trading range that has rolled over. This topping tail was a big green bar at the day's high. The sellers took control, slammed it back down, closed relatively flat. Here, once it started moving lower, I'm like, this ain't going back above this red line here, and however many days this trade was, I forget. So we sold the 1230. It's an expensive stock. Might even been something like Amazon pre-split. Who cares what it is? And then we buy a further out of the one. So we did a $10 wide. We took in $650 selling a 10 lot in 2 days. Take your money. So we're just managing in between. So we use the charts. So when this thing catapulted in 2 days, we're not at full profit. We're not at full profit until expiration. But let's say we're at 80, 90% of full profit. Take it, move on to the next trade. And that's how we manage these. We all three of our advisory letters have their own Telegram channel where we send alerts and charts and lessons out throughout the day. When we see them, we send trade adjustments. And so we're constantly, from beginning of the trade to end, we are in communication with you, and we track it in the members area with an open and closed spreadsheet. We show all opens, all closed. We don't hide anything, and we're very, very transparent of our teachings and management and answering questions. Here we go again. You know, it broke down. Look at my moving averages, they're downtrending. Tried to break out, failed. This could have been a directional trade also, where I would have looked to buy puts. But the easier trade is to say that ain't going up here to $95 strike in X number of days. You know, and okay, so I'm writing it out here. So this was a 4 DTE call spread. Sell the 95, bought the 98s, $3 wide, make it 650 bucks just by calling a short-term top. You see how simple this is in our methodology of how we approach these? It's an amazing strategy. Like if you went, you know, I kind of, you know, I like using silly analogies. If you went to this and to Wynn Hotel, and one guy on the left is just buying and selling stock, and I say, hey, where's the booth to say I want to collect money just by predicting that a stock's not going to go above $95? He's going to scratch his head and say, dude, you're in the wrong place. We don't have that game here. But in the stock market, with selling options, you do. You've heard me mention the green room a couple times. And I'm doing my best to power pack you with education and show you charts. Of course, we stop out. I'm showing you the many good ones for illustration, but if we have our stop and if it trades above the stop, then we exit the trade, whether it's a gain or loss. Here's where you see us work in real time. mastertrader.com/green trial. Spend an entire week with us, $7. We start at 9 a.m. We do market prep, Greg and I, and we even put it on YouTube from 9 to 9:30 Eastern time. Check us out there and you watch us walk the talk. So I'm not just pointing the slides here, we're scanning. I get many great trades from subscribers, which I love because that's an illustration of them successfully following the method. In fact, ADM, I was just thanking John in our room. We're long ADM from yesterday, and it's flying. Uptrend, nasty red bar suggested lower prices. It gapped up. So it's a 3-bar reversal at the 50 MA with a void. Once it traded over the high of this red bar, I said, it ain't going down here. Sold a put spread, went up, took our money, $800 as long as it stays above the short strike. Broke out all the way back down. So that's a breakout failure. Now, little sell setup, bear flag, call it whatever you want. Now I have a range expansion engulfing bar. The odds are overwhelming that the next day when it trades under this bar's low, it's not going above this red bar for a couple days. What did we do here? 2-day call spread. Probably sold the 55, 55, 58, something like that. This one, Greg likes to say same but different. And it's true that, we teach you how to read price action. And again, putting in the context of the trend, support and resistance, multiple time frames, similar to a professional poker player, again, which is not me, but the cards that are dealt to that player, he or she has the experience and knowledge to know how to react to that. And we are the same. So look at this topping tail. That's a false breakout. This is bearish price action. This is a bearish engulfing bar closing breakdown in a downtrend. And that has a void. Yeah, you might say, well, Dan, what about this? There's always something to the left unless it's like an IPO going to all-time highs. The amount of bars here closing breakdown, I have 95% confidence it's going to continue lower. And this one little bar is a twig compared to this bearish 2.5-week consolidation and a downtrend. You see that? So I would buy a put. I'd buy an in the money put, maybe a put spread, which lowers the cost of your put spread compared to just buying puts alone. And I'd be selling an out of the money call spread. You see, we spent 45 minutes together, folks. I hope you've learned so much in this short time frame. This is a big W bottom. Look, it's a little new low reversal. Look, these bars going sideways is telling us demand has stabilized this fall. This was a closing breakout. The next day, we shorted a 4 DTE put spread, 1095, 1090. For 70 cents a share, depending on how many contracts. One contract is $70, 10 is $700. big old W bottom, same. You know, this one I wouldn't even consider directional, but look at this stabilization and bullish price action. Closing breakout, topping tail at resistance, bottoming tail there over the high of this bar. I'm willing to sell a put spread. Now remember, my stop's under here. So it could the very next day on news stop me out. I said I'd take stops. We have 85% success rate, not 100. You know, been in a big trend here, kind of an retest and reversal. Sold out of the money call spread, closed half at 40% of max profit in one day. So on this, we put on the trade here. So the very next day, we've made 40% of our money. So again, another analogy. What if you're an insurance company and they sell you a 6-month car policy? Could you imagine how happy they would be if they were able to close that policy at 40% of their max gain in one day? Well, that's what we do here using the charts and volatility contraction. And when the stock moves in the intended direction. All right, so yeah, that's where we did it right there. You know, same, right? So this one I would not buy a put. Why? Because I don't have a clear void. But it's a great example of, look, little breakout failure. I'm in a downtrend, engulfing closing 3-bar breakdown. The very next day, I'm selling it out of the money. A call spread, I got 4 days to expiration, and I manage in between. Rinse and repeat, rinse and repeat. It's the same. This is a mess. Here, even though I didn't do it on this one, over the high of this bar, I would be looking to sell puts here. Put spread, puts or put spread, that's up to you. It broke out. Bullish price action going sideways. Over the high of this bar. This is the one we did, $5 Y. So this is actually how our closing trades look like in the members area. So it shows you, and I chopped off the part about the date and the symbol and so forth. It gives you the complete history of what we did. And every one of our trades gives you the technical reason. Breakout to all-time highs. So that was right there. Closed half at 24 cents, bid 2 cents for the back half. I'm always sending these out, tighten stops. And in our spreadsheet, we calculate position size off a max loss of $300. And so that's why, you know, this might sound like a low number, but it's because we had very few contracts. I would have to go and see how many, but probably only had, well, if we took in 52 cents, probably only had 5 contracts. Look, sloppy. I wouldn't directional this. I wouldn't, but I would sell a put. So this came in a very sloppy way. It's a big old bottoming pattern. Red bar ignored, moved up, sell a put under this week's low. Buy setup and reversal at the 20 and the 50. Here's my initial stop under the short strike of 155. Close for 4 pennies, take your money. So we sold it at 30. So that one, I would do 10 contracts because we have a 1-to-1 stop. So if I sell it at 30 and I have a $300 max loss, then that's $300. So I can do 10 contracts, right? And then we closed it at 4 pennies, which is why this reflects we made 260 in 3 days on that trade. Moved up, bullish price action. This was actually one I showed you earlier that we did a directional. So we've talked about this. We did a put spread, also the same pattern. Came in ugly way, ugly manner. It moved up, but I wouldn't have bought a directional on this. But this range expansion, notice the tail traded under these two prior bars lows. So we call that a correction bar. And what does range expansion mean? Simple. It means the range of the bar expanded relative to a bunch of other ones. So this was narrow, 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 and now correction bar, range expansion, closing breakout. I'm now willing to sell a put spread under this bar's low. So in this one, we actually did just a $2 wide. $2 wide put spread, took in 25 cents. So using my math in my head of $300 a share maximum loss, I would have done 12 contracts on that. If your max loss was $300 at 1-to-1. All right, let me just show you zero DTE, which I love here in the next couple of minutes. We only have 5 minutes left. You've already learned it, selling puts and calls, but this is doing it on zero DTE. So every time I see an intraday turning point that I feel comfortable that that's a high or low for the day, I go to the option table and see what I'm going to get paid. It's that easy on zero DTE, folks. All right, so this one, it probably was earnings, it gapped down. We did a zero DTE right here, the 420s. This one, there's no pattern to swing this whatsoever, but this was an excessive gap on earnings. And then we dropped down to the smaller time frame. But look, it gapped up, big old topping tail, lower low, lower high, and then we're selling way out of the money. Look at this, folks. So let's say I determined to put this on around 650. I sold a call $70 higher. And then I'm, $10 wide, so I didn't do it naked. Took in 60 cents a share. That premium is just melting like an ice cube. And when you do them on earnings stocks, you also get the benefit of volatility contraction. So my melting ice cube is melting rapidly for two reasons. Number one, the stock's moving in the intended direction, which is away from the short strike. And number two, if it's a news type of thing like earnings, you're getting massive volatility contraction. So that allows you, most of the times, unless it goes against you, it allows you to make like 50% of the max gain in a very short time frame. Just another example here. This is the daily, so it had a bearish gap on the daily. 15-minute chart is a microscope of the daily. And look at this. You can see the gap down here. Look at this price void. So when it took out a 5, 10, 15-minute low, we're selling look up here. Look at the 540s. Once this takes out a 15-minute bars low, the odds of it going back there are staggeringly high. This on spiders here, 15-minute chart, we sell zero DTEs all the time. This is a guy who's been with us for a long time. Let me show you his picture first. I call him McGraw because in the room, he's so funny. Whenever he would hear my tonality, it's like, oh, nice. And then boom, he'll get in the trade, but he's a very active trader. And look, he trades the big contract zero DTE. He's an expert in doing this. Paul Inglis, I call him McGraw. And he's been trading 25, 30 years also. Look, I've had a much higher percent with MT. And look, I love this. This old dog has learned some new tricks. Look, he takes losses, but look, 97% on the big contract. And, these are just some of the thousands of testimonials we have on the credit spreads. All right, so here's the deal we have for you. It's an amazing course I put together with Greg. So remember I mentioned we have a directional course where it's all about our technical approach, the different strategies of buying call and put options, spreads, etc., with a directional bias. And this one here is the mastering advanced credit spread course, which is what we spent a lot of time on today, talking about selling options around the patterns. It's going to include our top-down trading course, how the stock market works, and options kickstart course, 1 month of the weekly options trader, where you'll get all these trades, tracking sheet, telegram. You get lifetime coaching. You'll get Greg scans. Some people sell their scans $5,000. Greg's are worth more than that. I can promise you that. Add all that up, 1,600. Here you get $645,000 off. And then there's an option if you want to buy the directional course, 50% off. Fausto gave you the link right there, mastertrader.com/options package. Hope you enjoyed it. Feel free to email me, Dan@mastertrader.com, and come see us in the green room also, and you'll watch us walk the talk. Good trading, everyone.
Dan, thanks a lot for being here. And let me tell you, some of the option plays, just let everybody know that that Dan was talking about. I'm actually one of the favorites of those. I love to sell options and buy options. It's always nice to accept rent, then try to, then make the rent. So good way of doing it. So thanks everybody taking on his offer. And I'd like to thank Master Trade for being here. But I want to bring in our next guest, and it's our last guest of the day. So we have Jason Bonder here from the Money Flows, and it's the first time he's going to be on our Cyber Expo, but he was on my podcast. And, I thought we had such a great conversation of all the things that he was talking about. I loved his background. He was director of European equities of Candace Fitzgerald in the European in London. He's been of North America there. And it was a lot of good stuff, a lot of little synergy. I thought that he could bring to the table. He's also, like I said, he's a co-founder of the Money Flows, where they do more of a research firm that focuses on unusual institutional trading activity, which I think everyone would like to know a little about that. He reaches over about tens of thousands of traders and investors each week. So first, hopefully you can make some of you to be part of that group. So without further ado, let me pass it over to Jason. And Jason, thanks for being here. Everybody enjoy the show.
Excellent. Hopefully everyone can hear me, see me, although I'm not going to be on camera that much, but thank you for having me. Pleased to be here today. I'm sure it's been a long day, so hopefully I'm not putting you to sleep at this late hour here, but I'm going to go ahead and share my screen. We'll get a PowerPoint going, and I'm going to share the entire screen so I can jump back and forth, because this is our portal system, which basically shows you all the money flows. So we'll jump back into that in a little bit. Let me try and clean up my screen here, move over to the PowerPoint, and here we go. Play from the beginning. Okay, so today we're going to be talking about how we use money flows to spot trends and oversold buy signals. Really, this was a bit of an aha. I'm going to put a disclaimer on here for your own guide. I'm not a registered financial advisor. I don't dispense independent financial advice, etc. The lawyers make me say it, so there you go. We're moving on. Okay, so if you're at all interested in unusual money flows, how it moves markets, how it helps us pick stocks and trade setups, you can sign up for our free newsletter. You don't have to buy anything. And as a part of that, so it's here at the Money Flows website, moneyflows.com/free sign up. We will also, for signing up, give you our market outlook 2026 report, as well as 4 weekly stock picks. So we're going to give you one each week for a month. Usually that stuff is behind the paywall. Also, as an additional bonus, you will get the best gold ETF to buy now. Obviously, gold has been on fire for the better part of a year. We're still bullish on gold. I'll show you why. And this is a special report that helps you do that. So if you have your phones and you want to take a QR code, that'll take you right to the website. Otherwise, it was, as I mentioned, moneyflows.com/free sign up. So with that out of the way, why should you listen to me? What do I do? So that's me in my younger, better looking years, and I am a quantitative stock analyst. I started my career in 2001 at Cantor Fitzgerald just before 9/11. Fortunately, I was not there in New York. I had started in New York in July of 2001 and was transferred to London. I moved back to New York. I helped rebuild the US business where Cantor Fitzgerald lost 658 employees, including the 14 other people on my trading desk that I was there. Only one survived. He was taking his kid to school, thank God. And then I went back to Europe and built a pan-European business. So I have been trading options, listed and over-the-counter institutional options since 2001. While I was there, one of my clients asked me to monitor every single European stock in the market, 2,800 at the time, and he wanted me to tell him when trades of 5 million euros or more took place. I couldn't do it. I started programming computers to do it for me, and that's when I started to notice when I isolated these trades, there were certain patterns that would emerge and price action that were kind of like clockwork. So that's what I sort of morphed into, and that's what Money Flows does. We use Money Flows to identify asymmetrical payoffs, high probability trades. And this works for both long-term investors like myself. I hold stocks for years. It works for swing traders, people with a 1 month time frame, 1 week time frame. Even day traders can use our signals as reversions sometimes, which I'll get into in a couple of minutes. So what is Money Flows? We map what we call big money. That's huge institutional investors moving unusual amounts of money. I'm just looking for there we go. And basically I handle the largest accounts on planet Earth. We're talking about $1 trillion pension funds, multi-billion-dollar asset managers, hedge funds, proprietary desks at banks, etc. So these are those huge accounts moving money in and out of stocks and ETFs. This is all based on data science, our best guess about where this big money is flowing. It's not emotional. It's not a feeling I get in my knees. We run very robust models every day using close-on-close data on over 5,500 US stocks. We have an excellent track record going back since 1990, a 35-year data set that essentially says our stock picks win about 70% of the time, winners larger than losses, and typical outperformance of the market. Now, based on our previous speaker, who's applying options in a way where he's achieving a 97, 99% win rate, imagine applying that to a high probability source of data such as this. So when we're looking to identify when those big accounts are moving money in and out, that's where we come in. That's Money Flows. What we do is not really visible on a regular chart. This is a chart of the SPY. You got, where do we go? Our little laser pointer here. You got your blue area chart. That's the Spider ETF, S&P 500 Spider ETF. Now, if I look at what we do, it doesn't look like much. What you're looking at is a bunch of green and red bars, which are the cumulative unusual inflows and outflows on the S&P 500, or for that matter, the broader market of 5,500 stocks that we monitor every single day. These are how many see unusual inflows and outflows. As you can see, this very last reading was a couple of days ago. When I did these slides, we saw an uptick in outflows expected given the current market volatility. But this is what happens when you overlay it against the S&P chart. It kind of snaps into focus like an X-ray or an MRI. You can see back here, that was Liberation Day, extreme volatility. Everybody was throwing out the baby with the bathwater. And we have a powerful indicator, which I will show you shortly, that we were all in on the buy side and shooting out lists of high quality stocks for our clients to consider on their buy list. So that's what it looks like what we do. This works on a single stock basis. Here you're looking at a chart of Seagate Technology Holdings. And if I overlay the unusual inflows, it's clear as day. So each green bar here is when we believe there is unusual institutional accumulation. So what is that? That's when people are buying stock, they're lifting it outside of their normal price range, above average volume, above average volatility. We have multiple different timeframes that we measure for violations of these, and you can see the power of what we call the stairway to heaven. When you get a bunch of red and it's going down, that's the highway to hell. But clearly, institutional money flows are moving markets. There's one very key statistic that I want you all to take note of. Both Morgan Stanley and JP Morgan independently arrived at the conclusion that between 70 and 90% of all daily volume on the aggregate stock exchanges, especially in the US, are institutional. And of that 70 to 90% of volume that's institutional, probably 80 to 90% of that is algorithmic. So if we flip it on its ear, if you're not paying attention to what institutions are doing, you're effectively leaving out 90% of the market. So this particular stock, we saw since our first inflow signal appeared in May, a 300% rally. Now, Seagate Technologies had a lot of tailwinds because it's part of that memory shortage, the DRAM and RAM story in semiconductors. But that story didn't really start hitting the tape until November, December even. So we saw buyers positioning early. And that's a very key component of what we do here, right? If you were a multi-billion-dollar hedge fund and you wanted to build a position in a semiconductor stock, you wouldn't go tell the street and you wouldn't go up on CNBC before you bought the stock, right? You would buy it first, and then you'd tell everyone what a great buy it is and watch as the stock rallied higher. And this was a realization that came to me when I actually handled a trade for a multi-billion-dollar fund. At the time, it was Carl Icahn. We handled a huge acquisition in stock when I was working at Jefferies, the investment bank. And the next day he came up on TV. He was interviewed on CNBC. He was very happy. He was smiling. I saw the ticker of the stock. It was up 2.5%. And he was basically telling the world how he had just accumulated the stock and the world was buying the stock, lifting it higher. So nobody is telling you before the fact. You're always going to find out after the fact. We are all about finding out on the close of business each day what dramatic volume and volatility violations have taken place and how that can equal high probability trades. All right, so this is a concept for stocks that we are always looking for the outliers. I'm a hockey guy. Hopefully some of you watched the USA Olympic hockey game. It was awesome. I was on a plane and I yelled and woke up the woman next to me. But here you're looking at a graph of 500 of the all-time highest scoring players in terms of points. So all of these 500 players, the thousands over the 100 years the game has been played, are all below them. These are the 500 best. These are the outliers. In statistics, usually when you get an outlier, you throw it out, right? You're measuring the heights of people. You got 100 people in a room. Most of them are between the heights of 5'6" and say 6 foot. But you have one guy who's 7'4". You're going to throw him out because he skews the data, but that is an outlier. In the stock world, we're looking for the outliers. This right here, in terms of hockey, is the biggest outlier of all time. He's the Tom Brady of hockey. He's the LeBron James, the Michael Jordan. He is Wayne Gretzky. So we are looking for the Wayne Gretzkys of stocks, the Warren Buffetts, the Elon Musks, the Jeff Bezos. That is what we're looking for on a daily basis. However, we also look for stocks on the short side, the weakest. We're focused on the tails. If you remember in high school, the bell curve, you had a big chunk in the middle, and then things flattened out and it looked like a bell. We're looking at the tails. We let CNBC and everybody else focus on the middle stuff. Okay, so why is this concept interesting? Well, I had a hunch years ago that only a select few numbers of stocks can really power a portfolio higher. And anybody who's held NVIDIA in their portfolio for the past 10 years knows exactly what I'm talking about. I'm sure a lot of you have experienced it. Even in the traders, the short-term traders, you can get one massive win that sort of carries your week. Now, a professor, Hendrik Bessenbinder of Arizona State University, asked a very simple question in 2018: do stocks outperform treasury bills? Basically, are stocks better than bonds? And usually when I'm in front of a room of a bunch of people, I ask the question, I get a bunch of hands that say stocks are better than bonds. And yes, over 100 years, they are. But what he found was fascinating. I'm going to blow this up so you can see it. Over 100 years, since 1926, the best performing 4% of stocks accounted for the entire gain of stocks above bonds. I mean, that statistic in alone just tells you everything you know. Like, put another way, 96% of stocks are a waste of your time if you want to beat the market. So yes, stocks are better than bonds for 100 years, but you got to be fishing in a very small pond. And that is what we focus on. So this is the aha trade that made it happen for me. It all clicked into place. I received an order from a friend at a bank one day, at a competing bank. He called me up. I was running the trading desk at Cantor Fitzgerald at the time. I had 14 derivatives traders working for me. I got a call from a swaps desk. He wanted to buy stock. He told me, Jason, I heard you're active in JCPenney. Will you buy some stock for me? I bought about $20 million worth of stock that day. It was a great order. I felt good. I had this order every single day for an entire month. Between myself and two other competing brokers, we bought about 13.8% of the float of JCPenney. Personally, in my own hands, $638 million passed. I acquired a truckload of stock. The stock went straight up. Okay, you can see that volume blast here over the course of that month. And CNBC was coming out with all sorts of stories. There were stories on Bloomberg. Nobody knew why the stock was going up. The order just stopped. We got no more shares to buy. Stocks started to fall off because the buying pressure was gone. And lo and behold, 5 days later on Bloomberg, they released a story that Bill Ackman had acquired 13.5% or 13.8% of JCPenney. The activist hedge fund manager with the beautiful silver hair, icy blue eyes. If you remember, he was the guy crying on TV during COVID. My dad's sick. Trump, you got to do something. And then he was quietly buying hotel stocks on the side, Marriott. So very smart guy. We thought he knew what he was doing. What it turns out is that JCPenney was a total dog. It went down 90% over the next 2 years because it had horrific fundamentals. It was losing money, increasing debt. Sales were going negative. They were just doing everything wrong. But this was a great story of what it means when unusual institutional accumulation pressure just puts a lot of pressure on a stock, regardless of the fundamentals. So these are some additional slides. Again, it's not really visible in a chart. If you wanted to approximate it yourself, if you didn't become a client of Money Flows, that's totally fine by me. You would be looking for stuff like huge volume spikes, stocks gapping up. You know, this is good indication, obviously, of an unusual institutional accumulation. We tend to get there a little faster because I know what to look for because of that order I just explained to you about. But this is a good guide to do it on your own. Now, looking back over here, super micro, to my point, you saw a little volume spike here in January of 2023. January of 2024, you saw a massive volume spike. This is when it appeared on our top 20 report in July of 2022. So by using our algorithmic approach of identifying unusual money flows, in the depths of the bear market of 2022, we saw buying of this cloud computing company, and the stock was $61. And obviously it peaked up here at $1,200. I'm not saying we nailed the high or anything like that, but look, we're looking for the big middle meat of the move, 60 to 70% of the move. I mean, that's a colossal win. These are longer term trades, but again, this works for shorter term trades. I'm just going to go over a couple of fundamentals, key fundamentals that we look for in our stocks. I'm sure some of you traders are totally agnostic about fundamentals. You just care about price action or chart direction. But when it comes to seeding your portfolio for long-term holdings, I suggest you look at the quality of a business over time. We typically are looking at fundamentals for companies that blow away sales and earnings estimates by wide margins, blowout numbers, companies that just surprise the street, and then they issue strong guidance. That's a great trifecta. That means most of Wall Street is offsides, and you're going to tell me, hey, I should have been in that trade before the move. But as a matter of fact, what happens is you have a higher probability of a trend reversal, a longer-term bullish trend, people caught off sides. There might be a big gap higher that you missed, but I like playing, a 70 to 80% winning hand game. I'm looking for growing 1 year sales growth, growing 1 year earnings on a 3-year basis as well, sales and earnings growth. I'm looking for high profitability, and I'm looking for manageable debt levels. All this stuff happens algorithmically in our platform, and you get a score on each stock as well. So what I just talked about, prices gapping higher, that's actually a good thing. I'm not looking at it saying, oh man, I missed the setup. I'm saying, oh, I have a better chance of this going higher. I like to see that happen on above average volume and volatility. That's that green bar that I showed you on the chart. I'm looking for stocks trading near interim highs, because when you're trading at highs and you keep trading higher, it tends to keep going that way. Maybe you get a mean reversion for 1 or 2 days, and that's the day traders, and that's great. I'm looking for long-term profitability. I like stocks trading near their 52-week highs. I'm looking for institutional support. I love high short interest because many of you traders will recognize what a good short squeeze when you're on the long side can do for your account. And I like to see moving averages stacked, indicating an uptrend. This is from the long side. I want to see this stock performing really strong relative to its sector. Think NVIDIA relative to tech. It's leading, it's the nose of the dog, not the tail of the dog. So these are some of the bullet points that I'm looking for, and we have created a quantitative method for this. Someone raised their hand. I'm gonna try and get to questions towards the end. This is just, it works like a big funnel, right? We got 5,000 stocks going in. I'm looking at their mechanicals, like their technicals, how's it trading? I'm looking at their analytical, the fundamentals, the health of the business, and then I'm looking at the position. Are we seeing accumulation, distribution? That's what we're all about. So here is when that stock SMCI first appeared on our report in July of 2022. You can see it had a price of 61.09. Since then, our reports look way better. They don't look like an old Excel spreadsheet, but you can see here it was a new buy. And that was one of the top 20 stocks that week. And we had 1, 2, 3, 4, 5, 6, 7, 8 new buys. SMCI was one of them. And I already showed you how it crushed the market. Now, NVIDIA is a great example as well. This was picked in 2020 on our top 20 report back here. I personally bought it in 2017 when it also appeared on a 2020 report, but this just shows you the outperformance that we all know NVIDIA is. But this has been a mother outlier for us 5 times on our top 20 report. So what is the top 20 report? So each week we gather together all those green and red signals where stocks bought unusually or sold unusually. And then we look for the highest scoring stocks. We end up usually with about 500 stocks per week on this list. We remove duplicates because Microsoft can appear all 5 days. Remove duplicates. We get a list of about 300 stocks. We take the 20 top scoring stocks seeing unusual inflows, and that's how we get our outliers. And that's how we get our 70% win rate, obviously way better than 50-50. In Vegas, if you're doing 51%, you're running a casino. So, imagine applying a 70% win rate in stock picks. Yeah, that's our cute little arrow. I always forget it. Okay, so where are we going to find some opportunities today? At Money Flows, we do a lot of statistical analysis and regression studies, data studies, fancy way of saying we look through the data to find relationships that can be profitable exercises for traders and investors. So right now, as you all know, many of you who are traders love volatility. Volatile markets offer great trade setups using pivot, misspelled, I apologize, points around extremes. So the very first study I'm going to show you is, let me hop over to the portal for a moment. And hopefully you can see on your screen a chart of the S&P 500 tracking ETF, the SPY, that's the blue area. The amber line is our big money index. So switching over real quick, that same chart I just showed you, the greens and reds, if I take all of these on a 25-day moving average, that's what that amber line is. And I just want to make one thing clear. Okay, so look here. On February 26th, there were 110 inflows, 31 outflows. That's about an average day. Usually we get about 100, 150 signals a day. About 63% of them are buys or inflows. The rest are outflows. So it's rare on 5,500 stocks. We're talking about 100 stocks a day. It's a pretty rare event. When we take those rare events, we smooth them on the big money index, you get this amber line, which is basically telling you when money is flowing in or out of the market. Now, why this is very effective, I'm just going to go to the most obvious, which is COVID, and I'm going to show you what we saw during COVID. So the amber line is money moving into the market. Above this red line is overbought. So we said, hey, everybody, the market's overbought, but don't sell, because what matters is when we fall from overbought, which is right here. Overbought is 80%. On January 29th of 2020, we told our clients, it's time to lighten up risk. Money is coming out of the market. Despite that, we had a little dip in the S&P, and then it continued to rally up to February 20th, and all the while our amber line was falling. Then obviously the world collapsed. COVID came out. I can't tell you that I knew it was COVID. I wasn't writing, hey, there's a virus that's going to take out our portfolios and life as we know it. Somebody else did. The smart money did, and we follow that money. That's what this is all about. So obviously the market collapsed, and then we fell into our oversold zone. That's our strongest signal, folks. That's when we know, hey, it's time to start buying stocks. We'll tell you an average since the past 35 years, oversold conditions last about 21 trading days. This one was right on target. I called for the market low to be on March 24th. I called for it to be on March 20th. It was on March 23rd for the S&P. So I was off by a day. I apologize. And here's another reason. Obviously stocks rocketed, quantitative easing, unprecedented. Everybody knows that time. We went overbought for 87 trading days. So if you had sold your stocks the day we went overbought, you missed out on a 25% rally of the SPY. So it's important you pay attention to when it falls from overbought. So the whole point I just gave you this lesson was over here, if we're looking at a study of where we are in the market today, I went back in history and looked back since 1990, and I said, I want to see every time the market looked like this, what happens going forward. Well, 16 out of 16 times, stocks were higher 1 year later. Okay, for the day traders, that doesn't necessarily help you. For the people with a longer term horizon investing, that does. It's a great time to buy stocks. Basically, when the S&P 500 holds above its 200-day, so let's hope we stay there, and the big money index falls as fast as it's been falling, because I just showed you on that chart, it has fallen precipitously recently, indicating money's coming out of the market. This happened 16 times since 1990. 100% of the time, markets were higher later. And we're talking about the Gulf War, the mini correction of 97. We're talking about the Asian crisis, long-term capital management. Anyone remember that one? I do. We're talking about .com. We're talking about the financial crisis rally, flash crash, euro crisis, taper tantrum, the emerging market sell-off, China fears, Volmageddon. You remember when all those volatility products were exploding? Trade war, we have COVID in here. So these are not just one-off events. These are serious market pressure points. Markets were higher 100% of the time, an average of 22% 1 year later, 35 years. So this is very compelling data. These are the types of things. So if you're looking for mid to short-term setups, I still think it's a great time to buy stocks. We like the energy space. I'm going to go over some energy stocks that have been trending higher. Even day traders, these are stocks that, maybe gap up on the open. They close higher. Obviously, energy is a very volatile space. Oil is all over the place. But basically, we wanted to see what happens when, like the other day, the USO ETF, the US Oil Service Trust, jumps 12.9% in a day. What happens? Well, lo and behold, going back since our data began on this stuff, when USO jumps 12% or more in a session, 1 and 3 months later, that energy ETF is actually higher. And that obviously makes sense. Oil is spiking, the underlying commodity is expanding, people's profit margins are sudden windfall profits to oil stocks. 6 months later, it's actually a little bit lower, and that kind of makes sense. You would expect a resolution, lower oil prices, things coming back in line. What I did not expect is 12 and 24 months later, you're having massive gains in USO. Now, some of this was skewed a little bit by COVID data, but still, these are the types of studies where we find our opportunities. So I'm going to go over some energy opportunities with you in a moment. But further still, USO gained 36% in 6 days. A massive squeeze. Yes, of course, propagated by US invading Iran. You get similar returns here, right? 1 and 3 months, pretty reasonable returns. 6 months, a little bit lower, but golly, look at 12 and 24 months. And by the way, that's 100% of the time that it's higher, 12 and 24 months, using our data set. Again, our data goes back since 1990. USO has not been an ETF that long, but still. I'm going to jump over in a minute to some energy opportunities. I just wanted to discuss IGV. On February 23rd, I'm sure you all remember a report that came out that said software stocks are basically going to be rendered useless because Anthropic Claude is releasing this new update and it's coming for your jobs, your computers, your software, your mother, and everything else. It was a big, scary report. It was actually written by someone who was not really qualified to write the report, but that doesn't stop viral spreading. We came out, I was actually buying IGV for my kids in their accounts. And we came out with a study that said, hey, when 15% of the constituents of IGV, the software index, are only 15% or less or above their 200-day moving average, historically since 2006, this is a 20-year data set, including the great financial crisis, including COVID, including all these things, look at the returns. 63% of the time, 1 month later, IGV's up 3.7%. 61%, 3 months later, it's up 6.6%. 71% of the time, 6 months later, it's up 16%. And then, of course, looking at that, I'll skip right to 2 years later, 100% of the time, it's up an average of 69%. That was enough for me to buy IGV for my kids. And lo and behold, I'm going to say we were lucky to time the low, but we caught a 14% rise in the entire software index in just a few days. So I still see some very exciting software opportunities. I'll show you those in just a moment as well. And then I want to tell you about a reversion signal, because I'm telling you about all these long trades, but traders are going to ask me, hey, you know, what about stocks that go down? Well, this is another long trade, but it's using a signal to show when people are exiting out. And what this looks like, and I'll show you in a moment, I took out all the green bars. So you could imagine over here, I'm going to put my little pointer up again. Over here, you're going to see a ton of green bars when I show you in a minute. I took them out of this chart, and you can see each red bar, when people were puking out of NVIDIA, you had very short-term reversions higher for lasting a few days to a few weeks. Even these, you can see here that spike, that trough was followed by a little spike, etc. And this was over the past 2 years. And look here, just in November, you remember the November fears? That was also the AI bubble is slowing, etc. We had a big fat recovery. So these reversion signals on high quality stocks, and NVIDIA is one of our higher quality stocks, scoring with terrific fundamentals, growing sales, growing earnings, growing profit margins, etc. You can use that as a reversion signal. I went back and I studied it. I said, hey, since data began on NVIDIA for us, we were looking at data beginning, I believe it was in 2016, apologies. I went back and I looked for every one of those red signals we could find on NVIDIA. And it says every time institutional money has flooded out of NVIDIA at this pace, the stock recovered without a single exception over the past 2 years. So 36 outflows over the past 2 years. And since 2021, across 4 distinct episodes. So that was the 2021 correction, the 2022 bear market, which routed tech. We all remember that. That was painful. The 2023 AI hesitation and today's 2025 tariff meltdown. At every horizon beyond 3 months, the median forward return is strongly positive. The only 1 year loss, that's this one down here, this red one, came from the January 2022, right in the mush of the big market, the big bear market. It was ugly. But look at these returns. You know, 6 months later, it's hard to read. The average return was 45. The median return was 50%. It was up 65% of the time. 9 months later, 79% of the time, the stock was higher by an average of 102%. 88% of the time, a year later, it was up 128% average. And, 2 years, you would have made 550% on average. a 456% on the mean. So these are the types of opportunities we're seeing set up here. I'm going to switch over to my, hello, there we go. Switch over to the portal. Let's look at some opportunities. So I was telling you about the NVIDIA reversion. I just want to show you what that looks like. If we go in here and we look up NVIDIA in our portal, whoops, it would help if I wrote the right ticker. NVDA, let's try it a third time. Okay. This is what you see on every given stock. Look at this fundamental score, 87% out of 100. Very few stocks get that high. Technically, it's pretty midland. It's weak for NVIDIA. Obviously, stock has gone nowhere since August of last year. But again, let's look. If I put in 2024, those 2 years, remember, I showed you this chart, just those reds. Let's look what the inflows look like. You can see a clear pattern of a lift. So even after we get reds, we typically get some greens. This is when it appeared on the top 20, and you can see all the way down here. The first time it appeared on our outlier report, the stock's up 72,000%. You know, great. Theoretically, could you have nailed that? Yes, if you held from whenever it was 2002 till now. I personally held from 2017 till now. I'm sitting on about 6,500% gains. But I'm a long-term trader. So how do short-term traders use this? Again, you take away the inflows, you get a reversion in here. You can buy it for a swing trade, a one-day trade, a multi-day trade. You can sell puts, like our previous speaker was talking about. You can have quick reversion trades with high probabilities, you know, database signals. And this is not just price action. Like, you look at the fundamentals here, you can see we measure 1 year sales growth, 3 year sales growth. We measure 1 year estimated earnings growth, 3 year earnings growth, profit margins, debt to equity ratio. We look at the forward PE, market cap, etc. Over here, we measure all sorts of technicals. This is available on every single stock. So let's talk trade opportunities here. Recently, if I go into the sector flows and I look at what's been happening this month, it's going to be no surprise that it's been all energy stocks, right? So 35% of our unusual inflows are energy stocks. Out of 1,195 total signals, energy is the clear winner with the most inflows. It's the top ranked sector here as well. And we can literally go down, we can look at the stocks within the energy sector that's been showing us these inflows. So if I go back here and I look at the daily flows since March, and I isolate the energy sector here, we can see the top ranked energy stocks seeing inflows. So here's a great list to just start shopping. I can tell you one stock we really like is AROC. I should see it in here somewhere. And if I don't, I'll just go to it. Well, let's look at a FANG here, Diamondback Energy. We've seen a tremendous amount of inflows. And again, this all started in January, well before the Iran story. Energy was taking off, but we were right at the beginning of that move. It's recently a top 20 stock, which means it's got a great fundamental. Ideally, that number is all you need to know. But let's look at why. Growing sales and earnings growth. Okay, 3 years is not looking too good. But look at the 1 year estimated earnings growth. Obviously, with oil rocketing higher, earnings estimates are revising higher. This profit margin should be impacted as well. So it's got rock solid fundamentals, and we're seeing a strong technical surge. This is Saw last inflow signal 3 days ago. It's trading near its 12-week high, near its 52-week high. It's been only 2 days since its 52-week high. That trend looks set to continue as the Straits of Hormuz are all blocked off and effectively closed for the first time in decades. The stock's up 4.5% in a month. The last price is above their 50, 100, and 200-day moving averages, indicating an uptrend. So you see all these statistics here. Now, again, we like AROC is another stock you guys should look at. AROC, you're going to see a very similar profile. High fundamental score, upstream energy company, support activities for oil and gas operations. Look at those monster inflows. So let's say you missed the first inflow and you weren't paying attention and you waited for the next one. That stock was 28.97. We recently peaked at 37. So, I mean, what is that? North of a 30% gain in a couple of weeks. It's been a top 20 stock. Again, we can look at the fundamental. We're looking at the technicals here. Everything's super bullish. And some of you reversion traders might be like, it's got to come back to earth at some point. It will, but right now it looks set to go higher rather than lower. A great sales and earnings growth, estimated earnings growth, solid. 3-year earnings growth, 90%, profit margin of 21%. They have a lot of debt. That doesn't bother me as much in a falling rate environment, and I suspect we're going to get falling rates because don't forget, energy and food prices, even though they're going up, are not part of core inflation, and we have Kevin Warsh coming in as the new Fed chair, who is probably going to be cutting rates. This PE ratio is a very reasonable 18.4, so I am liking ArchRock. Now, I told you about IGV. We monitor ETF flows as well. So if I look back over here and we're still in March 2nd, I can tell you that we've seen a lot of equity outflows, not surprisingly, and we've seen a lot of fixed income outflows. Everything's flowing into energy, shocker, shocker, right? You can see those flows distributed by class, by region, by distribution. This is broad market equity seeing inflows, but high yield is seeing outflows. A lot of inflows into the volatility products, unsurprisingly, commodities, funds, etc. But what I wanted to show you was, and by the way, this is really popular for like advisory clients or registered investment advisors. We talked about IGV. And we talked about nailing the recent low. Well, I think it's got a lot of room to run. I personally think people are still going to do their taxes for Intuit. I don't think Claude is suddenly going to replace everybody's Microsoft Excel license. I think this is a place where the narrative just gets overheated and we see a massive technical distribution. Well, what you're looking at is a chart of IGV. This was the recent low that I showed you earlier. We had the 14% rise. These are the top holdings in terms of weight and score. We can scroll down here and look at the constituents of the ETF and look at it by weight. Microsoft is the highest weighted ETF. But over here, maybe we should look at it by fundamental score. And look at this, Freshworks. I don't really know the name that well. AppLovin is one of those names that have been beat to hell. It was Wall Street's darling last year, an 87.5 fundamental. I can go in and look at it. Pegasystems, another strong one. Palantir is in here. Fortinet, they're a cybersecurity firm. All these companies have been just beaten down, technically heavily sold. And I see a bunch of questions coming in. I'm going to stop in about 3 minutes and then we'll make sure we get time to get to questions. But what does that look like? Let's go back over here and just sort it for the strongest map score, which we're still seeing technical strength in in Adia. So these are the companies that were sort of spared, right? Ring, SCMR. But if we're going to look at the technically weakest ones, Sorry about that. I have hellhounds here. Forgive me. If we look at some of the technically weakest ones, Commvault, I don't really know that one. It doesn't have fundamentals that I'm looking here, but I would look for technically weak, fundamentally strong companies. This one, Agilysys, Salesforce is a good one. All these companies have been beaten down, but again, if we look by weight, I mean, Microsoft, I'm very comfortable owning it here short term, medium term, and long term. So we can do this for every ETF. Let's go back and look at USO. I was highlighting that one, right? This one might not have oil stocks because it's tracking oil. So let's look at XLE. Let's look at the constituents in XLE. This thing is still on fire. But look at this. By weight, Exxon's number one. I just filmed a video with my partner Lucas today. We love Exxon. We love Chevron. We also love Fang, Diamondback Energy. We just came out with those. But you can go in here and take a look at all of these stocks are still on fire, expanding margins. Now, these fundamentals are starting to lag, right? Because as I mentioned, with the price of oil exploding, windfall profits are due to a lot of these companies. So the fundamentals should be spiking up. This is one of those rare instances where you have a complete market disruption and a complete repricing, which could stay sustained for a while, because don't forget, price of oil comes back in, let's say in a week, 2 weeks, 3 weeks, we're still going to see quarterly runs for these companies for a long while. And I just showed you how 12 and 24 months later, ironically, energy stocks are significantly higher. So is this a case where I just jump in and look at the questions in the chat here and answer them myself? I think probably. Let me find. Okay, we got some in the chat. Someone's talking about combining this with Smart Money Tool and Acorn. One thing you need to know about what we do, smart money and institutional flows out there in the marketplace today in terms of data providers, nobody is doing what we do because, as I mentioned, when I handled that massive trade, the SEC requires you to wait 5 days, no later than 5 days before filing your 13F filing, which means they can buy a material stake of ownership is 5%. They can buy 4.9% of the float and then gun it for the next 4 days. And then they report. You could be weeks behind money flows. What we do is we find it on the close of that day. So, a lot of nice compliments. Thank you very much. Oh, I'm probably going back to chats that were before mine. Anyway, so yes, our stock picks do win 70 to 90% of the time, but remember, that's a longer time frame. So if you're getting in there for some of those reversion trades and selling puts, you're going to have a very high win rate. I hope you did take screenshots. And what I need to do before I forget, because everybody gets mad at me, back home on the range, I have an offer for you guys today. Don't forget to sign up for the free insights. You don't have to buy anything. If you did want to buy something, we have a special deal today. Pro is usually 30% more money, 12 months, it's $24.49. What you do get, you get a weekly flows report, everything about the market, kind of a digest of what I just explained to you, where the flows are going in, where the flows are going out, what are the best stocks in those. You get an outlier 20. Those are the top 20 ranked stocks seeing inflows for that week. That's our highest, strongest signal. You get a monthly rebalanced, it's not really a portfolio, it's a list of our top 50 highest scoring stocks seeing inflows over the past 6 months. If you want a comparable thing to sort of benchmark it to, not benchmark it, but compare it to, it's like the IDB 50. It's like your best of the best stocks. That comes out each month. You get the big money index. You get pro updates where we release special lists of stocks. Like if the market goes oversold, we'll be like, hey, these are our top oversold stocks you need to buy today, etc. And you get the full portal access of everything I just showed you. So that's the special deal. If you want, you can take a screenshot and save the QR code for later. Now that I got the that stuff out of the way, are there any questions that we should know about? Let's see. Mines in the water is definitely not a good thing, but let's not forget the Straits of Hormuz have never been really closed for a prolonged period of time. This will be interesting. However, you already have the strategic petroleum reserves coming online. They're releasing 400 million barrels. Obviously, that's not going to fix the problem overnight. It, by some estimates, will ease the problem by 10%, 2 million barrels a day, because the Strait of Hormuz is responsible for 20 million barrels a day. You have the neighboring country, Saudi Arabia, saying, hey, we can have a pipeline online within 5 days to divert some from the Strait of Hormuz. And let's not forget, the neighboring countries in Iran are not desperate for a prolonged oil crisis because, yes, they will experience margin expansion in the short term, but they need their product distributed around the world. So I don't foresee this being prolonged, but then again, I follow the data. And oh, someone with a really nice compliment. Money flows analysis and data has been such a value, made and saved me a great deal of money. The data gives me the info to follow the big money between CTU and money flows. My trading accounts are the winners. Longtime pro subscriber, worth every penny. Thank you and Lucas as well. You are welcome. Tim, thanks for writing that in. What do we think about silver companies and silver ETFs? Let's get right into it. If I can. You guys are going to cut me off, and I still have 5 minutes. Amazing. All right. I don't know what I'm doing wrong. Yeah, there we go. Let's look at silver ETF. Now, silver SLV is going to be the metal tracking ETF. Obviously, we saw a monstrous squeeze. So again, this is one of those, we saw the money flows before it became this parabolic move higher. And again, think about what we're saying. The flows knows, right? We say that, it's our little tagline. But in reality, smart money is not telling you what they're doing before they do it. You want to see when they're doing it and see if it's a reasonable trade for you to react to. So we started getting silver inflows in May. Right now, we've seen no outflows, so that's good. We've obviously had a big fall from the peak, and things have been volatile ever since. But in terms of silver mining companies, I don't have any off the top of my head. Isn't one like Silver Wheaton or something like that? If anybody has a ticker, throw it in there and I will look it up. Let's just go down the questions. Market Structure Edge. I can't say I'm familiar with him, but I will check him out. You got the offer. Do you send text? Not yet, but we are building that in. We're building an entire user dashboard that will be smart to learn by your own habits and make suggestions thereof, and you'll be able to set up email alerts soon, but it's not there yet. You're welcome, Iqbal. Hopefully I pronounced that again. All right, let's look at some stocks. My favorite thing to do. Let's look at WPM. Somebody's looking at that. WPM. So this is Wheaton Precious Metals. There you go. That's the silver one. I was thinking Silver Wheaton. 66.7 fundamental, very strong technically. This map score, I like to see between 70 and 85, just so you know, because we can have a super strong technical. Very nice bull trend. I would be a better buyer here after this pullback. It was a top 20 stock a while ago, hasn't been in about a year, but let's look at the fundamentals. I mean, with expanding commodity prices, we should see a similar thing like oil. Great sales and earnings growth, 1 year estimated earnings growth of 79%. That's the type of thing, if they come out and say, oh, it was 85, you're going to see that stock rocket higher. if the commodity price sort of stays stable. Profit margin 41.2%. I expect that to expand. They do it with no debt. I love that. Let's look at Pass. I think that's an energy company, right? Frozen. My machine froze here. Yeah. I lost my mouse, but I see it working, so I apologize. I don't know. Ah, here we go. Came back. PAAS. That is Pan American Silver Core. Sorry, I was thinking of PAA, Plains Exploration. But look, again, massive money flows, going back well before this parabolic move. The fundamental 79.2, I love that. Great sales and earnings growth, estimated earnings growth of 12%, profit margin 20%, 12% debt to equity ratio. So I think that might be all the time I have. I just don't want to go over, understanding I'm the last guy, but I'm sure you all want to get out of here, use the bathroom, have a drink, something like that. But thank you so much for the time today. I appreciate it.
Thanks for coming, Jason, and really appreciate it for you showing up. And like everybody wanted to sample his offer. We had him. I was really impressed with his platform. And like I said, thanks for being here.
Thanks so much for having me. Have a great day.
No problem. So I'm going to take over from here and just going to go over a couple of things really quick, ladies and gentlemen. Let me just share my screen with you, and let me just take over.
Please do. My thing's frozen for some reason.
There we go. All right. Can everyone see my screen okay? Just give me a chat back. Just want to do a little recap of the market for some of us here. Good to see you, Patricia, Stephen, Kathy, Nabel. Good to see everyone. All right. So a couple of things I just want to kind of cover really quick. So obviously, you see the market's been down about 700 points. We're getting a little bit of a correction. If you guys remember what I was talking about this morning, I was mentioning that I was a little nervous about this market. And, obviously, it's great to have all these speakers here talking about trading. And with the trading, I started getting out of a lot of positions while I was watching. So I don't know if I got out of a bunch of stocks. I sold some Netflix. I sold some Coinbase. The NVIDIA, I kind of held on to it a little bit, but I do own my Palantir a little bit. I did jump into that. I'm still holding on to that. The market right now, you could see it. We just made, go into program trading in the last 30 minutes. The market came down a little bit right there. So I was really, really nervous about that. If you notice right here, fellow traders, some of the students that are here, notice something that's called a Fausto flag. We're making lower lows, not making higher lows anymore. And it looks like we're going to probably test the 45,700, 800 on the Dow. And if it doesn't hold there, they're probably going to come all the way down here, which is a really big one, which is 45,000. So my big thing is you could always buy it cheaper, the market. It's not going to hurt. Cash is king, Everybody's like, well, don't eventually you have to buy it back. I'm like, yeah, eventually you got to buy it back, but big deal. You got to do what you have to do. All right. So, but we had a very good market in the trading room. There were things that were moving. The AGRZ was awesome. It was up about 150%. That was a good move. We had the LWLG. That one ran from 6 to 7. That was pretty good. Which one was also really nice? The BNBL. This one right at the gate ran from 330 to 420. There were a lot of good moving stocks out in the market. So, not everything was terrible. There were some really good movers, which was very important. And then obviously we talked a little bit about these, all these drone stocks. This one did pretty well. What happened to RCAT? Did RCAT do anything? RCAT moved a little bit. That was about it. All right. So I don't want to take too much time. I know it was a long day. We had some great speakers. Luciano, thank you very much. I'm glad you guys enjoyed it. Before we go, if you guys want to join the trading floor, here's a trading floor really quick. I just want to bring it up over here. So you're all invited to come tomorrow. Every single one of you, if you have not registered and you want to see all the traders that we trade with in the trading floor and see what day trading's about, swing trading's all about, you still can get registered right now. It's a $9 trial. Just take your phone, scan that QR code. You're going to get 1 week access in that trading room. You're going to get 1 week of all our training classes. And if you do it now, you will be able to get a free coaching class with me personally. So I don't know if anybody ever talked to the owner of the company, but listen, we need to have that conversation. If you really want to do it, if you're serious, I'll take you serious. So last chance to get registered. I know a bunch of you here already did, but I don't know if you heard my presentation from yesterday in the morning, but if you want to come in, we're going to give you my book for free, which is $60 value. You're going to get access to Nasdaq TotalView, and we're going to teach you how to use it. So once again, $9 last minute, just get registered. I know, listen, everybody was telling you, about their great programs, but this is obviously the most inexpensive one that we have, and we do it for a purpose. All right, so let's get registered. Thanks everybody for listening. We'll see you for the next upcoming one. If you did register, I will be doing a recap next week on this on Thursday at 12 o'clock. So if you come to join the trading room, we're going to do a real quick little recap, but we got these videos already set up for you. Thanks for listening, everybody. Happy trading. And for everybody here at Cyber Trading University, we wish you a good evening.